10th Securititation Summit, organized by Vinod Kothari Consultants Private Limited and Indian Securitisation Foundation. We derive a great sense of achievement when structured finance industry tells us that they look forward to this event every year. So this support from the fraternity has been the main driving force to make this event better and bigger every year. And the reason is that this event is not just a social gathering or a networking opportunity, but also a platform to pick up feedback from the stakeholders on the points that may require making of a representation to the regulator. It has been more than 6 months since RBI notified the new securitization directions, and we will look forward to your interactions through the day-to-day. While the market is trying to adapt to the revised frameworks laid down for securitization and transfer of loan exposures, it is also coming out of the clutches of the economic crisis caused by the pandemic. During FY22, the composite volume of securitization and direct assignments rose to 1.35 lakh crores, which is a 50% growth over the 90,000 crores in the pandemic-stricken year. Though the volumes are yet to match the pre-pandemic levels, however, the market surely is in the right track to get back to that level once again in India and globally. To mark the 10th year of this event, we have tried to craft the agenda very carefully. The topics for discussion range from traditional asset classes to the innovations in the market like decentralized finance. This year we will have 3 panel discussions instead of 4, and along with that, there will be a fireside chat session, which will be led by an anchor person, and we have called this as a Chakravyuh session. We expect participation from all present in the hall. So at the end of the session, the anchor person will present the views of each of the chakras. I would now like to extend our gratitude to the sponsors whose support has been tremendous. We have Nadana Capital as our platinum partner, Poonawalla FinCorp and HDFC Limited as the gold partners, Cred Avenue, Ugrow Capital and Resurgent India as our silver partners, and Ratna Fin as our associate partner. The event is also endorsed by the Asia Securities Industries and Financial Markets Association, the Asia Pacific Structured Finance Association, and the Australian Securitisation Forum. Last but definitely not the least, I would like to express our gratitude to the galaxy of speakers for agreeing to share their valuable insights on various aspects of securitization. Before we begin with the first session, I would like to invite Ms. Bama Balakrishnan, Executive Director and Chief Operating Officer of Nadana Capital, for the welcome address. Please welcome her with a wide round of applause.
Morning, everyone. I think we still have a lot of people who are trickling in, and hopefully see a bigger audience through the day today. I'd like to extend a very warm welcome to all the speakers, panelists, and of course the guests for the event today. It's a pleasure to deliver the welcome address at this summit. It's not easy to start and carry on such an event for a decade. And I do want to congratulate Mr. Vinod Kothari and his team for carrying this forward with a lot of momentum over the years. I think this has become the flagship event for the industry and for all of us. I think as you just heard, what we saw in FY22 was a pickup in the overall securitization volumes, but it's still not nearly enough. We believe that in the coming year or more, as the interest rates start going up, we see liquidity tightening. We believe that securitization poses a very credible alternative, including for very large originators, to raise financing, optimize their own financing sources, diversify funding sources, and so on. And we expect that momentum to pick up. Also, as some of the concerns around portfolio risk start falling off, and there's greater confidence in terms of asset quality that can be expected going forward. I think the other trend we've seen over the last couple of years on the back of the pandemic was concerns around servicer risk, working with small and mid-sized originators, and that's a core segment that Northern Arc works significantly with as well. We certainly believe that as some of these risk-off concerns recede, we should see greater participation and risk appetite coming in for the smaller originators as well to expand the market. What we've also seen over the last, I would say, couple of years is the emergence of new investor segments into this asset class in general. So we've seen greater participation by foreign banks. We've seen non-institutional investors, which includes HNIs, a few family offices, corporate treasuries, coming into these markets as well. And this obviously requires, I would say, orderly distribution going forward and responsible selling. But it's certainly very encouraging to see the investor base widen and diversify. If you kind of look at the broad numbers and compare a market that's very often compared with India, which is China, in terms of GDP, we are probably, not so significantly smaller than them. China is about 2.5 times on PPP basis. But if you look at the securitization market size, for example, in terms of the overall volume, in 2020, China was about 12.5 times. And I believe the bigger constraint today is on two fronts. So one, if you look at what the changes in the accounting standards and the adoption of India's equivalent of IFRS did, I think there were concerns around the lack of clarity on capital allocation, derecognition, and so on. I think a lot of that has got streamlined over the last few quarters. I think that should cause more originators to come into the market as well. And I think the other constraint that we see is basically excessive dependence on the originator as a servicer as well. And we hear this from a lot of investors that we speak to. I think 2-3 things which we believe can change the equation. One is, I think, greater emergence of third-party credit enhancement providers, subordinate investors, guarantors, which makes these structures more efficient. Also supports the derecognition that originators might be able to get. I think the second key aspect is ensuring that there is transparent availability of information. And I think to that end, the emergence of technology platforms, working with some of the new age, I would say tech-based financial services providers as well, and the transformation we are seeing in the traditional players, meaning portfolio data is available seamlessly, structuring tools are available. There are tools available for stress testing on the platform and transaction monitoring, and a lot of this then takes away the dependence on the originator as a servicer going forward. We're also seeing the emergence of a lot of collection tech platforms, and we believe this ecosystem coming together can really catalyze, I would say, greater interest in investing into securitization. So some of this becomes infrastructure that's needed for the future. And not just a tactical response to constraints that we see now. I think at a very broad level, perhaps it's a good opportunity for regulators to push towards this, industry participants and industry bodies to push towards some of this as well. I think the summit panels actually cover some of this during the day. But certainly looking forward to conversations on newer underlying asset classes, whether it is green securitization. So we've seen a lot of interest in financing renewables, whether it is electric mobility or it is rooftop solar, whether in the industrial or the residential segments. Of course, that will all get a lot of fillip as the infrastructure in terms of charging stations and some of the reverse metering infrastructure and so on comes up. But we believe that, that's a very interesting underlying asset class. There's a lot of interest from offshore investors to come into some of that. The other big asset class we feel, which is at a critical juncture is how do you kind of create marketable products to ensure transmission of trade receivables assets. So there are a lot of dedicated platforms that have come up. There are traditional originators who have a lot of this on their books. But how do you kind of create efficient, longer-term vehicles, more program-driven intervention to enable transmission of some of this? And for these and some of the other traditional asset classes, I think creating a more conducive environment for offshore investors to come in, I think is quite critical. We're seeing interesting applications of Gift City for this as well. And, of course, we and many others are looking at setting up vehicles there to facilitate this investment flow. I think the other big challenge remains having structures that can be efficient for hedging. And hopefully we'll hear some of this and other points through the day. So looking forward to the conversations. I don't want to, stand between you and the panels and the speakers today. Thanks once again to the organizers for allowing us to be sponsors for this event, and look forward to a great set of conversations today. Thanks, everyone.
Thank you, ma'am, for that address. We will now be beginning with the first session of the 10th Securititation Summit 2022. The topic for the session is Indian securitization market going the global way. For this session, we will have panelists joining us physically as well as virtually. I'll first introduce the panelists joining us physically. We have Mr. Vinod Kothari, Director, Vinod Kothari Consultants, who will be the moderator for this session. We have Mr. Sanjay Chamria, Director, Magma Consumer Finance, Mr. Krishnan Sitaraman, Senior Director and Deputy Chief Ratings Officer, CRISIL. Joining us virtually, we'll have Mr. Mark Adelson, Editor, Journal of Structured Finance and Independent Consultant, Mr. Prashant Dwivedi, Head of APAC, ex-Australia, Asset Finance, Credit Suisse, Mr. Ben McCarthy, Managing Director, Head of Asia Pacific, Structured Finance and Covered Bonds, Fitch Ratings. I would now like to invite the panelists onto the stage, and I'll hand it over to the moderator.
Very good morning, all of you. It's indeed a great pleasure to be here in the midst of all of you. And on the part of the organizing team, I must say it's an extremely overwhelming response that we've received. Over 250 participants registered today, so that's a tremendous response, I must say. And this is indicative of the way the securitization market in the country has come up. I would say broadly performing two significant functions, connecting the financial sector entities among themselves, smaller originators selling their pools to larger entities, non-banking finance companies selling their pools to banks, housing finance companies transferring their pools to maybe other housing finance companies or banks. That's one part of the market, and the other part is to create a bridge between the financial markets and the capital markets, where assets get pooled into securities, and the securities are ultimately transferred to capital market investors, be it the asset managers, be it the HNIs or family offices or other investors of whatever sorts. Now, in terms of economic value, the intra-financial sector moving of loans, loan pools originated by NBFCs moving to banks, whether that would fall under the classic definition of securitization may be an academic question. But the issue is quite clear that there are people who are banking on the differential capabilities of different originators. NBFCs have the connectivity with the last mile borrowers. They have the franchise with the geographical spread of the borrowers across the country. There are some asset classes that they understand better. So they are the ones who originate, and the loans eventually get sold off to the banks who probably have funding capabilities. Origination capabilities, funding capabilities, servicing capabilities, collection capabilities are all distinct parts of a financial transaction, and the process of origination of loans and moving them into securitization is leading to a dissection of these capabilities so that every player focuses on their respective differential capabilities. But in an economic sense, the real value of securitization is to create a bridge between the financial markets and the capital markets by transforming assets into securities so as to make the securities capable of being traded in securities markets. Now that is something which is happening to a limited extent in India still, but we have evolved over time two distinct instruments, the so-called direct assignment, which has now got a new name, transfer of loan exposures, and the so-called pass-through certificates of securitization. And maybe over time, the way it might evolve is that intra-financial sector transactions could happen more in the form of direct assignments or transfer of loan exposures. That's actually loan trading between the players in the financial system. And the bridging between financial markets and capital markets could probably be focused on securitization as such. But this is something that I should not be talking because we've got a great panel today. So let me introduce our panelists today. Joining virtually, we have Mr. Mark Adelson. Mark Adelson is joining today from New York. And in terms of time zone, I'm sure you can realize it's almost close to midnight for him. We have another panelist, Ms. Ben McCarthy. He is currently joining us from Sydney, Australia. And we have Mr. Prashant Dwivedi, who is joining us from Hong Kong. We have Mr. Sanjay Chamri already there. And Krishnan Sitaraman should be able to join very shortly. So he will just be walking in as he comes in. We would be expecting Mr. Mark Adelson to provide a global overview because after all, the Indian market should at some stage get aligned with the global markets. In terms of regulations, the regulations of RBI in September 2021 are largely the same or similar as they exist elsewhere in the world. They are aligned with Basel norms, they are aligned with European securitization regulations. So in terms of regulations now what we have is very much similar to what it is there elsewhere in the world. In terms of the market itself, a larger part of the market is still consisting of the so-called priority sector loans. The concept doesn't exist elsewhere in the world. We have less of bank originations. We have most of it is originated by non-banking finance companies and bought over by banks rather than the banks originating and the capital market investors buying up. But these are developments which continue to happen over time. Now, I have a point to start with and we'll probably have to discuss with our panelists as we proceed, that currently when global volumes are picked up by each of the rating agencies come up with the 2021 in retrospect and 2022 in prospect. They annually come with volumes in the world. Some of them come up with volumes in Asia Pacific as well. I was sort of able to see that these data do not pick up the volumes of India. I couldn't know what the regions could be. I tried interacting with some of the people who prepare the reports. Probably there were no convincing reasons as to why Indian volumes are not picked up, but probably the market in India has to gain visibility to be seen as a part of the global market space. In terms of volume, we're quite significant. Bama madam mentioned that we do not compare with the way the Chinese market has come up, and our panelist today, Mr. Mark Adelson, will talk about, in fact, each of the three panelists will talk about the Chinese market too. But in terms of the kind of asset classes that exist in China, mostly infrastructure loans or corporate loans or the so-called CLOs which come into the market, that's something which is not in India. So it's not a strictly comparable market though, but nevertheless, we are happy to see the market coming up very well. And with these few introductory remarks, I'm straight moving to our first panelist, Mr. Mark Adelson. He would be giving us a view of the developments in the world, 2021 volumes, in the US specifically, and then maybe over to the rest of the countries. And he will also give us some view on the asset classes emerging. And to give flavor of the way the investors or investors' interests are affected by emerging litigation, he would also talk about some of the case law pertaining to securitization in the US courts, in particular transactions or rulings which might affect investors' interest or the roles or responsibilities of trustees in transactions. So Ms. Mark Adelson, over to you. We are happy to see you once again joining in. I know it's almost close to midnight for you, but thank you very much for being there, and over to you, Mr. Mark Adelson.
Thank you, Vinod. It's a pleasure to be here. I'm going to try and share my screen so that I can use slides. Um, let's see if that works. I hope you can see that. Okay, it looks like it's there. So we're in business. All right, so I want to start out with some, just big picture of what the markets look like. And starting out with the U.S., it's the biggest market. You can see that there's total structured finance volume for 2021 was over $4 trillion. But the great majority of that was agency MBS, securities from Fannie Mae, Freddie Mac, and Ginnie Mae. So it tells us that the area of private securitization remains much smaller. The other thing to note here is that on a year-to-date basis through the end of April, 2022 is shaping up to be somewhat slower than 2021. And this is driven by various factors. Obviously, rising interest rates in the US are important, and so is uncertainty stemming from the geopolitical issues like the Russian-Ukrainian conflict. So we see the same thing, again, taking away the agency MBS, just focusing on private sector volume. We see that 2022 is running slower, and the ABS area is the biggest so far this year. CLOs have shrunk notably. When we go ahead and look at Europe, 2021 was a good, brisk year in Europe. I don't have 2022 figures. My impression from deal counts is that it is slower, basically proportional to what the U.S. market is observing. Chinese securitization volume, as Mr. Kothari explained, is roaring ahead. It's growing year after year. In dollar terms, the 2021 volume was in the ballpark of $480 billion, big number. So that's a brisk market. I don't know whether it's slowing for 2022 yet. I don't have 2022 figures. Indian securitization, 2022 was up from 2021. Good numbers, but a little behind 2019 and 2020. Obviously, there's been issues with the pandemic and everything else. So we'll see what happens going forward. I want to turn to the issue of investor protection. And I want to focus on some developments in the US that may be illuminating for the rest of the world. There may be missteps and challenges that are arising in the US market that can be instructive to other global markets and can help them avoid some of the problems that the US structured finance market has encountered. Just to paint the picture in the broadest terms, investor protection runs on the securities laws in theory, which have very strong remedies but very short time limits for investors to exercise their rights. So, because those time limits are so short, structured finance investors have had to resort to their contractual remedies, which are a lot more limited. And it turns out there are many contractual traps in them. And I want to give you some examples of that. So there's a recent court decision in a case called US Bank versus DLJ Mortgage Capital, in which the highest court in New York State took a very narrow reading of how investors' rights could be enforced. And what they effectively did was they limited the ability of investors to benefit from the discovery process that occurs during litigation. And this can basically take a lot of the wind out of the sails of investors' efforts to recover losses that they've suffered unjustly. I have a link on the slide to the decision. If you want to read it, all New York court decisions are readily available on the internet. They're easier to get than US federal court decisions. This is notable and very recent. It is a continuation in a long string of decisions from New York's highest court that have narrowed investor remedies in various ways incrementally. And this is a list of some of the cases that have done it. And any one of them by itself isn't such a big hit, but putting them all together represents a significant drag on investors' ability to recover losses that they shouldn't have incurred because mortgages were not what the issuers claimed them to have been. A case that goes completely the other way is called LCM 12 versus Serta-Simmons Betting. And here, this case went in favor of investors, really. LCM 12 is a CLO that had purchased pieces of loans to Serta-Simmons Betting, a leveraged borrower. And in keeping with practices of some other lenders for the past several years, Serta managed to maneuver in a way that was very detrimental to some borrowers, but not others. And the CLOs were among the borrowers who were injured. They brought a lawsuit, and the court basically sided with the CLOs. The case is not finished yet. It's moving forward, but it got past the stage where the borrower, Serta-Simmons Betting, sought to have it dismissed. In other words, the court rejected the borrower's motion to dismiss. The next case is the most important one I want to talk about because this goes to the very heart of the internal governance process within structured financings. So the main problem that's come up in structured financings is that parties to the deal haven't done what they said they're going to do. They've put in assets of lower quality and then refused to buy them back. And the expectation among investors, among market participants broadly, is that, well, in the first instance, that the deal participants will comply with their contractual obligations, but failing that, that the trustee in the deal will enforce those obligations for the benefit of investors. That the trustee is there to do exactly that. And there's been a lot of litigation where trustees have achieved some success in making the argument that that's not why they're there, that they don't have to do that. And in the Finkelstein case, the court said, no, the main purpose for the trustees to be there is to enforce the duties of other transaction parties. And to make the point extra strong, the court went through an analysis of different kinds of language that appear in pooling and servicing agreements and said, well, basically, whatever variation of language is there doesn't matter. It's all, to use the phrase the court did, belt and suspenders. In other words, extra verbiage to make the point stronger, but not essential for the point. So the trial court has denied the trustee's motion to dismiss the case. stating that arguing that it didn't have an obligation, and the case is moving forward. So the case isn't all done yet, but it's a very powerful analysis. And again, there's a link to it. You can get this one here. This was not yet in the official New York reports. But there is a way to get it through Google Scholar. So I think these cases, so wrapping up, I think what these cases do is serve as a warning to what can go wrong in other jurisdictions if parties to transactions don't want to fulfill their obligations, and also a guidepost for drafting contracts to include the strongest language to make sure that that obligations will be enforced and will be carried out. So that's it for my prepared remarks. I will pass the microphone metaphorically back to Mr. Kathari.
Thanks very much, Mr. Mark. I have a few questions to ask you. One question is...
Okay.
Yeah, thanks. One question is purely non-technical. You are a very regular participant in each of the ABS conferences in the US, ABS East, ABS West. So is the level of participation, level of interest of participants now similar to what it was in 2006, 2007, or is it still subdued? Or is it...
Well, things have been slow for a couple of years because of COVID-19. So this year will be the first year, I think, where we have very, very strong in-person attendance. For myself, I was attending virtually for the past couple of years over over Zoom or whatever like this. And many people were. So last year, the in-person attendance, for example, at the big Las Vegas conference was quite low. It was, under 2,000 people. And at its peak, let's say 2006, it was 7,000 people. This year's Las Vegas conference will be in July, which is the hottest time in Las Vegas, which is in the middle of the desert. It's nearly the hottest part of the United States. But it's expected to have a very good turnout. There was just a CLO conference earlier this week. I haven't got the figures yet, but my impression is that it was very well attended, because CLOs are viewed as a hot area.
Right. Okay. So
also, I should have added earlier, you did ask me to say a word or two about emerging asset classes and activity there. So there's been a flow of steady deals, good number in the US, good number internationally. Solar deals, there's a handful of deals backed by solar projects. Another notable area is cellular devices, mostly cell phones, the contracts, consumer contracts to pay for cell phones. Another area that's worth some note is credit risk transfer. That's a very interesting area for certain kinds of issuers, particularly banks have used credit risk transfer to move assets off balance sheet. It's associated with the balance sheet CLO transactions, for example. But in the mainstream area involving mortgage risk, it is still dominated very strongly by Fannie Mae and Freddie Mac, who've done more than 80% of this year's $16 to $17 billion of deal volume in that space.
Another asset class which would be of interest to people here is the so-called reperforming loans, which I guess are securitized by both the agencies. the loans which went into non-performing loan classification, but the borrowers started repaying once again. He's not been able to clear all his dues, and therefore is still a technically non-performing asset class. Is this something which is attracting a lot of investor interest?
Absolutely. There's actually two areas there. There's reperforming and non-performing, and the difference is on a completely non-performing loan, the emphasis is on the liquidation value of the loan. So really an analysis of the underlying collateral, usually real estate for, in case of mortgage loans. With the reperforming loans, it's a different story because once they start making payments again, a good number of them will end up surviving and repaying in full. Some, of course, will redefault. But the success rate is projected based on the amount, or I should say the amount of time that has passed since the loans started making payments again that have been consistent in doing so. The reperforming is active, both in the U.S. and internationally.
Mm-hmm. Okay. Thanks very much. May I now move to Mr. Ben McCarthy? Mr. Ben, would you give us an overview of the new asset classes that you see emerging in Asia Pacific or elsewhere in the world, and particularly the developments in terms of fintech originated lending, or the news about some of the transactions which have been securitized using the tokens, the cryptocurrency based tokens? How do you view these developments? Are they like disruptions in the making, or are they like, sort of exceptional situations? Mr. Ben McCarthy, over to you.
Yeah, thank you very much, and thank you for the invitation to speak to you today. I wish I could be there. I look forward to being there next year. It was interesting when we were sort of initially having discussion about the particularly the sort of new technology. One of the topics that came up was crypto mortgages, which I thought was interesting because it was something that immediately, as a rating agency person, scares me. But it's an interesting. It sort of leads into blockchain and tokenization in an interesting way. The crypto mortgage is a product that's sort of emerged in the US, and it's very I'd say very niche, but it's designed as a product for people who have lots of assets in the crypto sector, don't want to sell them because they like their position, don't want to pay the tax on the huge gains they've made, but want to buy a house, and the lender is giving them 100% loan to buy real estate, and is taking a mortgage over the real estate as well as crypto assets, but not doing any credit checks. And I guess from a rating agency point of view, the way we look at it is that crypto is so new and so volatile that the level of certainty is just never going to be there for us. So that product sort of really doesn't sort of play in from a rating standpoint. But what is interesting is the technology itself. So the tokenization, as you put it, or the blockchain really does have significant merit, and will play into securitization over time. So whether it's through two ways that we can see it sort of emerging at the moment, particularly is smart contracts, where you can effectively sort of pass assets from one entity to another without a middleman. That makes sense to us. Land registries, for example, where at the moment you would have people have to lodge things at a land registry. If you had a sort of blockchain application, it could be done where everybody could agree who owns which asset, again, without having the middleman, and potentially, don't need the trustees to play as strong a role as they do now. So that sort of technology is happening. We are seeing, originators sort of try and move to be much more efficient on that side. But I'd say it's probably been a little bit disappointing in how it's emerged. It tends to be very slow and quite fragmented in terms of how it's being implemented. in terms of fintech lenders, we're seeing the emergence of fintech lenders all over the world, and particularly in consumer lending, point of sale lending in particular, but also mortgages. And a lot of the part of it is in the efficiency, and they can do things much quicker. So, in Australia where I am, we have old style lenders that can take 6 weeks to approve a mortgage, compared to a fintech lender who can take 2 minutes. And that speed to market is making a huge difference in terms of who is writing mortgages, and it continues to take effect. I guess from a rating standpoint, the way we're looking at it is they're still, most of the fintech lenders are actually doing the same things. They're still looking at credit. They're still they're still making sure that the assets are worth what they say they are, but they've just automated a lot of the process and made it much easier, which I think has been very effective. And we expect it to, even the old style lenders are moving in that direction. So we think that's positive. I'm not sure how much the buy now pay, what we call the buy now pay later sector has taken in India, but it's certainly in Australia and other parts of the world, it has taken out a lot of sort of taken the place of credit cards, and the sort of credit at point of sale, where effectively they're charging zero interest, and the shop, if you like, is actually paying for the service as opposed to the customer. That's become quite a sizable sector here. We've seen it a little bit through securitization, although I think there's certainly more to come. It's been very successful, but from a rating standpoint, the history's been pretty short. The world's been in pretty good shape throughout its growth, so we're really interested right now in, as interest rates rise, what's going to happen to that sector when it's put under a bit of stress. I just wanted to touch a little bit on when you talk about new products, and just your opening address mentioned sort of ESG products, and I think that's one of the real sectors where we're seeing changes in the structured finance market globally, and something that I think this session's sort of called going the global way. I think it's something where India will certainly have the ability to take on a lot of what's happening around the world. And what's interesting is that a lot of it's already happening. It's just labeled differently. And I think the realization, I sort of had the realization myself here. In Australia, we've rated, just this week, we rated a bond that was labeled social bonds, and it was a standard, what I would have called a standard RMBS transaction. But part of the loans were going specifically to fund loans to people to buy affordable housing and sort of underserviced sector. And I think your priority sector loans in India really play very well into that social bond. I think they would probably fit very well within the guidelines. So the two entities in Australia that have issued these this week, both non-banks, were following the International Capital Markets Association's social bond principles for 2021, and they're very broad. And my sense is that the Indian assets would fall very, very well within that. Just on the environmental side, or the green securitization, in the past year or two, we've rated our first transactions where auto transactions where 100% of the loans in the portfolio are electric vehicles, and we see that's become issuers who are funding traditional vehicle loans, but also green loans or electric vehicle loans, are actually splitting the portfolios because there are investors that are particularly interested in the environmental side. and I think that opens up a new set of investors. I think I already mentioned solar assets again is another one where we're starting to see portfolios that are specifically designed to fund some of these environmental assets, and that looks like a growth sector, and again one I think that will play very well locally in India as well. I might just stop there.
Thanks very much for the perspective. I have a couple of quick questions to ask you. You mentioned about buy now, pay later transactions. And I think another asset class which is also seen in both in US and UK is securitization by the P2P lenders, the marketplace lenders or the P2P lenders. Are you seeing these transactions, BNPL or P2P securitizations in either Australia, Asia Pacific or any of these countries too?
Yes, there's been a few. I'd say there hasn't been a lot just because of the evolution there. Portfolios are still growing very fast, and they haven't got as much history as a lot of the investors would like to see. So, and rating agencies would like to see. So we're starting to come up to a period where you're going to start to see more of sort of public transactions. And again, one of the things we know with the buy now pay later lenders is everybody has their own slightly different product. A lot of them are very short, so the weighted average life of a buy now pay later loan for an afterpay, or I think it's called block now, is only 3 weeks. So it means you've got a very fast revolving portfolio, and there needs to be a lot of constraints around that. Some of the other companies are offering loan sort of buy now pay later, but much longer term loans. So they're larger loans for maybe white goods, refrigerators that may be 3 years long, and that we've sort of seen more of those, which I guess is akin to the old personal loan as opposed to buy now pay later. But definitely that's a sector. The consumer finance sector is one that is certainly growing across all markets.
That's right. Prashantji, over to you. How do you see the developments in the Asia Pacific sector, particularly the markets in China, the markets in rest of Asia? And I'm sure you're taking a close view of the developments in India, comparing those with rest of the Asia Pacific region. So how do you see the market in this part of the world?
So I would say, anything that is happening in Asia is normally when I was you're working in Europe, I used to say that everything that started in US comes 5 to 6 years later in Europe, and it takes another 5 to 6 years to come to Asia. I think that cycle might be slightly expediting, but still that remains the case. So some of the other asset classes that Ben and Mark kindly were discussing, and before that Bama was mentioning, in my mind, I think if you think about Asian market, right? Which are the active Asian markets per se? And I'm totally talking about as a principal investor, because Credit Suisse in a lot of these jurisdictions, unrated transactions, normally we invest into all kind of matured players, tech platforms, early stage companies and whatnot. So if I take the whole space, there are for me, there are the active market will be, of course, China, world's second biggest securitization market besides US. And I think Bama touched on a point about what percentage of GDP is China's ABS versus India. And so India is roughly, if you take the loans, loan trading into consideration, the overall market is roughly 75.75% of GDP in 2021, while China is roughly between 2.5 to 3% of GDP. So you can see the difference where we are talking. And so personally, we haven't gone to China for different reasons, but in today's time, we might call it a blessing. But if we keep it slightly aside that market, in other markets away from China, the active market is Hong Kong local market. which is predominantly mortgages because, as you know, it's one of the world's most expensive real estate, and there are mortgages which a person sitting in US or in any other part of the world can't even imagine how much a small 800 square feet flat can cost you. So those are the mortgages coming for financing. We are part of those, some of those. But beyond that, Hong Kong, there is uh, markets in APAC. In again, I take Australia as a DM. So and there is a everything that happens in Australia is more like what happens in Europe or in US in terms of asset class, in terms of the securitization development and whatnot. But away from those two markets, you have countries which are ripe for securitization, but the volumes are too low because the economy itself is too low. There are countries like Singapore, countries like Korea. Korea, we see quite a few transactions, but all on the private side. Unfortunately, Korea regulations are very, very difficult. You have different regulations for real estate. You have different regulation for example, P2P platforms. And you have to be mindful of every time when you go and do a transaction, you need to think about that particular asset class regulation in relation to securitization. And then comes India and Indonesia. For me, there are like two big buckets of purely because of the GDP, because of the size, the credit market, and whatnot. So for me, India is doing a lot of things right in terms of, as you just talked about, September 2021 securitization specific jurisdiction, which is pretty close to what your global benchmark or global guidelines for securitization is. So we are coming to that space where there is a volume, there is credit growth that's coming with it. What's need is like driving that credit to the financial markets or driving that credit to the capital markets. That's where I think that link is missing so far. I'll come to detail to Indian market in a second, but before that, I'll just take Indonesia market. Indonesia is a market which we always would love to kind of get more involved in. The real struggle in that market is there's no securitization regulation per se. So there is a lot of couple of trades that have happened in Indonesia done by the local banks are done because of their borrowing of their some of the regulation from the common law or the law of the country, which is always an interpretation, not a securitization specific regulation. The biggest hurdle in doing a securitization or two biggest hurdles in doing a securitization in Indonesia are, one is you have to get permission of sale of the receivable to an SPV from the ultimate borrower every time you sell a receivable, and they need to give you a written confirmation for that, which is a huge hurdle in any securitization. And the second part is the counterparty which gets paid the least in the whole transaction, which is your trustee, has a lot of liabilities for which they can be punishable in the court. So, which doesn't allow you to get an independent trustee to do those transactions. So, it could have been great to have that market evolve a bit, come a normal securitization, adopting a normal securitization regulation. That will open a big market for people who are trying to establish a viable Asia market per se. And when I say Asia, again, I reiterate, I only mean non-Australia, New Zealand market. And then comes India, right? So in India, as I was saying, there are a lot of things which are going on the right track. If I took it from a myopic lens of the way we invest into these transactions, I think a couple of things which we would like things to get better. One is the whole velocity of the money. So if we do a deal, ideally we would like the deal to have a significant size. And that size means that, and a public market for it, which means that you have a primary market, you have a well-established secondary market, which brings the liquidity in the market. The liquidity in the market, what will do is bring in more international players to the market. So that's one. The second part of that is, even with the new securitization regulation, one of the big gaps we still feel is still there is what we traditionally in other jurisdictions like Europe and US, we call warehousing of a particular, for a particular originator. So right now, all your traditional PTC route is you have built a volume and you then need to put it in SPV, and over the time that amortization comes and you go from X to Y X to volume X to zero over a period of time, and your investor get paid. Where we would like that market or the regulation to come in, where you have a let's say a new age originator, call it a tech lender, which has the good technology, everything right in place. They need the real capital behind them to propel their growth. Where people like ourselves can do is like start from, let's say, 10 million trade, which is their seed volume, and to grow that portfolio from 10 million to 50 million US. And at that point of time, we go and do a proper public securitization, do an exit, or allow that transaction, given that if it's depending upon the nature of the asset, we either allow it to amortize into the warehouse itself or do a proper capital market transaction as it happens in any other country where the type of securitization market is well developed. That particular piece, as I understand so far during with my conversation with the lawyers in India, we don't have that flexibility yet. And for me, I think it's a win-win situation for both us, for Create Opportunities Fund, which are practically missing from this space in India, which will bring a lot of them into the space. And most importantly, for the originators who do not need a huge amount of capital to build that asset balance before they can, do the securitization and get some leverage on it. So that's one of the big missing piece. The second part of that is like a very active non-performing loan market, right? Securitization of non-performing loans. It's happening. I'm not saying it's not. We know that India's India's bad loans are one of the biggest. If you talk about only maybe Italy was higher. I don't know where they are right now. And the whole idea of putting the bad bank together, which government has, was a great initiative. I think what Italian government did, if you think about 4 or 5 years back, they allowed the non-performing loan securitization, and they essentially allowed them to. They allowed the private market players to become the equity or the mezz players in that capital stack, and the senior part of that capital stack was guaranteed by Italian government. So that traded very cheaply. And what happened was the leverage return for the players, the equity players, were pretty good, which essentially meant that a lot of these private equity guys, Create Opportunities Fund, they got, and in a way it helped both parties, i.e. it allowed the private parties to help in getting that, and of course getting the better economics, but also allowed the government to get rid of a lot of those bank things. I think for many political reasons that might not ever happen in India, but that's something that we would love to have to see in this market happening. So some of the and third part of that, as I said, which is somehow related to what I was saying, is that new asset class is digitization of Indian economy is phenomenal. I mean, very few countries match it in the speed and the growth that it's seeing. That will enable more and more tech lenders to come in and exploit that space, leverage that technology, and get deeper credit into the deeper market in India and different rural tier 2, tier 3, tier 4 cities, which already is happening, in fact. So, but how do you allow that capital to grow? I mean, we allow that by allowing people like ourselves to get involved with those players. And for that, I reiterating that warehouse point, it cannot say enough that we should be bringing a regulation around that, where the capital comes at an early stage into that, i.e. the third party capital comes early stage, and then allow the firm to grow with it, i.e. the end lender. I think that will be broadly my view on what in terms of where I see the broader Asia market, and without going into details of what exactly good things are happening in India, because all of us sitting in the room and on the panel know about it. It's about what we would like to see as a change, which will, in my mind, will allow this market to really start functioning like a proper a market which possibly UK and US have been doing for the last 10 years or so. I will stop there, Mr. Kothari.
Thank you very much. There were some very interesting points that you made, and incidentally there are participants from the Reserve Bank of India, and there is one from SEBI as well present in the room, and I'm sure they're taking note of these very important points. Of the points that you made, there are two that I picked up and I would like to maybe make a mention of this. Number one, warehousing finance. You rightly mentioned that that's something that happens all over the world. During the time when you ramp up assets for the so-called, in India we call it minimum holding period. You're ramping it up to take to the market. There is a statutory minimum holding period. There also is a period during which you are building up the size to reach to that critical size at which you can take it to the market. There is only one option of on-balance sheet funding during the ramp-up period. You have traditional lines of funding during that, and you do not have access to an off-balance sheet method of funding during the warehousing period. That's a very important point. The other one that you mentioned about non-performing loans, and you gave the example of the Italian government's securitization of non-performing residential loans, where the government gives a guarantee. If the transaction has investor interest up to a BBB level, then the government gives the guarantee for the rest of the investors. That would mean the originator has to either arrange for his own interest or some other investors to reach a level of BBB rating, and thereafter the government guarantees the entire non-performing residential loan pools. This is not just in Italy, but there are at least Spain and Greece also have similar structures, government guarantees for non-performing residential loans. So that's a point which we intend to discuss during the fireside chat session today, securitization of non-performing loans. And I think that's the right juncture. I can move to Mr. Chamria, who, as I understand, has interest in non-performing loans as well as performing loans. And the best part for Mr. Chamria is that he's seen the origination side for several years, I think 20, 25 years, and is now perhaps having interest as an investor, a potential investor as well. And having seen this market from the perspective of a CEO of a very successful non-banking finance company, how do you visualize securitization or direct assignment as a part of a business model? Strategy of a non-banking finance company structured around securitization, direct assignment. Do you see strategic benefits in that? Do you see strategic risks in that? How do you view it from point of view of a CEO? Maybe you can take that.
Good morning to all the participants, and thank you Vinodji and the team for giving me the opportunity to be amidst all of you and share my experience and thoughts on the securitization, both on the liability and on the asset side. There are two instruments principally, and as I've seen over the last 15, 20 years, one is the PTC and other is the assignment. And from an NBFC perspective, which includes a HFC or a microfinance as well, I think we look at it from liquidity perspective, then we look at it from a regulatory and accounting perspective, then we look at it from a risk transfer perspective. And the calls that we take in a everyday treasury management or a P&L management, we typically would compare between a PTC and a DA based on these three principal parameters. Liquidity, of course, is common, and we have seen that India has several hundred very active NBFCs under different subcategories, and not all of them have sufficient access to the borrowed capital from the banking system. Second, we also see that between the small and the medium NBFCs, and more than 95% of them would fall in that category, that banks are still not very comfortable taking credit exposures. And therefore, in the last 20 years, securitization has emerged as a very powerful tool to create liquidity in the balance sheet. And it is originally considered to be an off-balance sheet item, but I think for the companies that moved to Ind AS, where now you retain on balance sheet, whereas in RBI filing, it is still treated off balance sheet. So I'll leave that to some sessions where I think this topic will be taken up. So I've experienced on both sides where we used to treat it as off balance sheet for accounting as well as regulatory, and then on balance sheet for accounting, but off balance sheet for regulatory. So what I feel, if there are people from the regulatory side, that there is a need for some level of harmonization to make life easier for the practitioners of securitization as a tool. So liquidity is a very important aspect. From a regulatory and accounting perspective, as I spoke about, there are some chinks that can be ironed out. And the third and the important one is on the risk side. PTC, as we know, that the risk is retained more or less, and I'm talking more practical than legal terms, entirely by the NBFC. There is no risk transfer to a third party who provides a second loss, or there is no instance that I would remember in the last 20 years where a securitization transaction has failed in the sense that the first loss, the second loss, all have been exhausted, and the investor had to book loss in its balance sheet. At least I'm not aware, I would like to be educated on that. And probably going back to what we saw Mark sharing the details of the various lawsuits, I think at least we are very fortunate and lucky in India that despite having securitization for the last 20 odd years, I am at least not aware of lawsuits being filed between the originators and the investors. In the same breath, I will also like to touch upon a sensitive issue that there are with regard to assignment. And if you look at the entire landscape, who are the investors in the PTC or the assignment? It is largely the banks. But banks are not the only providers of borrowed capital. You have a very important mutual fund industry, which are the 40 trillion rupee worth of the AUM, and a larger part of the AUM is the debt mutual funds. Then you have insurance companies. They would also have probably $30 trillion Indian rupee. So if you add the two together, it is 50% of the banking system. And they are not very present into the debt market. And how this kind of a summit, Binodji, now you are celebrating the 10th anniversary, possibly to pull them into the mainstream so that it can expand the funnel. And if the funnel expands, it will benefit the entire NBFC sector. So this was more in terms of a landscape. So coming to that sensitive point of assignment by the very nature, as well as by the regulatory guidelines, I think from 2013-14 onwards, when probably there was the first guideline issued by RBI on deed of that assignment or transfer, that the risk also goes with the sale of the portfolio. And we have also seen that it is typically the domestic nationalized banks which have been the large buyers and the investors into the assignment of pools. It is not the private banks, it is not the foreign banks, and certainly it is not the mutual funds. It actually establishes a distinction that the private banks, foreign banks, and the mutual funds, they are not keen to take the credit risk in the portfolio. Whereas the PSU banks, they take. One, they also, it helps them fulfill the retail portfolio build up as a mandate from RBI and from the government. Two, it also helps them to fulfill the PSL obligations. So therefore, they do an assignment deal. But at the same time, their expectation is that we don't want to have any losses on account of the performance. Now, in a retail portfolio, you will have 1%, 2%, or even 5% losses. You build that into the price. But then you should also take the losses in your books. So this is an issue This is an elephant sitting in the room. Today I can talk freely about it, and I will leave to the practitioners and the organizers to kind of address this issue and put it to bed. This is one outstanding issue which, in my opinion, should get resolved, and it will actually then expand the market, and water will find its own level. I'll now touch upon what Prashant mentioned, and Vinodji also mentioned about the non-performing loans. And I see that RBI on 24th September 2021 came up with the two set of guidelines. One is that securitization, and the other one what they call as the transfer of loan exposures. And I think that covers both the standard and the stressed assets. And I think there is another very strong emerging class of investors which is emerging. Now, all of you sitting in this room, if you look at your own investable corpus, you have an allocation to equities, you have an allocation to debt. How much do you earn in the debt? You put into liquid funds, you put into long-short arbitrage, you earn 4%, 5%, or fixed deposits, you earn 4, 5%. Can we channelize that part of the corpus which you have allocated to the debt to be put into securitization through some kind of an intermediary, which is a AIF, or which could be a dedicated fund? And therein you have a chance to earn 7 to 8%. I think that also will expand the market. And coming to the what Bhama mentioned some time back in her inaugural address, that there is another class of HNIs in the family offices who understand the market well and who may be willing to do a risk assessment of the non-performing loan portfolio and then take a larger exposure on that. There are certain, I think, logistical and infrastructural bottlenecks also that need to be resolved. One is you need to have a third-party independent servicing outfit so that usually what happens both in DA and in PTC, it is the originator who does the servicing, which is absolutely fine. But every single agreement provides for, in the unlikely event of the failure of the NBFC, the investor, both in the PTC and a DA, have a right to take over the servicing and give it to a third party and adjust the cost from the receipts and then adjust towards their own principal and the interest of the securitized pool. So, and I'm sure if time permitting, my friends from overseas can share that the markets, like Bama mentioned, China is 12 times the Indian market. We saw the US market is more than the overall European market. There must be these kind of independent third-party servicing outfits which can provide a letter of comfort that will step in tomorrow if required and charge a commitment fee, which also will expand the market. So these are some of the thoughts which I felt, and of course on the non-performing loans, I think there are certain issues with regard to how you treat on balance sheet and off balance sheet. The purpose why we sell in NBFC a non-performing loan is because we want to reduce the NPAs. Otherwise, if I'm the originator, no one will know better than me how to collect money from a delinquent party. But RBI, the regulator specifies, their expectation is that the reported GNPA should not be more than, say, 6%. On the other hand, 12th November guidelines says you have a debt stamping of the NPA, and once an NPA, always an NPA unless it comes down to the zero bucket, which on the industry representation, it is extended to 30th of September 2022, which is just about 4 months down the line. And by the rating agencies, there is a projection that once that is implemented, it will enhance the NPAs by about 1 to 1.5%. So if you add the entire math together, in the December quarter, there will be more pressure on the entire NBFC system to sell the NPAs. Now, if they sell the NPAs, there should be buyers for the NPAs. How will there be buyers if they don't have the capability to service? And if they lean back on the originator, so you understand where I'm coming from. So there are some structural bottlenecks that need to be addressed, but I can share that there is a lot of patient capital available, provided these bottlenecks are addressed. I will not take more time. Thank you very much.
Thank you for picking up those very interesting points. I must just say, for the benefit of all participants, that we have two so-called fireside chat sessions in the afternoon today. Number one, dealing with securitization of non-performing loans, specifically on that. And we will also have a session as to whether banks are giving a fair deal to the direct assignments. You mentioned that the PSU banks which buy pools are unwilling to take losses in the pool, so are they actually giving a fair deal? That's a topic for an inclusive fireside chat session today in the afternoon. By the way, we also have a fireside chat session on green securitization. Mr. Ben McCarthy mentioned on the interest in green transactions. We have a session on that. And we would be having a session also on third-party enhancers. Mr. Chamria mentioned that actually in securitizations, the risk is almost entirely retained by the originator. We need to visualize the possibility of a third-party enhancer coming up and picking up at least the mezzanine piece of the risk. So these were very important points made by Mr. Chamria. Mr. Krishnan Sitaraman, over to you to get an overview of how the market has been over the last year and how do you see it going forward as sort of a broad overview.
Thank you very much, Mr. Kothari. Very good morning, everyone. First of all, I'd like to compliment Mr. Vinod Kothari, his organization, as well as the Indian Securitization Foundation for completing the 1 decade of organizing this particular forum. I think it's a well-awaited forum in the field of securitization, and they've also played a role in the evolution of the market in India. So many congratulations. And also thank you very much for having me on this event. It's actually great to be part of a physical event after probably 2 years, slowly getting into the physical form of holding seminars after several months of webinars and Zoom calls. So that's again a good place to be in. So coming to securitization, Indian securitization market has come a long way from the first transaction which happened in 1991. It's more than 3 decades now. That was a 16 crore pool originated by Citibank, car loan pool, which is rated by CRISIL. So that was the first ever transaction, and we've seen several transactions since then. Over time, the objectives, motivations for which securitizations have been done in India have also changed based on regulatory environment, market landscape, and so on. So typically, I see 5 different benefits or objectives for which one can do securitization. One is capital relief. So that's something which was done and quite in vogue in earlier days. Then, of course, securitization is an alternative funding source or a liquidity generating source, which Mr. Sanjay ji also referred to. It's also a tool to manage your profitability. If you churn your balance sheet, the ROA levels, ROE levels can be higher than going with an on-balance sheet funding business model. It's also a tool for exposure management. If you want to take more exposure to certain categories of borrowers, you have hit your limit, you can do securitization and take fresh exposures. The other advantages, I would say, from tenor matching or ALM management. When you do securitization, fixed tenor assets get replaced by cash. So the maturity profile of your assets comes down, so it's a good ALM management tool. So these are some of the advantages of securitizations, and depending on which spectrum of the time frame you are, one or the other was of motivation for the Indian market participants. So if we go back to say FY19, I would say FY19 and FY20 were the years where I would say securitization came of age in India. We had market volumes of around 1.9 lakh crores in both years. Those numbers were actually put up by Mark in his presentation. Those were numbers which were published by CRISIL. So those were the years where we saw numbers go up, volumes go up. However, FY21, at least the first half of the year, we hit a pause button due to COVID and hardly had any volumes in the first half. There was some pickup in the second half, so we closed at around 90,000 crores in FY21. FY22 again, initial part of the year, the second wave of the pandemic was there. It was fairly widespread and volumes came down. But again, there was a good rebound or recovery in the second half of the year, and we closed the year at around 1.3 lakh crores, which is roughly 50% higher than the volumes in the previous year. We are hoping that this fiscal would be better than last fiscal, assuming there are no further waves of the COVID and collection trends continue. So that's broadly on the volumes. If you look at the Indian market structure, as Sanjay ji was also mentioning, the last 7 years or so, it's more an assignment or a direct assignment dominated market. Roughly give or take 60% of the volumes year on year have been through direct assignments, whereas 40% roughly are through PTCs or conventional securitizations. Now, why are assignments volumes higher? Typically, these are done by public sector banks. That helps them show a higher credit growth. And also, they have some discomfort on PTCs in terms of mark-to-market losses. So if you take it as a PTC, it's on your investment book, there could be mark-to-market losses in a rising interest rate scenario. So we have seen assignments showing higher numbers than your PTCs. In terms of the asset classes that we have seen, typically the most popular asset classes in India have been mortgage-backed securitizations and vehicle loan securitization. That has been followed by microfinance loans. We are seeing volumes there as well. And in the last, say, 3 years or so, gold loan securitization has also picked up. So if I look at these 4 asset classes, together around 90% of the overall volumes are contributed by these 4 asset classes. Then, of late, we are also seeing interest coming up in other asset classes like SME loans, they are getting securitized, personal loans, education loans, equipment loans, lease receivables, trade receivables, and so on. So these are some of the up-and-coming asset classes. Hopefully, going forward, we'll see more volumes in them. Next, let me come to a kind of a year or a point on time, which is, I would say, an inflection point for the fortunes of NBFCs in India, which is the ILFS default of September 2018. Before that period, for a period of say 5 to 6 years, the going was quite good for NBFCs from the liability side. They were able to access both debt funding and equity funding fairly smoothly. It resulted in a CAGR or a growth of around 20% per annum on their asset side for the NBFCs. Now, the ILFS default was, as I said, a kind of an inflection point. Immediately, it was unfortunate, but immediately it resulted in lenders and investors having a high degree of caution and conservatism about taking exposure to NBFC, at least a number of the NBFCs. So fundraising became challenging for many NBFCs, especially the smaller and mid-sized NBFCs post that. Now, that is when actually the appeal of securitization actually grew for, at least for those entities and some of the larger ones as well. Because what we have seen in the past is the performance of securitization transaction, as Sanjay ji pointed out, has been very good. We've hardly seen any defaults due to credit reasons. There have been a couple of defaults due to non-credit reasons, but the performance, the collections have been fairly good. So lenders and investors were more comfortable, were more confident in taking exposure to NBFCs through securitizations rather than direct lending. So then securitization volumes picked up. That's why if you go back to my earlier statements that FY 19 and 20 post ILFS, they saw higher volumes. That's something which we have seen. In terms of, I would say, the innovations in the Indian market, if I may touch upon that, I would kind of classify them into 2 buckets. One is macro innovations, which are more structural in nature, impact the entire sector. And then there are some micro innovations, more transaction specific. So coming to the macro ones first, what we are seeing of late is TIUP structures taking center stage, that is timely interest and ultimate principal payment. they are more or less taking over from TITP structures, that is timely interest and timely principal, which were in vogue earlier. Now the TIUP structures actually give more flexibility to the originators and also factor in recoveries from overdue or delinquent accounts through the transaction tenor. So if there is a default but recoveries happen before the transaction tenor ends, that still kind of helps to bring down the credit collateral requirements which a credit rating agency would specify. So TIUP structures we are seeing increasing. What we are also seeing of late is some traction in replenishing securitizations. So these are securitizations where very short-term receivables like trade receivables can be securitized, which can back Hello. Yeah. So what I was saying is about replenishing securitizations, where relatively shorter term receivables, trade receivables, 1 month, 2 month receivables, can be used to back relatively longer term PTCs, which can have investor interest. So these are a couple of innovations we have seen. What we are also looking at, hoping that based on our discussions with a number of originators, some of the following could also pick up. One is a single loan securitization. Prior to 2012, we saw a number of single loan securitizations, but I think that was not looked at very favorably by the regulator at that point of time. But the September 21 guidelines which have come out, regulatory guidelines, that actually permit single loan securitization. So there are some discussions we are having with some of the originators. So maybe that can pick up in the days ahead. We are also having discussions around utility receivable securitization of that, infrastructure receivables, as well as securitizations of loans which are backed by ECLGS guarantee. So the loans under the ECLGS scheme, post-COVID, that scheme was bought out by the government. So that has an element of guarantee built in. So we may possibly see some securitization in these sectors in the days to come. Now coming to some of the micro innovations that we have seen. We actually saw in one transaction recently, not seen in the past, 7 different tranches. So A1 and A2 tranches, but within A1 there were 6 sub-tranches where the interest level was pretty much ensured, timely interest, but principal was time tranched. So each tranche had a different time period where principal was paid out, and that could attract investors with a different time horizons. And in that, the prepayment absorptions were reverse tranched. So that was something which looked different. Of course, on the A2 sides, residual yield was payable and ultimate principal. Another transaction which kind of looked good to me or innovative in nature were delinquency trigger based principal acceleration. So in these transactions, if the overdues in the underlying contracts or pool hit a particular threshold level, then the principal payment would be accelerated or there would be turbo amortization. So that was one. And another one was a structure where I saw combination of TI-TP and TI-UP both. So for a default recognition, it was TI-UP, timely interest ultimate principal. But for credit collateral utilization, it was TI-TP. So that was a combination of both structures. So that's a particular innovation we saw. So we are seeing some action. There was some pause due to COVID, but we have seen pick up. Typically volumes happen towards the end of each quarter. So this is a period where we are seeing some pickup in activity. But going forward, based on the discussions that we are having with a number of NBFCs and HFCs, we see a broad structural shift in business model for many of them. Instead of asset-led or balance sheet-led growth, they are looking at off-balance sheet growth in terms of the AUM-led growth, wherein they would be entering into partnerships with banks or larger NBFCs to look at securitization as well as co-lending as a business model to kind of pursue growth, wherein they will be able to manage their client relationships of origination. See, NBFCs have a lot of inherent strength. Client relationships, adaptability, local knowledge, innovativeness, responsiveness, flexibility to last mile connect and reach. So where they face challenges is on the liability side, raising resources, funding, where banks are very strong. So a partnership between NBFCs and banks will be a win-win. You marry the strengths of both entities. So I think we should see more of that going forward. A number of partnerships, at least on the co-lending side, have been signed. Direct assignments also we see happening. So between both of these, we see partnerships between banks and NBFCs building in the days to come. And that would mean that NBFCs will see more of AUM-led growth rather than balance sheet growth. And with the collection efficiencies picking up, business activity picking up post-COVID, we are cautiously optimistic that even the securitization market should pick up. And NBFCs as a whole, probably the worst is behind them, and they will come back to the growth trajectory soon. I think those were some of the key points I thought I'll highlight.
Excellent.
Over to you, Vinod.
Thanks very much. In terms of time available for us, I'm left with 49 seconds now. Do any of the participants have any questions to any of our panelists? Okay. Do the panelists have any last few seconds of comments to make, or maybe comments from any of our virtual panelists, Mr. Mark Adelson, Mr. Ben McCarthy, and Prashant Dwivedi? Any last comments to make? Okay. If not, then it's my profound privilege to offer a vote of thanks to all 5 of you. Mr. Mark Adelson, like last year, you've been a great help this year too, providing a global perspective. Mr. Ben McCarthy, once again, thanks to you for providing us Asia Pacific, particularly in the asset classes. And Prashantji, thanks for combining the perspectives of Asia Pacific with those of India. Sanjayji, thanks very much for being here. And Krishnan Siddhaman, thank you very much for providing us the Indian perspective. Thanks to everyone, and look forward to a day full of deliberations. Kanak, over to you.
We are really thankful to our panelists for this interesting session. Now, before we move on for a short tea break, I would want to introduce our very recent publication on securitization and transfer of loan exposures. I would want to invite our lead contributor, Mr. Abhirup Ghosh, to talk a few words about the book. Over to you.
Good morning, everyone. So first of all, thanks. I would like to thank people on the dais and also the participants in the floor for coming to this summit. As you see, we are celebrating our 10th edition. So we thought that we should have something special for this event. So luckily, in November 2021, the RBI came out with 2 new sets of directions for securitizations and transfer of loan exposures. So the idea of writing a book came around that time. And when we started, creating the broad contours of the book, we thought that, okay, just commentary on the book won't, do justice to the entire topic. So we made some changes and, to make it a comprehensive guide on securitization in India. We brought in the structural aspects and the legal aspects, the accounting and taxation aspects as well. And on the regulations, we did a clause-by-clause commentary, along with comparisons with global jurisdictions, what the practice is elsewhere in the world, and along with that, we have also tried to take a 360-degree approach while drafting the commentaries, and create questions. Think of questions one can have on each of these clauses, and created some sort of FAQs on each of the clauses. So this is a 650-page book, and we are formally launching it today, and some of the copies are also available for sale today. So if you like to grab a copy for yourself, then please do go and contact the registration desk. So thank you so much.
Abhirup, congratulations for the book.
Thank you so much, everyone.
Thanks,
now,
everyone. Thank you.
Yeah, and now I think we can move on a break for 15 minutes or so.
Thanks, everyone. Thank you
so
very much. Thanks.
CFO, Lending Cart. Mr. Irfan Sheikh Mohammed, Chief Business Officer, Cred Avenue. Mr. Shachindra Nath, Executive Chairman and MD, Ugro Capital. Mr. Pankaj Malik, CFO and Head of Strategy Execution at Fullerton India Credit Company Limited. Mr. Kishore Lodha, CFO, Hinduja Leyland Finance. And Mr. Nihaz Bashir, Partner at Wadhya Gandhi and Company. I would now hand over the stage to Mr. Gada to proceed from here.
Hello. Good morning to everyone. So, firstly, thank you, Mr. Vinod Kothari, for having us here. And it's a pleasure to have this distinguished panel as co-panelists over here. Securitization always has been a very interesting market, full of ups and downs since its start. There have been times when, people have tended to write off this, that it's something which basically it's doomed. Various market scenarios that have happened right from the 2006 guidelines to the 2008 crisis, the tax issues that we faced. But there have also been times, there have been very innovative ways in which, the Indian market has always used this opportunity to meet the various objectives that they intend to meet, both from a seller side and a buyer side. So let me start this conversation by my first question to Mr. Lodha, Mr. Kishore Lodha from Hinduja Leyland. Mr. Lodha, could you share a little bit of a perspective from an NBFC perspective, NBFC side, that how the market perceives, how you would want the market to look differently at NBFCs, if at all, and how securitization and NBFCs go hand in hand. Yeah.
Thank you, Devang. So I will start with a very cautious note that what has been the market talk and what has been told to me and what I have been made to believe, I certainly disagree with that. So, yeah. So generally, if you look at general perception, whether you talk to a regulator or an investor, they would say that NBFC, there are governance issues. They are not comfortable with NBFCs. And recent, all the announcement, if you see, the direction is that NBFC should reduce their exposure on their balance sheet, whether it is securitization guideline or the NBFCs which are too large should convert to banks. So there was a discussion paper which I also participate, that NBFCs whose balance sheets are more than 50,000 crore, they should migrate towards a bank. Then this co-lending guideline came in, securitization guideline came in, co-origination guideline came in. All this indicates that regulator wants that NBFC balance should not be grow beyond certain limits. And the perception is that NBFCs, there are governance issues, there are management issues with NBFCs. But I certainly humbly disagree with this perception. If you look at the whole credit market of the India, a total credit market is about roughly around 160 lakh crore, out of which NBFC market is roughly around 30 lakh crore. So 30 lakh crore of funnel is being managed by NBFCs, and this has been the trend since inception. So overall credit market, initially NBFC contribution by 8%, then it moved to 10%, now it is close to 15 to 20%. If you look at if you analyze this 30 lakh crore by sector and sector, you will find that whatever is the credit market of India, and if you dissect it between sector, you take it any sector, whether it is manufacturing, textile, real estate, and put NBFC along with them, you will find that NBFC is far, far better compared to any other sector which borrows. So we borrow roughly around 30 lakh crore from market, where we lend to 30 lakh crore. But if you compare with any other segment of borrower, we are far, far better. Our borrowing today is 30 lakh crore. And if you look at our default rates, if I remember earliest large default was CRB, which happened in 1998, where roughly around 8,000 crore went down. Then recently 2-3 NBFCs have gone down. During the Andhra crisis, few MFIs went down. Put together, the total loss in the system would be less than 1 lakh crore in 30 years, 40 years horizon. Whereas overall credit we are managing is around 20% of the credit market. So even if you provide standard provision on the asset, still NBFC perform far, far better compared to any other sector. You compare it with any sector, NBFC is far better. So the perception that NBFCs are bad boys, governance issues are there, all said and done, fine. But if you look at data, if you do a deep dive in, then you will find that NBFCs are far, far better compared to any other sector. So from this note, I would like to see that most of us who represent NBFC or interact with NBFC should start looking at NBFC from this perspective as well. And when the regulators, the lenders talk to about NBFC, we should give this perspective as well. So this is my view on NBFC as a whole. Of course, there has been cases of defaults and delinquencies, which is with any other sector, whether you take as manufacturing, textile, real estate, gem and jewelry, which are the large borrowers. So every sector has a trend of default. But NBFC would do far, far better compared to any other segment of the borrower. So this is my view on NBFCs and perception about it. But perception is what it is. So as we have seen that recent announcement, recent amendments which happened on securitization, of course securitization helps in terms of overall liquidity, in terms of ALM management, in terms of balance sheet management. So many in pre-COVID, the total market size was close to around 1.75 lakh crore. And my personal perception is that as the time grows, as the regulator will feel that the balance sheet should be smaller, this market will keep growing and new structures will evolve. So this market is here to stay, and as time progress, we will see this market growing leaps and bounds.
Thanks, Kishore. So we've seen the securitization guidelines in September, wherein things have come up in terms of co-lending. So my next question will be to Mr. Sachindranath, that how do you see co-lending versus the securitization and the direct assignment transactions? How do you see the market shaping up?
Thank you. So I think so. Co-lending is nothing but a form of securitization. If you look at what has happened post ILFS, post DHFL and few others, one of the regulatory and policy intent have been that NBFC should be used as an intermediation rather than as a balance sheet activity. And I also generally believe that the market is gravitating, and it should, wherein on one side of the spectrum are people who own the liability, who have the capacity or who is attracting the liability side, and NBFC as a universe has the prowess on the asset side. And for the first time, you have a regulatory framework wherein asset side engine and liability side engine is collaborating. And that's why, if you look at the guideline on co-lending, there is an option 1 and there is an option 2, it is nothing but a direct assignment, wherein basically you originate a loan, you hold it for a very short period of time, and then you sell it down. The core difference being that, in case of a direct assignment transaction, it has to be held on the balance sheet for 6 months. In a co-lending, it can be held only for 1 day. But predominantly, I think so most of the NBFC industry, except probably top 10, where the capital flows not because of the underlying asset engine or what kind of portfolio quality is being generated, but it is largely because of the parentage and the rating. Large universe of NBFCs which are independent, which have the last mile reach, have to gravitate or graduate to not thinking liability on balance sheet, but liability off balance sheet. So I hope that over a period of next three years or so, this artificial bifurcation between a direct assignment transaction and securitization and co-lending would all combine, though the regulators have actually made it very sharply distinct. But end of the day, if there is a lender who is relying on a servicer and its credit, its origination, its credit and its collection technology, data analytics, it should be allowed to originate, provide some comfort and be downsell the loan to a large bank. And that is the way the Western market have been. If you look at most of, because we don't have hedge funds in India, but if you look at US market and European market, hedge funds provide that liquidity. Most of the large marketplaces actually originate the asset, warehouse it, and then sell it down, and it finally in a pool vehicle goes to large liquidity provider. I am generally of the belief that most of the lending industry in NBFC feel that co-lending is difficult to execute, it would take too much of time. Contrast it to the securitization market. The first securitization transaction in India happened in 1992, and it has taken almost 3 decades to mature where it is today. But actually, I have predicted that this year 50,000 crore of co-lending would happen in India, and that's a very sizable number.
Thanks. Yes, Sudhi, please.
Hi. I think fully resonating what Sachin sir just said, I would like to add a few more aspects, to ensure that people here, who are either the originators or are the investors, are able to clearly see how the differences between the PTC, DA and a co-lending, or in short, an off-book borrowing or a lending arrangement is shrinking. So essentially, let me give you a very practical example. So for instance, most of you who are in the business of borrowing, right, for your company, you have to, so on one side, your company is originating these assets, right, month on month. On the other side, you need some funding avenues to ensure that you are able to continuously garner adequate funds, either through a direct borrowing or through selling off the pools that you already have. Now let me give you a very practical example. So for instance, we originate, say, a X number month on month, right? And after some seasoning of 6 months, 8 months, 9 months, on an average, by the time you have done the securitization, it has already, I think 40% of the asset life has already crossed, considering the prepayments, etc. So now, there are banks who want us to give a revolving limit of say 100 crores, say either month on month or every 2 months, right? And when you ask them that instead of giving me a securitization limit, which is say 200, 250 crores every quarter, why don't I start originating these assets on your balance sheet? And that is where you see how the thoughts are fixated, that this is the product we do, this is the product we do not do. And there are separate policies and guidelines. However, having said that, over the last several months, in fact, with an accelerated pace, the entire differentiation between the two is shrinking. Because on the PTC side, you need to do the entire due diligence, you need to do the credit limit, you need to issue a sanction, then you do the DD, you see the seasoning, MRR, you look for if it is a BBB rated entity, you will look for a credit enhancement or an enhancer, right? On the other side, you can achieve almost the similar outcome by entering into an arrangement whereby instead of looking at the pool of assets which is being bought or sold, you can actually look at the static pool of the company. What is the performance coming in the last 9 to 12 months of origination? And that is, you can create almost a PTC-like structure with a credit enhancement through the co-lending model. When it comes to a PSU, right, there it is very difficult to provide a credit enhancement because at the pace at which you will do the origination, they may not be able to do the credit sanction, and therefore they prefer to go with the co-lending model 2, which is a DA route. And there the credit enhancement is very difficult. But on the other side, if you look at the market in general as such, there are people who will buy your pools, right, where you don't need to necessarily restrict to the, limited credit enhancement, or you don't need to necessarily, look for alternate avenues to provide that credit comfort. So this is where I think you need to carefully think about how you can use the existing opportunities available to the best of your entity's advantage, right? So I think this is a very deep and I think broad topic, and it is very evolving situation as we speak. So anyone wants to maybe understand more, I'm happy to be available offline.
Thanks, Sudeep. So talking about the direct assignment and the PTC routes, we have Pankaj. If you can share your views that from a capital perspective, how do you look at these transactions? How do you compare the two?
Yeah, thanks, Ivank. See, I'm the big supporter of both the, first of all, the vehicles available, be it the direct assignment or the securitization. I'm a big supporter. Because both serve different need. One common need is that this is also the funding available, but definitely one can choose between them based on what stage of the business they are in and what exactly they need other than the funding. Direct assignment, to my mind, is an excellent ROE kicker. It helps us releasing the blocked capital, and one can leverage capital much better through the direct assignment than the PTC. Thanks to the regulatory guidance which came sometime in March 20, if I'm not wrong, and September 21, that has removed the bottlenecks of the PTC earlier, because PTC earlier used to be a capital drag. Now it's no more the case. At best, it could be equivalent to the capital what is required had you not done the PTC or had you not done the securitization. So commenting on the capital perspective, DA 100 marks, PTC maybe not that much, but definitely it is still better than holding the asset in the books of account. Because it gives you both the advantage. One, why will I keep the asset in the books? Maybe I have some different considerations. I want to show better GNPA, because when I'm selling my assets, good assets to an investor, in the DA, I take those assets off from my book. Some of my ratios look little bad, maybe GNPA may not look so good. However, in the PTC, I'm getting three objectives. One, I'm getting a comparatively better rate funding. I'm getting the perfect, if I'm selling a residential mortgage, I'm getting the completely matched funding. The asset and liabilities are completely matched. Who will give 20-year funding? Definitely not. But in the PTC, I'm getting 20-year funding against a 20-year asset. So perfect ALM match. Now with the regulatory guidance, revised guidance, I'm getting some capital benefit as well, because in the PTC structure, I need not to keep now capital for the asset which I'm selling. I just need to keep capital for the credit enhancement, and that too in a specific percentage between the, in the tier 1 and tier 2. So these are the, among my thoughts on the capital implication of the DA and securitization, but both are excellent tools, big supporter for that.
So if you can also add the comparison versus co-lending, is that something which you look at as an organization? And how do you compare that with the typical direct assignments to PTC?
See, co-lending, I would request Sudeep will cover better, I believe, and they are very aggressive, he was telling me just before the meeting. Since you spoke about direct assignment once again, so direct assignment, and the PTC, I just want to bring one point on the table. After the ILFS crisis, many of the lower rated NBFCs were not able to get the funding, and that was existential challenge. And PTC came really very handy at that point of time. Why? Because PTC allows you to give credit enhancement and take the funding. So I know many of the companies who were really struggling, and PTC came very handy to them as a liquidity tool. In addition, now as a capital optimizing tool as well. Sudeep, can I request you to cover the co-lending?
Yeah, sure. Yeah, sure. So essentially, if you look at the capital adequacy calculations, the minimum regulatory capital is 15% for all the NBFCs. If you look at any NBFC will have usually, based on their covenants and the overall ongoing business enhancements, they will carry anywhere between 18%, 22%. If it is a fintech, it will also have maybe a 28, 29%, who knows, right? And therefore, if you do a PTC transaction, if your capital is anywhere more than 15%, as per the regulatory guidelines, the credit enhancement is capped by the regulator itself to 15% of capital reduction. And therefore, if you have a capital which is more than 15%, which is naturally going to be the case, your capital ratio will increase disproportionately higher than the PTC proportion that you have done. So for instance, just to elaborate, if you have done 20% of your portfolio under securitization, your increase in capital or the saving in capital will be far more than 20% because the credit enhancement is being capped at 15%. Whereas in terms of co-lending, you can maybe do credit enhancement structures of say 20%, 30%. In that, if you have given a higher credit enhancement, you may not have capital saving disproportionately high. So this is the edge, and this is slightly complicated, but I think just go back to the textbooks and see the PTC capital reduction capping of 15%, which is actually creating the edge to enhance your capital adequacy disproportionately high.
Thanks, Sudeep. So, Pankaj spoke about how the PTC route came in handy for originators who were not at a very high rating. Irfan, if I can have your views on how you look at the situation in the market and the demand that you get, both from a PTC and also if from a DA route also, if you want to add.
Sure. Thanks, Devang. I was just trying to, listen to the views of other panelists and then, all valid. And I have the following perspective, wanted to bring in the context of regulation, starting, in fact, it all started before September 24, wherein RBI came up with SMA guidelines. There is, of course, securitization guidelines, then subsequently daily NPA, there is a deadline that is coming up also in terms of harmonization. And then all these guidelines, including the co-lending guidelines, are indicating one, right? There is a harmonization between NBFC and banks, and then being able to bridge from the perspective of control and visibility of each and every account that is part of, say, direct assignment or co-lending. The bank, which is, be an assignee or the co-lending, any 80% co-lending partner, is required to have a visibility on each and every account on a daily basis, right? Before September 24th, the situation was a bit different. Especially in case of direct assignment, it was a monthly frequency wherein the data was coming in, and largely, the general practice was it was a consolidated basis, engagement. Right? I'm not talking about PTC yet. So if you look at these guidelines, SMA IRAC norms, then subsequently co-lending, then subsequently September 24 securitization, and subsequently daily NPA counters, etc., etc. So all these are alluding to one, all these are coming up to say everything is getting, we need to have a harmonized structure here and the data flow that needs to come in. So what does it mean? We've been talking about regulation, accounting, capital adequacy, so on and so forth, investor supply and demand of capital, and so on and so forth. There is one important piece that we also need to talk about, which is a technology piece here, right? For us to be able to talk about, the requirements that the RBI is, asking us to, comply to. We need a seamless data flow from one, system to other system. Else, how is this possible to have a, we do millions of, accounts which are part of the direct assignment or co-lending or PTC as well, right? How is that data flow on a daily basis coming in? And where is this leading to? With this kind of info flow, which is transparent and on a daily basis and probably real time also, it is, we are getting into a zone which is far more transparent. Both counterparties have equal control and, good control of, and visibility of each and every account. And hence, our ability to subsequently credit control, risk monitor, and subsequently, we may, see that exit in terms of direct assignment guidelines, wherein reassignment is now allowed in the new guidelines as well. So basically, an assignee can also offload that exposure depending on the market situation. So where is these guidelines pushing us? These guidelines are pushing us to a place wherein there is transparent and far more fundamental foundational piece, that infrastructure that is being driven, and then this is allowing for more exposure to be taken. Now let me add the perspective of PTC also. Sir did mention about hedge funds. That's a brilliant point that he made. Today we are all talking about banks and NBFC. Now, and then if you look at the securitization market, top 15 and probably if you include 20, 90% of the securitization market is done. But then there are, a really long tail, where is the market for single A, where is the market for triple B, right? We need to provide that, and then hedge funds that he talked about, in fact, is the liquidity provider, outside India for all these issuers. They could be probably, NBFCs or non-NBFCs also who are originating. But these are the ones, hedge funds are the ones who are providing liquidity to, these originators who are in a probably A or triple B category also. That's where we need to increase the PTC piece. What Sudeep talked about in terms of rated transactions, which could be credit enhanced to the comfort of the investor. It could be hedge investor, it could be non-bank, bank other than banks. Those investors coming in will increase the pie for the PTCs. That's one piece. So I think the reason why I was talking about technology as a piece which will get us to the zone wherein there is far more light on the underlying contracts, performance of the underlying contracts on a daily basis. All this is possible if we are getting into the technology-led, there is a significant place that technology can have here for us to be able to move into direction. And then not just about working or making the program of DA or PTC market or co-lending market, but it is also increasing the pie overall. And I believe, and we believe at CredAvenue that DA, PTC as well as co-lending as three options are here to stay. And then it is this ecosystem's responsibility to increase the pie of each, of these programs. That's how, and then, I think Pankaj also was making a point wherein it is at the end of the day, what is the motivation of the issuer or the investor, assignee, assigner, or both co-lenders to see what works in that situation. Then there could be an NBFC which needs capital and hence needs a DA or co-lending for that matter. For profitability is another point in case of DA, which there is an upfront profit, which is the most important motivation for a few of the assignors, right? So then, of course, there is a co-lending which is a continuous, and it's not a bulk supply of capital. In a DA, there is a 100 crore transaction done, there is a flow of 100 crore on a single day. Versus co-lending is a continuous capital that comes, and there is a commitment on both sides to have this access to capital through the program. And of course, there is a definite marriage of strengths. One is an originator, could be good at servicing, and subsequently there is definitely an efficient capital provider, be it a PSU bank or a bank or anyone else. Today, co-lending guidelines do restrict it to only banks. We don't have non-banks or capital markets coming in there definitely. So for capital markets, there is only one PTC route that comes in. DA and co-lending is more like a bilateral transaction. But coming back to the original point I was trying to make, that irrespective of all these three, be it co-lending or DA or PTC, we need to, get into more technology-driven, transparent ecosystem. So,
Sure. Thanks, Ilfa. So multiple points that were touched upon over here. But if I'll pose a question to Nihas later on regulations, but first, picking from this, that traditionally we've seen banks and NBFCs as the major originators and investors. So, given that you are one of the prominent law firms, legal counsels for this, how do you see the parties which are there, both as investors and originators? And the recent regulations and how it impacts the non-financial space also to come in. So, just in terms of the various class of parties which are there on both the sides.
Thank you, Devang. So I think on the securitization front, historically, apart from banks and NBFCs, you've seen mutual funds, you've seen insurance companies as investors. And from the origination side, we've in fact, you see big corporates who have trade receivables, etc., who have done securitization in the past. So anyone with, we've seen receivables under M&A transactions being securitized. Back in the day, there were toll receivables being securitized. So I think from a participation perspective, securitization as a tool goes far beyond banks and NBFCs for sure. Now, what the regulations have done is kill the banks and NBFCs' participation in the non-regulated space. So essentially, I think what the September 2021 regulations have done is, if a bank or an NBFC is participating in a securitization originated by a non-regulated entity, you end up having to provide capital equivalent to 100% of your participation, and you may be subject to further scrutiny, which is just a threat put down there. We don't know what that will entail. Now, I think in connection with just to take off on this whole co-lending thing, and I think as Irfan rightly mentioned, co-lending at the end of the day limits your participation. Further, co-lending as a tool has been brought in to address a priority sector lending requirement. And if we keep focusing on the priority sector lending requirement, I think the market itself will get stuck in that rut where we are doing securitization only to meet priority sector lending requirements. And securitization as an active investment option or an active fundraising tool kind of gets limited to that priority sector thing. And I think, therefore, securitization, and also I think one of the points Pankaj mentioned, that whole capital benefit between DA, securitization, etc., all of that. I think it's it's a function of what parties want, and at the end of the day, securitization gives you the flexibility to further kind of liquidate your position at any point of time without additional documentation and additional kind of effort. So planning from that perspective. And two, obviously, if you're having a higher capital requirement, it means you provided a higher exposure, which means probably you're getting a better rate also at that point. So it's a function of what parties want. Sorry, Devang, does it address what you were asking?
Yeah, it does. Thanks. So, Niyas, if you can also, touch upon, from a regulations perspective, what are the key issues that, the September guidelines touch in, and what are your observations in terms of what was expected and didn't get covered?
So as I've said this multiple times, I think the regulations were more positive than negative, because it's actually clarified a lot of points. But if you had to nitpick and pick out a couple of issues, one is the requirement that securitization, unless it's a single loan securitization, has to have two tranches. The consequence of that is even people who want to kind of not have additional capital burden, so like in Pankaj's case, if he wanted to do a DA in a securitization format, he can't do it anymore because you still need two kind of securitization tranches. So the moment you create a junior tranche and a senior tranche, that becomes treated as good as credit support that you're giving. And your MRR requirement, you have to participate for sure. Now, if that requirement of two tranches were not there, I could have had a single tranche, which is just senior, no credit support, nothing, and I could have participated in that. I would not have had a capital hit. So it would almost been similar like a DA transaction for me. I could have done that. So that is something that a lot of NBFCs who historically have been avoiding the securitization market continue to avoid for that same very reason. And I honestly don't know if there's an answer to that. The other thing already we touched upon, the fact that a bank or an NBFC cannot participate in a securitization which is originated by a non-regulated entity makes no sense. I can factor their receivables. I can I can give them a loan against those receivables, but for some reason I cannot invest in a PTC.
Does it mean that the transactions, sorry, yes, I'll continue further on that. So does it mean that the transactions are completely stopped from a non-financial? Because mutual funds will still be there, right?
So not at all. So in fact, we have transactions which are happening where corporate originators are securitizing their trade receivables and the investors are the non-regulated entities. So either mutual fund or, even sometimes another corporate for that matter. This is happening under the SEBI securitization framework, which does not have most of the conditionalities that the RBI securitization framework has. And the SEBI securitization framework applies irrespective of whether you're a regulated entity or not. So therefore, people are able to take the benefit of that. You have the tax clarity which you have for RBI securitization, even for SEBI securitization. So people are able to take the benefit of that. Not as many as we would like to see, but still, you have every quarter 1 or 2 transactions which are definitely happening there.
Kishore, coming back to you, so if you can also highlight from the regulations point of view, how, your perspective as an originator, on the current practices that are being followed.
So from a perspective of an originator, things have been evolving fast. Securitization is going on for past 30 years and we have seen many changes coming in. Recently, after September 21 circular, some of the obligation has come on both the originator as well as the investor. As of now, what I see is that obligation on the investors have increased significantly compared to what it has come on the originator. But ultimately, whether the obligation comes on the investor or the originator, ultimately the original is responsible for compliance of the obligation of the investors. Otherwise, investor would not turn up to you. So where a lot of changes have happened, some of them were favorable to also for the investor from the originator perspective, like MMR has been reduced for loans which are less than 5 years from 6 months to 3 months, even without any MRR also you can do the transaction. So some of these were positives, but the obligations which are more in procedural nature, like 30% of the KYC has to be done by the investor themselves, has put in more thrust on the compliance part of it rather and management part of it. So now a lot of tools are available where CKYC or URC etc. can be verified through digitization as well, and a lot of platforms are evolving where they are helping the investors to do those compliances. So that way the compliances have increased significantly, but it has not, I have never come across a situation where a transaction has failed through because of these regulations. So transaction volumes are not like getting hampered because of this thing. Only thing, some back-end work is required to be done, which is happening. Some of the platforms which has come in, they are helping the banks in terms of CKYC requirement, URC requirement, etc. But where the banks are which are the largest investor in this segment, feeling a pinch is the loan-wise account opening. Now, imagine they were doing the investment in a PTC or a direct assignment in a small pool of even microfinance also. Now imagine if they have to open accounts, individually accounts in their system for all the microfinance ultimate borrowers in their system, which is creating a lot of issues in terms of compliances at the end of investor, which are largely banks in this segment. There they are working on their IT systems, they are taking help of external people also, but it is work in progress, and that way some amount of fear is there among both the investors and originator that today the regulator may, tomorrow the regulator may come in and they hurt. So there little bit of caution is there. Otherwise the volumes are, because of whatever recent amendments happened, that has not impacted the volumes per se.
Sure. Thanks, Kishore. Yes, please, Pankaj.
Yeah, there are a couple of more comments which comes in my mind when I was listening to Nihas and Kishore. One, that as we all know, in the direct assignment, we need to upfront the profit or upfront the income for the lifetime, which to my mind is not right. I maybe have a contradictory view, but yeah, in the pre-Ind AS era, it was not allowed. It was required to be amortized. However, the regulators, I have pitched personally to the regulators and the other bodies, and but the fact is that today it has to be upfronted. It brings kind of volatility in the earnings. To my mind, today avoidable. But yeah, regulators have recently changed the capital implications of this. They have said that if it is a realized profit, that only you can consider towards the capital adequacy. Otherwise, you will report higher profit. Unrealized profit, you will not be treating as a capital for the purpose of the capital adequacy. One side they are plugged, but definitely PTC is a different ball game where it's is not, you're not getting the the hikes and drops in the profitability due to the assignment or the securitization. Other point which I wanted to just emphasize is that the NBFCs largely cater the unserved or underserved, and they are the originator in a big way of the PSL assets, which is to my mind a gold mine, right? Why they don't need the PSL asset. Banks definitely need the PSL to meet the regulatory requirement. And that brings a good opportunity for the NBFC to monetize the PSL assets by selling under DA or the PTC. I see it as a big opportunity, and many of the NBFCs are doing it, and that gives not only a lower funding, but also the other benefit what we spoke about it. So PSL is another key thing which people can encash or monetize PSL asset what the companies NBFCs are originating.
Thank you. Sachindra, can you add your views on, from a regulatory perspective, what are the things that you would wish to see, what kind of changes you would wish to see to be able to better access the markets?
Yeah, Devang, as I said that India is the only market wherein you have this artificial bifurcation of two forms of securitization. One is called direct assignment, other is called securitization. It doesn't exist anywhere else in the world. And I think so the reason why it has happened, generally, and no offense to any banker here, generally RBI believes that banks are what they use, sometimes they use term called lazy banking. So sometimes they feel that bank, we give them any form of credit enhancement, they become lazy and they don't do the job which they are supposed to do. That's not true actually, but that's the way, I think so that's where this whole bifurcation of regulations have come. Second, it also came from the fact when the intention of direct assignment was that the banks or the buyer of the asset are actually looking at the end borrower, doing diligence on them and taking loan asset in the balance sheet. But the way the pre-DHFL era was being done is on a pool basis, right? So which means that while the underlying borrower was not paying, the originator was paying from his own balance sheet, and finally the entity became insolvent, there was nobody to provide for that. And from there, all of this problem of that you have to book on every account basis, you have to, not on pool basis, technology, all of that kind of a challenge. But I think so it is the job of the industry to go and explain to regulator that when there is an originator who originates a loan, underwrites it, and then downsell to a bank, there is any buyer, whether it's a bank or a mutual fund, their ability on a per account basis to actually estimate the credit loss and then take on a pari passu basis is extremely, extremely difficult. And that's why this market doesn't explode. So I see no reason that the difference, if you go to any bank and say, I want to do a PTC transaction, while the rating would be done, credit enhancement would be done, but most of the bank would also do the same job what they do in direct assignment. So we are artificially creating this bifurcation. Please allow credit enhancement across the board for co-lending, for direct assignment, for PTC, because all asset owners, banks, large institutions, want to buy and increase their asset book. No, they don't want to increase their investment book. And that's why the hunger and desire is to buy the asset book. Most of the NBFCs are originator of asset, but because of this artificial bifurcation of selling asset only on pari passu basis, we are constraining the market big time. So time has come for all of us to go and explain that let bank which is providing a differential pricing, it is just not for originating the asset. It is also for holding the credit cost within the banking system. Please allow credit enhancement on co-lending direct assignment as well.
Thanks, Sachindra. Sudeep, you've been really smiling, so I think you want to add something on this?
No, I think this is really, really good point. And I think this is one thing. While I understand the principle, basis which regulator is not allowing it, because it is possible that banks may start outsourcing the credit itself, right? So this is very much understandable that this is one thing that the regulators just do not want. However, if you apply it to the 100% without any reasonable, without considering reasonable aspects of what a third party originator and the servicer servicing, relationship means, then you are actually killing this entire proposition, which the regulator themselves are, trying to enhance in the market. So for example, let's take the example of, say, this DA. In DA, if the credit enhancement is not allowed, and now in the CLM2, there is again the same DA aspects are being aligned. What is happening is, if there is no credit enhancement or if there is a zero credit enhancement, the investors are also a bit worried about, regulator might ask, what have you checked, what have you not checked, whether your credit and due diligence was complete, right? And therefore, the entire CLM is, instead of taking, a 2-day turnaround time, it is taking a 2-month turnaround time. If you originate maybe a secured asset, right, in a co-lending arrangement whereby both parties agree that these are the credit parameters basis which you will originate an asset, they have now done it, they have disbursed it, they are waiting for the disbursement, and now the bank is just sitting because they have to do the valuation once again, they have to see through the exception process once again. So I think if there is a way to at least do a credit enhancement on a first loss basis, at least to maybe 10%, 15% basis, this can have a domino effect on the entire industry. And I can tell you this will have like a 100x impact, if regulators were to open to, for this particular recommendation. So thank you so much for touching it.
I just want to add, anyone who have eyes and ears to regulators, please go and tell them this. India's entire banking and its liability side is funded by retail savers, right? And central bank and all regulators are custodial of that money. When a bank is buying an asset from an NBFC, which is wholesale funded and capital is coming from private sources, when you allow that NBFC to provide a credit enhancement on a portfolio sale, ultimately the regulator is protecting the interest of that last mile saver who's putting money in the bank. So from that perspective also, regulator should allow that to happen, because you are protecting the interest of the bank, which means you are protecting the interest of every saver which is putting money into a bank.
Sudeep, coming back to you.
Want the floor to participate on this very interesting discussion? Do you want the floor to also chip in? I mean, credit enhancements on DA and credit enhancements on co-lending, do you want the floor to interact as well at this stage, or you would like to do it later? Devang.
Sorry, come again?
We have been having a very interesting discussion on credit enhancements in DA and credit enhancements in co-lending. Do you want the floor to participate here or later? Whatever you.
Yeah, absolutely. As in, so we were thinking of having a Q&A session at the end.
Not an issue.
But absolutely most welcome if anyone just raise your hands and we can have, happy to have a interactive session.
Want to speak? Can I?
Yes, please.
Okay. So if we talk about sale of, I think maybe the light is impinging the view. We want about a sale of a loan, and we say the seller credit enhances the sale. Then the buyer is taking exposure on what? On the seller or on the loan? Mr. Bhatia, you also talked about it, and Mr. Satyendrath also talked about it. If you talk about a sale of a loan, the loan has been sold, and still the seller gives his own comfort on repayment of the loan, then the buyer is essentially taking exposure on the seller, which is equivalent of giving a line of credit to the seller. So what is so wrong in line of credit then? If you're saying banks, the regulators are not permitting credit enhancement, the easiest way of credit enhancement by the seller is to take a loan on his balance sheet. So what is so wrong in taking a loan on the balance sheet? I hope my point is coming through. If you talk about a sale, and we still talk about the seller giving his comfort, we are equating a sale with a line of credit, with a borrowing.
No, not necessarily. I not necessarily agree with that. See, look at this way. A line of credit is an exposure on the balance sheet.
Which is how it is. Once you, the moment you give a credit exposure, it becomes exposure on the seller.
No. So let me explain this. So suppose I am selling a 100 crore portfolio to a bank, underlying 100 loans, right? And loans were originated at a say gross yield of 15% and bank is buying at a 10%. I am making a spread on that. Now what for I am making that spread? I am making that spread for my cost of origination. I am making that spread for my cost of servicing. Bank has to price that spread basis the expected loss which will come from that portfolio. But the estimation of that expected loss, to estimate it accurately and correctly, is very difficult exercise. It can be done more by the originator who has done this and that segment of the market for a long period of time. And that's why what Sudeep said, if you provide a first loss cover or if you provide some kind of credit enhancement, the ability of a bank to price the pool or price each loan enhances, and the liquidity which is available into the market does not remain constrained. Finally, the money would come back from the borrower itself. So think of a scenario of a large or a mid-sized NBFC which is doing a large wholesale corporate loan, right, of a balance sheet of 1,000 crore, 500 crore exposed to a large structured credit and 500 crore to a retail credit. It may so happen that NBFC may devolve because its structured credit portfolio has not performed well. Bank would not suffer versus the same 100 crore given to the NBFC, bank would suffer from that. In this case, the underlying cash flow would still come from the customer, but any form of first loss cover or credit enhancement would support its credit even more than what it is doing today.
So the idea is sounding very attractive. I mean, allowing credit enhancements on DA, allowing credit enhancements on direct assignments, but please do appreciate that ultimately in a straight balance sheet borrowing as well, we exactly have the same thing. I'm making the 5% margin, you referred to origination at 15%, cost of funding at 10%. If I lend at 15, borrow from a bank at 10, I'm making a net interest margin of 5%, which is for what? Which is for my expected losses. I'm the originator, I'm the one who understands expected losses, I'm the one who does a DD on the loan, and I make a 5% profit on that. So if in substance a so-called credit enhanced DA is effectively serving the same economic purpose as a borrowing from a bank, then the two would be equated from, we cannot think of a regulatory arbitrage and think of regulation treating the two differently, though substantively it serves the same purpose. Mr. Bhatia also made a very interesting point of co-lending, and also understand that co-lending essentially is what? Two lenders come together as partners. In a partnership, think of a normal business partnership. Does one partner provide credit enhancement to another partner? Does one partner say that if the business loses, I'll compensate you for the losses? The two are, hand in hand when it comes to profits and losses. So co-lending essentially is no different from a partnership in a loan. If one partner says, I will protect you should you suffer losses, then that's an additionality. That is over and above the sharing, over and above the partnership, it becomes an additional risk comfort. If there is an additional risk comfort or credit comfort, that obviously would call for capital. If you're providing, let's say, first loss support for any transaction, typical idea of first loss support in the moment you talk about first loss support, we're talking about tranching of the risk. And a first loss tranche which invariably always call for full deduction of capital. That's the rule globally in all capital regulations. If I provide an FLDG for whichever transaction, let's say for a co-lending transaction, somebody else's pool, for example, someone else is holding a pool, I provide first loss guarantee. The first loss guarantee will call for full capital. It's not capital at the rate of 15%. It's capital for the entire protection. So if we are okay in providing capital for the first loss piece, then probably from a capital or risk perspective, one wouldn't have an issue on a co-lender providing protection. But a co-lender providing protection yet not providing additional capital, that would probably not be understandable from a capital regulations perspective.
Sir, very interesting points. And I think I may want to make some statements which I think will be best to remain here. On the practical grounds, okay? Number one, although you can call whatever fancy names that these are partners and whatnot, at the back of, everyone's mind, everyone knows one is a king who is the money provider, and second is a service provider. You will also note the service providers will do everything possible, whatever the king wants them to do, because they are at the mercy, right? Although it is still, there is a principal to principal arrangement, but still at any given point in time, if the losses are going beyond even 0.1%, there are multiple restrictions which will be imposed, right? And therefore that credit enhancement is definitely a requirement. It is an inherent requirement. It is not a luxury item. So this is one, aspect. Second aspect, which is, I think, on the ground, is there any lender in the entire market who will forget the losses which were not covered by an originator even if 5 years ago? At the end of the day, they will ask you to square it off. And in the end, if the markets were to sustain, no one person can benefit at the cost of the other, and especially not at the cost of a money provider, right? And therefore, in the long run, everything is being squared off. So better accept this, acknowledge the fact, and start doing it. And if required, if the service provider needs to provide for some capital, maybe 10-15%, so be it. So these are the two humble points that I wanted to make.
So just thought I'll add a few, 3 points there. One is form. The form is, you call it direct assignment, PTC, or co-lending. Number 2 is roles that we play: seller, buyer, credit enhancer, servicer, right? Number 3 is what he talked about. It is our ability to price the risk. First of all, assess the risk and price the risk. And what time do you want to price and assess the risk? In the first piece, first of all, as a buyer and seller, assignee, assignor, co-lenders, like the point is same. It is the underlying loan is flowing as a loan itself. At what point? At the point of origination, or after MHP, or after MHP as a with the credit trap as an investment. We should say, from a regulator's perspective, probably, I probably am, coming on your side, just saying that the regulator is telling, okay, if you want credit trap, please book it as an investment and not book it as a loan. So from that perspective, that avenue is available. Now it is up to both the parties, assignor, assignee, seller, or PTC, originator and then seller, to decide which form they want to take. So from that perspective, there is a venue available to take a credit wrap. There is a venue available without a wrap. And then at what point, which is like a co-lending. Co-lending is not assignment, because assignment is a sale of asset. Co-lending is at the point in time. Of course, for operational reasons, there is CLM2 where the RBI is telling, okay, you take it after a day. Right? So I would still want not to qualify CLM2 as direct assignment. So that's one. Number 2 is about risk assessment. I completely agree that it's very difficult to assess the risk and then price it right up front, because at the end of the day, anything which is deviating from the first assessment is going to definitely cause heartburn to either parties, either one or the other. So from that perspective, it is all important to go into the transaction with all eyes and ears open, because that is going to help in terms of building the market, rather than taking a shortcut and then saying kuch aur kar lete hain. Right? That is definitely not good for the market. From that perspective, again, it is important to allow for that risk assessment right in the beginning and through the journey also, because lending, unlike any sale of asset, selling a car to a loan to a car to a house, etc. Loan is actually an asset which will run through the journey, through the maturity, and then the last EMI will decide if I have recovered the full money or not. So from that perspective, it is important to be able to risk assess at the beginning, and also important to be able to risk assess credit monitor through the journey. Probably that's where I am telling that RBI's guideline is probably pushing us to say, please monitor on a daily basis. It is very difficult, but please monitor on a daily basis, and then please get into the transaction with your eyes and ears open. Let us fast forward this 5 years from now. We will have tons and tons of data at contract level, which is going to tell us, he's talking about static pool, but it is still coming in from an originator. But the buyer itself will have, after 5 years, contract level data in case of direct assignment, in case of co-lending, which will allow us to probably price is better. But it is not going to solve the problem. But we are, at least at the lender's end itself, there is enough information that is there. The third point is about, sir, on that point, you said we are partners probably. Co-lenders are partners in the journey. I mean, not getting into the partnership or owners of it, etc. But there is a role that one can play. The role could be of a servicer. The role could also be as a credit enhancer. Right? So, but not talking about the accounting, perspective, it was Ind AS, etc. So, I thought these are the 3 points that I thought.
We can probably think of a fourth option also. If we talk about securitization, direct assignment and co-lending as the 3 options, the fourth one is quite simple, source the loan. The NBFC sources the loan, puts it entirely, forget about co-lending, entirely on the books of the bank and provides its own wrap. If credit wrap is all that we are interested in, credit enhancement is all that we are interested in, let the entire loan be put fully on the books of the bank with your comfort. You are the servicer, you are the originator, you probably might be the credit underwriter as well, and let the loan be fully on the books of the bank.
And that particular point is, that particular as a BC, model as a BC is very much available. And
I wouldn't call it BC. It's not, you are not, BC is a term used in different contexts, but I wouldn't call it BC, though. In this case, regulatory arbitrage is, if it's searching for regulatory arbitrage, we won't have it, because this would, then the fee that you're getting would probably be a fee rather than interest income. You would still be called upon to provide capital because you're guaranteeing somebody else's portfolio, so that would be capital absorbing as well. And this would probably not call for any regulatory exceptions, because you're not calling this a case of co-lending.
Yeah.
So the so-called co-lending actually is nothing but loan sourcing. Then better put it that.
Yeah.
The point I was making is that regulatory arbitrage will probably be transient. It will stay for a year before maybe the regulators catch it up, and then the reaction may not be all that favorable.
I will very quickly add 2 things. When a bank lends to an NBFC, the capital adequacy is nothing but a credit enhancement. It is presumed that the first 15% of the loss would be covered by the equity capital of the NBFC. And that's why a bank lends. The problem arises wherein that equity buffer from 15 to 25% is wiped off because the NBFC does something which bank has not envisaged, right? And that's why the expected loss on the balance sheet is higher than the capital adequacy provided. And that's why in any form of securitization transaction, you are taking away the risk of the institution or the financial institution going down and transferring the risk from balance sheet to the end customer. But the core hypothesis of providing some capital against every margin should be allowed. There is no difference between the two. Number 2, I'll give you a very live example wherein the information arbitrages. There are 12 small finance bank, of which except 3 or 4 probably, most of them are still continuing to be the largely microfinance institutions, and all of a sudden all of them have flushed with liquidity. We were doing a transaction of a direct assignment to a small finance bank. This is the filtration condition came. CMR 1 to 3, LTV self-occupied residential property, LTV capped at 50%, 0 bounce on our balance sheet, 0 bounce across the what we call off balance sheet, and not restructured. An expected price 14.5%. I called up the CEO of the small finance bank. I said, sir, this customer profile is today getting funded at 6.5 to 7.5%. He said, yeah, but unfortunately, if I have, because we are transitioning from a 25% microfinance portfolio to secured portfolio, how low I can go when I don't have the capacity to assess this risk. I wish you could provide me credit enhancement, because my cost of borrowing capital has gone down to 6%, I would have done it at 9%. That's the point I was making.
Yeah, I think we'll open the questions to the floor. Yeah, it's kind of open, but yes, please. So, can we have a mic over there? Can you first introduce yourself and then pose the question? And also mention who the question is posed to.
Yes, sir. So I'm Siddharth. I'm an associate at Khaitan & Co. So, sir, just wanted to understand.
So slightly closer to the. Not very audible.
Yeah. Am I audible now? Yeah. Hi. This is Siddharth here. I'm an associate at Khaitan & Co. So my question is posed to sir at the left end.
Mr. Sachindranath.
Mr. Sachindranath, right. Sorry. Yes. So, sir, coming to the point that opening up the market, NBFC is providing credit enhancement, just wanted to understand from the systemic risk perspective, because, I mean, time and again, RBI has shown great concern over concentration of risk, like NBFCs has been primarily funded through bank loans. And providing credit enhancement to the other banks, I mean, this would substantially increase concentration even more. Like if there is a downturn in an asset class, so how does that systemic risk gets taken care of? Like if you can throw some light on that.
No, I don't think so that's the case. I think so people are reading the digital lending draft guideline and getting confused that RBI is too concerned with credit enhancement. That's not the case. RBI is concerned with credit enhancement given by unregulated entities. And there is a reason for that. So if as an NBFC I am providing credit enhancement, the credit enhanced amount adjusts out of my capital. So it is reflective in my capital adequacy. What is regulatory framework? Regulatory framework is that there is a provider of equity capital which protect up to certain % of losses, so the lenders don't have to take the hit. The shareholder have to take that hit. So when I provide the credit enhancement, it adjusts out of my capital. Think of a scenario. If a marketplace which is unregulated has given a 15% first loss cover for its customer to be funded by an NBFC or a bank. Now NBFC and bank would not provide provision or capital cover presuming that first loss would be covered by the marketplace. But RBI has no control over it. When that loss actually crystallizes, and if that marketplace which is unregulated entity refuses to pay, the financial institution would fall because its capital adequacy at that point of time is inappropriately calculated. So that is what a regulator want to cap.
Right. So just a follow up on that. I mean, so it is in the normal circumstances, but what if there is a downturn in asset class? I mean, this could risk NBFC paying back the bank itself, not just from the the one they have credit enhanced, but the one they have borrowed from. I mean, it could have a wider systemic implication. Just that, I mean.
So, okay. So let me give you an example of a NBFC originator and a non-NBFC originator. Where the NBFC is originator, they have originated say 1,000 crore of assets. On that 1,000 crore of assets, they have provided a first loss guarantee. They are bound to keep capital, which is regulatory capital. And therefore, even if things were to go wrong, at a minimum, NBFC has followed the Fair Practices Code. They have followed the Ombudsman scheme. They have followed the rate of interest, collection practices, capital adequacy, right? And therefore, regulators are far less concerned with FLDG being provided by a regulated entity. On the other hand, just think of a digital app which is not regulated, say capital of 1 crore, originates 1,000 crores of assets, puts on to say Aditya Birla capital balance sheet. Suppose portfolio goes bad. This particular portfolio, because they don't have any capital, they have only 1 crore of capital, not regulated, right? First of all, they are going to create this mess in the marketplace. Borrowers are going to suffer. On the other side, the overall systemic risk is going to come to a, as a big concern. So this is something that the regulators do not want, and that is why there is a difference when a NBFC or a regulated entity is providing a credit enhancement, which is absolutely fine. Not an issue at all.
Thank you.
Any more questions?
Hi everyone, my name is Gopal Tripathi. I am from Janai Small Finance Bank. I have a question regarding capital efficiency of this product as a system. So if I'm an originator and on the existing loan I'm already providing a certain capital against the pool which I'm going to securitize. Now once the securitization is done, the capital requirement is on the investor side for senior tranche, junior tranche. And if I'm participating towards cash collateral, I also have certain capital requirement. So adding these three capital requirement, the instrument, particularly for the lowly rated entity, doesn't seems to be a very capital efficient instrument for system. I'm not talking about any individual player out of it. I'm talking about all three combining. So if the capital requirement only remaining at a originator level before securitization, the capital is X. If you add these three, particularly for anything which is A or below, I think that X become X, 1.25X or 1.5X. So how we are thinking on that particular line, particularly if the people or regulators are there regarding the capital sufficiency or efficiency of this product as a whole.
Maybe I'll take this and if it's okay. So was the question, sorry, maybe you had difficulty in understanding the question. Was this the question that if there were three slices of the pool which were sold to different entities, is the combined capital post securitization higher than what it was before the transaction? That depends on the capital requirement for each. For the banks, for example, the requirement is 9%. For NBFC, it's 15%. So that itself will result into a difference in the capital requirements. But for the originator, the capital requirement post the transaction cannot be higher than what it was before the transaction. That's capped. I mean, the highest capital that you'd be required to keep will still be the capital that you would have needed had the transaction not been done. Does that address the question?
I think for the entire pool across the buyers and sellers.
No,
I think, sir,
across different investors, there's no way of comparing the capital requirement across investors.
there is arbitrage already, which is the requirements which are different from a bank to the seller, which is could be
And
an
in any
NBFC or
case,
SFB.
in no system do we aggregate the capital requirement for each of the buyers. The capital rules that we have in India are exactly the same that they exist elsewhere in the world. And nowhere do we aggregate the total capital requirement post the transaction and compare that with the requirement before the transaction. However, for the originator itself, the protection that you will not be called upon to keep more capital, that still exists. Systemic capital, first of all, there might be some investors who don't need capital, for example. There is no capital requirement for a mutual fund. There is no capital requirement for HNI investors. There is no way one can compare the capital requirement for investors in general. Even if each of the investors came from the financial system, their own capital requirements are different. So there is no way to aggregate the capital requirement for each of the investors and compare that with how it was before the transaction. That's not there anywhere in the world as well.
So if you...
On an overall basis, if you are talking about the overall systemic capital, one would notice that at a whole, at a, say, a central level, the overall capital requirement will be less. This is my first hand hunch, because the assets which are bought and sold are usually of better than average quality than the overall pools in the economy, right? Because there are multiple credit triggers which are already, multiple filters have been applied on that data. And therefore, when a bank is picking, they are only picking a seasoned pool, right? Where the portfolio has performed, the bounce rates are very less, and, multiple other filters have been applied. So on an on the overall basis, the capital for the pool at a pool level will only reduce than increase.
But having said that, at a systemic level, it is possible that the capital provided is higher also, but you can't help it. There's nothing like that. But I'm saying even if you have to, look at aggregate for theoretical, if you would want to do that, it may be higher. But as in, that's not something which basically can be. Yeah. Yeah, higher or lower.
If it's a stressed asset, then could be higher.
Do we have time for any one last question, or we're just running out of time? Yeah.
My name is Nimish. I am from Kotak. I would like your views, like maybe from Irfan or Sachindra. Like, what are the kind of co-lending volumes you are seeing? Though this is a new product, we see a lot of sign-ups happening in the industry on co-lending. But in terms of actually transactions happening, what are you seeing? And whether it is under Model 1, Model 2?
So definitely, you talked about sign-ups. Yes, there have been increase in sign-ups across banks and NBFCs. Definitely, no doubt about it. And if you include the hello, audible? Yeah. If you are asking about volumes, definitely we've seen volumes picking up, especially in Q4 and then subsequently in Q1 of this year as well. One interesting piece is, I'm sure Mr. Nath sir can also add, earlier it was sign-ups. Now we have seen larger players, including AAA, AA, also coming up and doing, transactions, although, in CLM2, picking up, right? If you come to private banks or other NBFCs, we are seeing fintech co-lending also happening. Fintech or small originators, two-wheelers, across asset classes also happening, and then these volumes also going up, for sure. Currently, if you ask, the right question probably is what is the potential? And we see that anywhere between 70,000 to up to a crore is something that we can project in 12 months to 18 months for sure. I think he was talking about 50,000 crores. So that number is definitely possible. Unlike last year where we were seeing co-lending partnerships between fintech or small originators and large NBFCs and private banks, this year we already have seen transaction flow also happening across mortgages, across housing, not just the small tenor loans or something like fintech or two-wheelers also.
So my prediction is 50,000 odd crore of co-lending volume at the bare minimum in FY 22-23, of which roughly around 50% would come from mortgages, which is home loan business, around 25% would come from SME and other allied, and around 5 to 7% from agribusiness.
Sure.
Go ahead. You can start asking questions. Mr. Razi, you can post your question.
Okay. Hi. Thank you very much. I'm joining in from London, and Vinod, thank you for inviting. So, Mike, I wanted to just address the question that was asked a while ago. Well, actually, it was the last question regarding whether capital requirement at the system level has increased or increases through securitization. I think the way to look at it is whether risk has been created, because capital requirement follows risk ideally, although oftentimes it does not. So in a securitization, risk is neither created nor destroyed, because what you're doing is transferring the risk, both the credit risk and prepayment risk, associated with a pool of assets from one party to multiple parties, right? So risk is the same, whether the assets are securitized or not. Now, whether the regulators for the buyers and also for the originator assess the capital requirement differentially, that results in what we call capital arbitrage. So I think the right way to look at it is risk, following risk. So as opposed to trying to figure out what the systemic risk is, as Vinod pointed out, it depends on who is regulating whom and how they view the risk and therefore the capital associated to cover that risk. That's it. That was the point I wanted to make.
Sure. Thank you, sir. I think with this we come to end of this session. After the next session, while we network, everyone will still be available for any further views that anyone else has or questions that anyone else has. Take this opportunity to thank you, Mr. Vinod Kothari, and all my co-panelists. Thank you, everyone. Thank you.
I would like to thank the panelists for a very insightful and interactive session. We will now be having the Chakra View sessions. I'll give you a little brief on what exactly that is. These are commonly known as fireside chats. The idea is to have a more inclusive discussion on several contemporary issues, for which I would request the audience to split into 4 inclusive participative groups. Some of the participants have already shown their interest for their respective topics. If you have not, then you can pick a topic which I will announce shortly. These groups will discuss the topic assigned to each one, and then an anchor will assimilate the crux of the discussions to be presented to the entire crowd. I will now introduce the topics and the anchor person for the Chakra View sessions and the place where it will be held. Topic 1 will be on NPL securitization. The anchor person for the same will be Mr. Prasanna Kumar, Senior Director and Head of Treasury, Northern Arc Capital. This will be held at the Royal Room, which is outside the main hall to your left. Topic 2, are bankers giving a fair deal to the DA or TLE, that is direct assignment or transfer of loan exposures market? The anchor person for the same will be Mr. Hemant Pandey, Head Treasury, Ugrow Capital. This will be held within the hall on the right hand side corner. The third topic is on green securitization, STC securitization, that is simple, transparent and comparable securitization, and ESG concerns in securitization. The anchor person for this session will be Mr. Atul Agarwal, Vice President, Debt Syndication, Resurgent India. This will be held on the left-hand corner within the main hall. The fourth topic will be role of third-party credit enhancers for securitization, transfer of loan exposures. The anchor person for this session will be Ankur Sachdeva, Senior Vice President, Cred Avenue. This will be held in the Regal Room, which is outside the main hall to your right. We intend to have the discussion for the next 30 minutes, followed by lunch. Lunch will be announced through the sound of a bell, and also I might come up back and announce the same. For our online participants, there will be a break of about 1.5 hours, and we will be resuming by 2. Thank you. I request the participants to now break out for the Chakra View sessions. Pandey, Head Treasury, Ugrow Capital. The topic was, are bankers giving a fair deal to DA or TLE markets? For topic 3, we have Atul Agarwal, VP, Debt Syndication, Research in India. The topic was green securitization, STC securitization, and ESG concerns in securitization. I would like to invite the anchor persons up on stage, and then we can proceed with the discussions, with the presentations of the Chakraview sessions, one by one. Mr. Hemant Pandey. Prasanna. Hemant Pandey. So we'll start with the first topic, which was NPL securitization. The anchor person for this topic was Mr. Prasanna Kumar, Director Structured Finance, Northern Arc Capital. So I would like to invite you to please come and give us a summary and a crux of the discussions that took place.
Thank you. Hope you all had a very intellectual engaging discussions on various forms and aspects of securitization in the first half today. As part of the Chakraview session, we had a participatory dialogue with various participants from ARCs, legal counsels, and few from the banking side. Before summarizing the gist of the discussion, I would like to just put the problem statement first. So every one of us acknowledge that credit flow is the bloodline for any economy, and increasing NPAs can negatively impact the banks in multiple ways in terms of profitability, capital constraints, balance sheet effectiveness, and incremental lending. So the credit flow will get impacted if the NPAs are increasing. And as per the December 2021 Financial Stability Report of RBI, as on September last year, the gross NPA of overall banks stood at 6.9%, which is expected to increase to around 9% by this September 2022. If we triangulate that into amount terms, it is 8 lakh crore, which is $100 billion plus market that we are saying. There is a stressed asset book of $100 billion plus. And on the other side, in terms of resolving these stressed assets, while we have very good regulations in terms of IBC and resolution planning framework, or even the debt recovery tribunal, the number of cases pending with the IBC runs into thousands and with the DRT runs into lakhs, which means while there is some gap in execution. So as part of the Chakraview sessions, we have discussed what are the gaps in the existing options available for resolving these stressed assets, what are the enabling factors that we have to put in place if we have to make securitization as an alternative route that can be effective in terms of not only on paper, but also for executing that as an effective route for resolving the stressed assets. And then finally, what are the opportunities that are available in this route? So in terms of gaps, one of the things that we just discussed in the, I think in one of the morning sessions, Mr. Mark Edelson pointed out, between US securities law and US contract law, the securities law has very strong remedies but very short timelines, hence it is effective. The contract law has limited remedies and very many contractual traps. Our IBC process and DRT process is similar, where the traps are too many, with the IBC allowing many legal findings. Or also there is another angle where the capacity building in terms of expediting the resolution process, capacity building at the judiciary end is also important. Having said that, if we have to move, RBI is also keen to move away from the legal way of resolving this and creating alternate routes for resolving the stressed assets. And securitization can definitely help in addressing that route or be a solution to that route. So the question we have put to ourselves is securitization is a natural way? Is it an alternate option? Or can it completely redefine and be a game changer in resolving this stressed assets scenario? Now, another gap that we found is access to information, access to authentic accurate information about the stress reset. While there is an information utility that is proposed by RBI, effective functioning of it also requires voluntary information sharing by all the participants, especially all the lenders, which is not happening right now. Another topic which was touched upon in one of the earlier panel discussions is how the European countries, especially Italy and Greece, where the NPL securitization is effective, where the information sharing by lenders is mandatory, and hence that has helped in ensuring that the securitization process also runs effectively on the NPL side. The same thing can be done here. One other suggestion that we have received from the participant group is that given the multiple reportings that we have, reporting to MCA, reporting to ROC, reporting to then Information Utility Center, can we have a centralized Information Utility Center which can be utilized by different parties based on the purpose that they want the information to serve. So that is another point gap that can be addressed. And in terms of arriving at a level playing field, so currently there is an arbitrage between banks and NBFCs. Banks have access to DRT in terms of resolving their retail assets, whereas NBFCs do not have recourse to debt recovery tribunal. Banks can call willful defaulter on a corporate which defaults, whereas NBFCs cannot. In terms of information exchange also, the free flowing of information, banks are positioned in a better place. This arbitrage, if it can be removed through regulation, that would be really good in terms of putting NBFCs on par with banks in terms of resolving their NPS, so that when they securitize these NPS, they will also have recourse and the ultimate investor will have an eventual exit option. Few other enablers that we have discussed is from regulation perspective, and again this is one point which was touched upon by the participants and earlier panel members also, the off-balance sheet treatment. With the INDAS and the ECL provisioning, there is no off-balance sheet treatment per se for standard asset securitization. But if the NPL securitization, the intention is to move the assets out of the balance sheet, then this off-balance sheet treatment need to be given for this route. And also applying the ERBF framework, which is external risk-based framework for risk weights for investors in these PTCs. Since the rating framework handles the normalization of the risk, the ERBF framework should help attracting newer pools of investment. Then access to SURFACE. If through this stress research securitization, if the access to SURFACE can also be given, that would help. See, eventually, all these investors who are investing in the NPL PTC, they too will look forward to an eventual exit. Currently, what we understood from the participants is among ARCs, the retail assets, stress assets that they purchase, only 70% of it is amicably resolved, whereas 30% of it goes to legal proceedings. If the legal proceeding is not solved, that either you strengthen that portion or give the recourse to DRT or any effective legal remedy there, so that the investor in these PTCs know that there is an eventual exit, and it's not just that after a time again it becomes NPA on his book and he has to deal with further stress, the residual stress, so to say. Couple of other enablers in terms of guidelines when compared to standard asset securitization guideline that can be put in place in stress asset securitization guideline is allow securitization of FI exposures, because there is stress, there is a possibility of stress in the FI exposures as well, financial exposures to lending institutions. One point which is, can we incentivize loss amortization in order to encourage more participants in this route? If we allow the loss to be amortized over two-year period, at least in the initial period, that will ensure that this route will kick off. But having said this, or even further, similar government-backed scheme like it was in place in Italy and Greece, if such scheme can be put in place either by Indian government or in collaboration with other impact investors like European Commission, if a first-class guarantee or a subordinate position can be taken by somebody who wanted to create an impact and enable sale of these assets under the NPL securitization, that could also help. So the entire participant group has agreed that securitization of NPLs can be a formidable route, given that these gaps are filled and these enablers are put in place, then it will open a route for additional newer pools of capital, say the HNIs, family offices, or even allowing other forms of investor classes or investors to participate would also be possible, and that will help make this a vibrant space. Thank you.
Thank you, sir. For the next topic, are bankers giving a fair deal to direct assignment or transfer of loan exposure markets? We have the anchor person, Mr. Hemant Pandey, Head Treasury, Ugrow Capital, to give us the crux of the discussion.
Good afternoon, everyone. I think to begin with a quite controversial topic, and I can see Vinod sir is smiling here. So I'll first introduce the forum that we had. So in the forum, we had representation from Kotak. We had representation from SBI, Cars24, Motilal Oswal, and Northern Arc. So the forum was quite diversified. And I think that's where the controversies start happening. So on one side, you have NBFCs, and one side, you have bankers and lenders. On this topic, they're clearly divided. So when we talk about our bankers giving or lenders giving a fair deal to the direct assignments in the market, I think we were essentially looking at 3 pointers, essentially 2, I would say. So to begin with, are banks actually viewing direct assignments as another form of credit exposure to the originator? Now, again, the forum was a bit divided, and finally the conclusion that we came to was, it depends on the size of the originator to begin with. If the size of the originator is A-rated or below, depending on their credit rating, there is a likelihood that the banks will or the lenders will actually consider it as another form of credit exposure and cap the exposure on term liabilities and direct assignments. There could be a slight difference here, which we see that if the ratings are in AA categories or A+ and above, you will see slight differences in this approach. On the other side, there could be a distinction basis the type of investor or lender you're looking at. And from personal own experience at Ugrow, I can say that if it's a PSU bank or when you reach out to them for a term facility, the term facility on books could be 100, 200 crore exposure. But vis-a-vis, if you look at a DA exposure or limits that they have set for you or co-lending exposures and clubbing those two together, you could get limits up to 500 crores or 700 crores easily. So there is this understanding by PSUs, and probably that's how they look at the exposure and price it. They are ready to divide the exposure and segregate that, which is quite helpful to the NBFC market. Now, just opposed to that, if you look at the private lenders, and we had few representations as talked about in the forum, the private world looks at a little different. They still are trying to club that exposure, primarily because of the servicer risk that they see, though coming from the NBFC background and having worked in Northern Arc earlier, I personally feel that that shouldn't be the case, because the exposure via DA is primarily to the retail assets that you are actually taking onto your books. That's a way you are actually building your books, and the regulators and the overall environment is supportive of that fact to build the books and increase the exposure. In that scenario, probably looking at a term liability and clubbing that may not be the best way to kind of do it. I think over the last 1 year, we've seen certain changes happening here as well. There are particularly few NBFCs who are larger NBFCs, if I may say so, who are actually not capping this exposure and kind of segregating that. Other way to look at it could be the trust that you build in the relationship. We have seen, again, from our personal experience, that you initially start with a smaller DA transaction. The lender becomes comfortable with the overall underwriting that you are doing at your end. The lender is more comfortable taking higher exposures, and then a term liability also comes through. And then they try to segregate and create a larger portion for a DA or a co-lending with you, which they are very comfortable with. So this is how the relationships have been building in the last at least a year or so, and I think that's the way to look at it, because co-lending and co-originations have become the flavor of the season. As already discussed amongst few of the panels earlier, that in the next 2 to 3 years, probably you'll see the co-lending volumes and co-origination volumes taking over direct assignment volumes in the market, which is a very real scenario at this point of time. One other thing here is why a bank or a lender will actually club this exposure. Primarily is, and that's the saddest part as well, but if you have done a DA transaction with a bank or a lender, and God forbid there are losses in that pool, I think for at least the next couple of years, your term lines are blocked. And no banker, no on the private side or a PSU will ever look at you. Maybe at the PSU side, they might consider because of some other external factors, but definitely not on the private lender side. We don't feel that that will happen for the next 2 to 3 years at least. either you find out a way to compensate for that loss, which could be in the form of an excess PF or something, or you need to wait and demonstrate that how your underwritings have improved, how the business model has improved, how the relationship with the overall ecosystem has improved, and then you probably ask for a new term line. So yeah, in a way, that's how the banking world or the lending fraternity looks at the NBFC world, and we have to live with that. Another aspect here was, are banks actually ready to take up losses? Is there a perception they not want to share losses? Now, structurally, if you look at the waterfall, they will have to. There is no other choice. I don't think the regulator allows that part in the direct assignment space. Having said that, that took us to the next point of discussion was, are banks actually pricing basis what are the potential losses in the pools? Now, here there are various things to consider. The first point is, are you actually evaluating the risk properly? So a lot of the lender fraternity actually relies on rating agencies. Now, I come from a ratings background, so I can vouch for that the models are good and great, but now I've come to the other side of the value chain. So I would say that it's a statistical tool. Now, if you actually rely on an external rating agency to evaluate the risk in the pool that you're about to take on your books, that could vary depending on the size of the pool and the concentration in the pool. A very classic example is a secured pool with a 25 crore exposure versus a secured pool, same product, same characteristics, 150 crore. The LEs could move from anywhere between 1% to 4.5%. And that's a live transaction I'm talking about. So how do you price that? So if you're doing a 25 crore transaction, do you just price the 4.5%, divide by the average life of the pool and add it to the pricing? That won't work for at least an NBFC like ours and maybe many more NBFCs. And no, none of the NBFCs would like to do that. But that's how the real world is. You have to live with the external evaluation of loss estimates. One aspect which also came up during the discussion in the forum was some of the large banks are using their own internal models to evaluate. Now, if you're doing that, of course, there is a different methodology, and it's more customary to just get an LE from a rating agency, but then you do and price it basis your internal loss evaluations. A question which I had posted to the group was, why should you actually price basis the losses? In an ideal scenario, the pricing of a pool should be something like, what is the yield that you'll book on your books minus the OPEX? And you still take some losses, right? Every pool has a probability of taking some losses. It may happen, may not happen. So why price that onto the pricing of the DA? And a very classic example was, we need some ROE kicker there. So, and that's kind of an internal mandate. I'll not name who said that, but yeah, that's the real world. So even if you would not like that to happen, but that's what is happening in the market, that the bankers or the lenders will try to price it, or they'll have a minimum cutoff or a threshold in their minds that they want to achieve with doing a direct assignment. And they know that they don't have to have any kind of OPEX, the servicer risk, or the servicing is being done by the originator. So in that sense, it's quite safe. And whatever losses are there, I've just already taken into consideration. But then the first question which I started with was, how do you actually evaluate the risk? Is that the right way? And then do you price it? So it's a very subjective matter. I think everyone will have their own answers and every lender will have their own thoughts about it. But that's how I think the NBFC world actually thinks. And I was speaking to a few of the colleagues while they were having lunch, and I think everybody had the same view that it may not look like a very fair deal at times until unless we move to Q4s and there are pressures of PSL and there are pressures on the bankers and the lenders to take it on their books. And again, that's the real world. So those are the two ideas which we were deliberating on. And one of the third idea was, what time do the losses or shortfalls actually get passed on? Is it regularly on a monthly basis, or you see a tail end kind of a risk? So to answer that question, I think the waterfalls are pretty clear, the guidelines are pretty clear. If there are any shortfalls on the interest side, you'll have to bear it on a monthly basis to make good later. And similarly on the losses that you book on the principal side as well. The only thing is, because you will accumulate all those loans which are not performing well and try to sell them off towards the end. So that kind of you can consider as a tail end movement, that the eventual losses will hit you at the end. But then beware, you're not getting a new term loan facility. So I think it's a choice to make. How do you actually evaluate the pool when you're giving it to the banker. Just not think of raising a new form of liability, but think it from a relationship perspective, because the larger the relationship, the bigger the trust. And we have seen that, I think, month on month, quarter on quarter, that the trust builds many-fold. So the more the trust with the banker or the lender, the better the deal for you in terms of pricing, in terms of the newer opportunities. Thank you, everyone.
Thank you, sir. For the next topic, which was green securitization, STC securitization, and ESG concerns in securitization, we had the anchor person, Mr. Atul Agarwal, Vice President, Debt Syndication, Resurgent India.
Good afternoon, everyone. Thank you so much for giving me this opportunity. Basically, green securitization is a very new concept in the parlance of the country. So what is green securitization? Green securitization is either a securitization of green financial assets, which are either collateral or where collateral are either green assets or cash flows are generated from the pool of the green assets. And what are the types of green securitization? There are three types of green securitization. One may be the securitization with green collaterals, whereas the underlying assets are green assets. Second could be the securitization where loans are utilized for green projects. And third would be, that would be very interesting and very, I must say, it's a very debatable topic. In fact, all the participants in our group were debating on that. Notes, proceeds which are used in investing green projects can be termed as green securitization. That could be a very debatable point. But as per my understanding, if that proceeds are going for financing some green projects, that could be defined under green securitization. Even though the underlying assets on which that particular securitization has been done are not of green assets. Then we talked about the benefits of green securitization. So it will definitely contribute to sustainable securitization. And second, increase liquidity in green finance. And what are the challenges we are finding in green securitization as of now is the first and foremost is the absence of a standard eligibility criteria. Second would be the absence of specific regulation. Regulatory regulations are not there on which we can define a green securitization transaction. Third is lack of incentives, whereas there are certain NBFCs who are doing only green financing, but they are not getting any incentives against securitization of their green pools. They should be incentivized. And fourth would be the use of green securitization to finance non-green assets. So the finance which we have got through securitization is being financed for the non-green assets. So that will forfeit the entire thought process of the transaction. That would be a biggest challenge. After that, we discussed what are the challenges investors are finding at present days. So the first and the foremost difficulty investors are finding in identifying the green assets in current loan book. That is the biggest challenge. Second would be the absence of standard eligibility criteria. And third is no clear definition of green loans. So beside this, I leave it to the panel for the further discussion on this. Thank you so much, everyone. Thank you very much.
Thank you so much, sir. We would like to invite anyone from the floor if you have any queries for the anchors to discuss or any points to put forward. And we also had a fourth topic, role of third-party credit enhancers for securitization, transfer of loan exposures. For this also, if you have any points to put forward or if you have any queries on the same, you can please present your views.
Okay, I have some discussion on the NPL securitization, Mr. Prasanna Kumar. You mentioned about SARFAESI eligibility. If we talk about a non-performing, like in case of performing loans, the servicing typically stays with the originator. I would assume in case of NPLs also, Mr. Sanjay Chamri also mentioned earlier that there is no reason for the servicing to get shifted because the best person to collect a non-performing loan is the originator himself. Servicing stays with him, he has SARFAESI rights anyway. If he has it, he has it. If he did not have it, he wouldn't have it. So why would SARFAESI write in the name of the SPV or the servicer as such be a concern? That's one question. Second one, you mentioned about the existing framework. The SSA directions obviously do not permit something which is taken as non-performing. As you are aware, I'm sure your participants included, I mean, there is probably a possibility of a revised framework which might permit NPLs to get securitized. But under the existing framework, can we think of using the SR security receipt route for a sort of securitization of non-performing loans too, in the sense that if the SRs can have a structure, a senior, a junior structure, then that serves the same purpose. All that we do is to route it through a ARC. So ARC acts as the trust, and the trust comes up with, let's say, class A, class B. Of course, 15% investment stays with the ARC, which is a mandatory rule. But if structuring of SRs is possible, that possibly will serve as the mechanism even under the existing framework. So maybe your thoughts on both of these, or maybe anybody else in the floor might want to interact as well. Maybe take this. I think you just need to keep it pressed for some time. If you come. Okay, please.
Sir, in response to your first query, why is the recourse to SARFAESI is required in securitization? So, like I already covered, even the investor who is investing in the NPL securitization PTCs, every investor would want to have a clear exit route and have a clear assessment of how much return he will make. If ARCs in retail SRs or ARC transactions, only 70% of those stressed assets are resolved amicably. The remaining 30%, you need a recourse either through SARFAESI, DRT or ABC. The resolution process need to be made available so that the investor will have an eventual exit. So that's the reason we said even under securitization of NPL, if the recourse to SARFAESI can be given, that will expedite and also encourage investors to participate.
No, my point was that the NBFC to begin with had SARFAESI rights. The fact that it has securitized will not take away the rights. The right will still remain. So NBFC continues to service and continues to proceed under SARFAESI if at all that's applicable. And in any case, there will be a subordinated class retained by the NBFC. So the investor gets an exit by way of a senior tranche. The junior tranche stays back with the NBFC. The NBFC keeps using whatever remedies it would have done to continue to pay off itself. Because then that's the
Understood. In the scenario where you are saying NBFC will retain a portion, especially the subordinate portion.
Every transaction NBFC is anyway retained.
Right.
I think all that needs to be done perhaps is to relax the limit of 20%. Currently 20% is the max.
Right, yeah.
So I think that is relaxed, that will probably take care of it.
Definitely, yeah, that is one of the points that the participant group also said. There is a cap of 20% ceiling that need to be relaxed. Yeah, you're right.
No,
In that
Mr.
case,
Kothari, sorry, yeah. What you are saying, it's here. Hi.
Yes, sir.
So what you are saying that the originator retains the right of servicing, that's true essentially when these are retail loans. What we have seen transaction where it's a wholesale loan, where especially foreign institutions are investing in NPL. They actually want the servicing right to themselves because they don't want the originators to service because these are large chunky assets. That's where we face the biggest issue because the SARFAESI right goes away if it moves out of the originator's hand. Which is possible in an NCD or a PTC structure, but in an SR structure, that goes away if, the originator is not part of the transaction.
Not sure though, but Anita could probably also contribute. If the loans are transferred to a SARFAESI eligible entity,
Yeah,
the
so-
buyer assignee SURFACE eligible, will the SURFACE rights not remain?
So currently that's where the regulation prohibits because you use an ARC. Now the challenge is with using the ARCs, you need to get the ARC on board for 15%.
15% tax.
So you need to use the ARC. If you don't want to use the ARC, there's no structure because the surface right goes away. So what we were discussing is if the regulator permits a separate class under the securitization guideline for NPL, where you don't need to use the ARC vehicle, that would make the transaction much more easier and the surface would still be available.
But that would require a statutory
Absolutely,
amendment.
absolutely,
The SURFACE Act to get amended. Okay. I had a
Yes, sir.
question
Sir,
on the
yes.
green part as well, and maybe I think if there are people here who could probably also want to contribute on that.
Sorry, sir.
I think
There was a second question you had on the crate ranching. Yeah, you're right
SRs
that
make
SRs,
it annual
SRs
branch.
have crate ranching, and in the market, I think there are deals that happen with different classes
Are
of
there,
SRs.
are there deals with tranching of SRs?
Yeah, that's what I heard from some of the rating agency people I spoke to last 2 days. Not today. Today, I haven't seen participation from them. Yeah.
Okay, I don't know if there are people in the floor who also are aware of it, but I am told that there is only probably one case
One tranche.
of.
Okay, one case. Yeah.
That's what I was told. Only
But
one
there is
case
a
of-
possibility. The route is available to crate tranche in SR route also, like you rightly said.
Though probably the regulations say that as far as payment of principal is concerned, the principal will have to be at par. You can do tranching on the residual, but the principal has to be paid to both. If, supposing there are two tranches, the principal has to be paid both before distribution of income can be done. So tranching of principal probably cannot be done. Tranching of the excess over principal perhaps can be done. That's a bit of inefficiency in the SR structure.
Right. Additional possibility that we discussed in the group is when compared to SRs, in PTCs to incentivize more investor to come, why don't we securitize a heterogeneous pool, heterogeneity from the perspective of the status of the loans? Why can't part of partial pool be current loans as standard assets? And X% is standard asset, Y% is NPA asset or at different stages. Some are in DPD, some are in NPA. And you pool them together and allow for a securitization where different credit tranches can be given and investors might be incentivized because part of it is already performing loans. And you are trying to pool in non-performing loans along with them, which might have the possibility to become a re-performing loan like we discussed in earlier sessions.
I don't know whether that, I mean, you have a basket of apples and you got a lot of good apples, but some bad apples. Will that be a good idea? Because the moment you add some bad apples in the basket, investors' perception changes, isn't it?
This came forward because of the re-performing loans that what ARCs also said is after securitization, after assigning to the SRs, there is part of the book that starts re-performing. And banks at that point, even if they want to buy it back, they know that these are re-performing. There is no option for them to buy back. But if you know that it is only a temporary delay, the borrower has a temporary cash flow stress, went into 90 plus DPD. And then after that, they started paying consistently one EMI, but not clearing of the prior period overdues. Then they stay in NPA. So it is a re-performing loan. And there is a significant chunk of that NPA book, which also is re-performing. And that loans can be clubbed along with standard assets and securitized, and that can attract investors.
Very good, absolutely. On the green part, just one question. What you talked about incentive, of course, but aren't there mutual funds which are holding, funds intended to be invested in green bonds only? So if we come up with green securitization, that money which is dedicated for green investments will be available and probably at a cheaper price than the regular non-green investment, so to say. So I'm wondering if one can get money cheaper by doing a green transaction, one would do it. But if there is no cheaper pricing, then why wouldn't we bother about it?
Exactly, sir. There are certain NBFCs which are doing only impact funding.
Just keep it pressed for about 5 seconds, it comes up. But
so there are certain NBFCs which are doing impact fundings basically, and they are looking for some cheaper funds. So they are not available to get cheaper funds as of now. So obviously, if there are certain banks or investors who are looking for some green financing,
I think many of them issue green bonds all the time. A lot of banks are issuing green bonds.
Yeah.
That money has to be invested in green assets only.
but so securitization I have never heard.
No, I'm saying if there is a money available to be invested in green issuances, be it bonds or securitization, then the money would obviously be available for green securitization too.
Definitely.
And that money hopefully will be cheaper than a non-green tag transaction.
Yes, definitely it should be there, sir. But I am not aware about it.
Okay, right, perfect, good. Anyone else who would like to contribute on the third party answer or any of these topics? Otherwise, Tim? Thanks all of you. Thanks all three of you.
Thank you for this very interesting discussion. Next up, we have a special address from Dr. Viral Acharya, who is a former Deputy Governor of the RBI, a noted economist, and a professor at NYU Stern School of Business. His words are valued by central banks and the financial industry world over. He has also reviewed and commented upon the booms and busts of the securitization and fixed income products over the years. In his special address, he'll be discussing a wide range of issues, such as the success story of US MBS market, CLOs, and what drives them, what is ailing the Indian bond markets, the role of NBFCs, and other specialized lenders in the emerging cash flow-based lending environment, and several similar issues. While we would have loved to have him present with us today, due to his inability to commute, we have pre-recorded a very interesting and insightful interview with him. May I request the video be please played on the screen?
I would just introduce you to the participants in the summit. It would mostly be the structured finance professionals from across banks and non-banking finance companies in India.
Okay. Right.
This is the 10th edition of our summit. We have, of course, not been able to get you in the past, but this time we've been so very lucky to get your time.
Okay, great.
Thanks. So I'll straight take you to the questions there. And the first question I would want to ask you is about the economic value that you perceive in securitization with nearly 52 years of history in the US with almost $4 to $5 trillion worth of mortgage loans and other kinds of receivables being securitized. Does it hold value in terms of being responsible for more affordable or more inclusive funding? Do you think it's been the region for more affordable housing finance in the country?
Yes, so I think United States on the mortgage-backed securities market is quite peculiar in my assessment. I wrote a book on this with my colleagues, Matt Richardson, Larry White, and former colleague Sten Van Nieuwerburg, where we think that primarily the securitization markets in the US are of the size they are because of the government-sponsored enterprises support. So Fannie Mae and Freddie Mac and a couple others which are smaller, for most part they take over the credit risk of certain conforming mortgages below a certain size, meeting some loan to value, etc. thresholds. And because the credit risk is taken off the table when these mortgages get securitized, essentially it becomes a pure play on interest rates. In private label mortgages, as they are called, which is the securitization of non-conforming mortgages, where the credit risk will not be taken over by Fannie Mae and Freddie Mac, that securitization market basically was essentially a boom and bust cycle, I would say, from early 2000s until the global financial crisis. That market has really not revived itself in much capacity at all, partly because the mortgage lending standards became much tighter because of regulation and maybe the lessons learned from the global financial crisis. And capital requirements for holding these assets have also gone up substantially. So I think when one thinks about securitization or the originate and distribute model for mortgages and looks at United States, I think it is primarily, in my view, the government credit support for a huge chunk of the mortgages that's the driver. If you look at the world over, securitization does exist, but it's in slightly different form notably in the form of covered bonds in some European countries, and we can touch upon that later. But I would say that there is securitization in the United States in the corporate loan space. There is corporate loan obligations, most notably, they are called as the collateralized loan obligation or the CLOs. And that is almost entirely private market. There is no government backstop there at all. It's a very clever self-liquidating capital structure that these corporate collateralized loan obligations have. And to me, that's partly a sign of sophisticated and deep institutional base. It's a sign, I would say, of financial innovation and legal infrastructure that drives the securitization. And third, it is a sign that bank capital requirements have been rising post global financial crisis, which makes it better for banks to originate, especially riskier loans, but then to distribute them to institutional investors who are funded more long term, unlike banks which are funded more relatively with short term paper, and then their capital requirements are either light or they have lighter touch regulation. So I think to me the success of securitization in the United States as a private market outcome is greater in the corporate loan space, whereas the success of the securitization markets in the mortgage space is really thanks to the government sponsored enterprises. Now, to be fair though, as I said, there is interest rate risk distributed. There is a thriving market for that. But to me, that has flourished primarily because the credit risk has been taken off the table on the mortgages.
Touched upon several topics. You talked about the government market and the private label market, and then you talked about the CLO market. But let me just take some more inputs on the government or GSE supported market, as you referred to. You said this is basically risk assimilated and absorbed by the GSEs, which obviously have the support of the government, either explicit or implicit support. But eventually, if it results into a lower cost of mortgages to the homeowners, is it something that you would like to recommend as a policy choice for other countries? For example, in India, there is currently no absorption of mortgage lending risk by the government. And do you think if this is something which helps individuals to own houses and lead or sort of support the cause of affordable housing, is it something that you would recommend as a policy choice?
I've never actually been terribly convinced by it. These institutions are partly sort of creatures of the New Deal that was signed after the Great Depression in the United States in the 1930s. It was a very deep crisis, financial and economic, and there was a need to kickstart the housing markets. And so the government guarantees were created for that. But it's been sort of hard to put that genie back into the bottle because the system just can't be weaned off it, so to speak. So I think that the trouble with these kinds of support is that it works well only if it is tightly regulated, which is that the loan to value documentation standards, the risk management of the government sponsored enterprises themselves is maintained at very high and prudent levels. And what the checkered history of the GSEs in the United States shows is that as long as they are doing prudential risk management of reasonable standards, things have worked out okay. But whenever they've deviated, they've contributed to housing market access and either resulted in their own vulnerability or the vulnerability of the market as a whole. And the question then arises is that why should this prudential risk management fluctuate in the first place? And that's because there is mission creep because of political economy factors. housing is a very popular currency to pay your citizens in, especially in the United States. And so usually there is sort of changes in the mandates, changes in the requirements, missions and goals are being set on it. And that debate, in my view, is not that different from the debates that we've had in India on, objectives of public sector banks. What are they trying to achieve? And invariably or the other, sometimes they might be serving a good purpose, but there are times when they are available for politically expedient pump priming of the economy in one way or the other. And so I think there are economies where housing is not as much owned, and yet housing is available. Like Germany is a good example where rental markets thrive. Probably home ownership in Germany is not even 50%, or it's somewhere around in that range. In our book, Guaranteed to Fail, we in fact had a table where the highest home ownership at that time when we wrote this book after the global financial crisis was in countries like Iceland, Ireland, and Spain, and they had all had spectacular housing crises. So it seems to me that government guarantees are never priced fairly. Their scope is never regulated in a consistent manner over time, in a manner that they remain sort of distant from the political cycles that an economy might be experiencing. And I think in the end, people end up philosophically on one side or the other, whether there should be government guarantees or not. My view is somewhere in the middle, which is that it really goes through cycles. And to me, that's a sign that there is no guarantee that government support of mortgage markets will work well, because there will be mission creep, there will be political exploitation of these guarantee providing entities as and when they are set up. They will be run horribly from a risk management standpoint when pump priming of the economy and giving stimulus to the housing markets is politically convenient. And that these are risks that then have to be either accepted or taken into account or managed well.
Very well articulated. I think for any country which intends to support housing finance to government guarantees should bear these words of caution in mind. You talked about the risk transfer and the regulatory capital arbitrage, so to say, in the CLO market, and you mentioned that through a very efficient legal and regulatory management, the bankers have been transporting the risk, so to say, into capital markets, thereby gaining regulatory capital arbitrage. I have also, everyone is aware of your writings on, the potential risk transfers that perhaps wasn't real in the asset-backed commercial paper market or the CLO market, so to say. Post the global financial crisis, most of the regulators have taken steps to rewrite the regulatory requirements with more skin in the game requirements. Are you sort of satisfied with what is the existing regulation now with the minimum 5% risk requirement? Do you think that the capital requirements are now in good shape? And do you think the kind of risks which were seen in the US before the global financial crisis, are these of real concern to countries like India or developing markets which don't really have so much of trust on securitization as of now?
Yes, I think I would say, the regulators are by and large good at fighting the last wars. And so, especially if you've had a crisis of the scale of the global financial crisis. So, the rule making at the Basel capital reforms, and especially in the United States, with sort of very serious stress testing being done for systemically important financial institutions, I would say capital requirements are fairly high. Now, in some ways, that creates even greater scope for regulatory arbitrage by pushing risks off into the shadow banking system. And I think there the regulators have not done as much as I thought they might after the global financial crisis. Somehow the diagnosis of the global financial crisis has been more about capital requirements for banks rather than necessarily also harmonizing capital requirements within the financial sector as a whole, as they say, sort of regulate by function rather than form. So, if a mortgage-backed security is going to be held by entity one versus entity two, roughly given the risks on their liability side, are you apportioning capital requirements in a similar manner? Money market funds, I think, still remain vulnerable. I think they had to be supported at the time of the COVID shock again. And I think what to me is more disturbing is that the traditional shadow banks, such as broker dealers, the asset-based lenders, I think those have all. I think those are running their balance sheets more prudently than in the past. But I would say hedge funds contributed quite significantly to vulnerability of treasury markets at the time of COVID. Many of them were quite substantially levered on, cash futures trades in treasury markets. And when that blew up, the margin calls caused them to topple and liquidate their positions. The new suite of investments in debt mutual funds, ETFs, etc., where sales can take place or redemptions can be claimed, even if not on the underlying securities, but on the units of the ETFs. In case of mutual funds, you can of course claim redemptions of the underlying assets themselves. At the time of COVID, all of these seem to be like claims on liquidity. As uncertainty rose, everyone simply started liquidating in these markets. And so those who were supporting corporate bond markets until then suddenly withdrew their support all at once. So it looked like a run, in my opinion. It looked like demand for immediacy from these investors. It was as though they thought, of course, these markets should be liquid at all times. But once these fire sales took hold and bond markets froze, of course, then corporations started drawing down on bank credit lines. And ultimately, the risks got transported back to the banking system because the corporates that were reliant on the shadow banking markets ultimately had insured themselves against that risk through credit lines from banks, and they drew down these revolving facilities, and ultimately banks were on the hook for the shadow banking freeze that took place. So I'm not yet convinced that we have a good grip on the risks of the shadow banking system. It seems inherently still very fragile to aggregate risk and uncertainty. In one way or the other, the risk travels back to the banking system. The phrase I use is that the shadow always touches the feet. So shadow banking always seems to touch the banking in one way or the other. I think this is still work in progress as far as financial stability regulation is concerned, in my view.
Absolutely. So you talked about covered bonds a while back, and you referred to covered bond markets in Europe. This is something which doesn't exist in India as of now because there is no supporting legislation. Most of the European countries do it based on legislative support. So whether in conjunction with or as an alternative to mortgage-backed market, which is also not very great in India, would you suggest covered bonds to be a value for the housing finance market?
It's certainly an option. If you look at the covered bonds market, my understanding is that there's a lot of skin in the game for the original lender. They distribute, but then when the losses arise, the losses come back to the balance sheet of the originator. And it kind of shows this point I was making earlier that ultimately the investors in securitization are comfortable with interest rate risk, but they want that the credit risk be shared or be borne by the original lender. And I think there is some sort of incentive efficient properties about that, which is that we saw at the time of the period preceding the global financial crisis that if credit risk is not on the table for the original lenders, then credit quality can decline very substantially because of moral hazard associated with that. But therefore, to me, it's also not surprising that the covered bond markets that exist in Europe are not as large as the securitization markets for mortgages in the United States. Now, coming to India, I'm fundamentally of the view that the biggest problem in India as far as corporate bond securitization and other markets are concerned is that typically the natural investors in these securities would be those who have long-term liabilities. Like in essence, if banks are finding it expensive to hold these on their balance sheets, you have to be able to share risks in the economy with someone else who effectively faces lower capital requirements because they have long-term liabilities rather than short-term liabilities. As we know, the Reserve Bank is trying to bring the prudential regulation of shadow banks or non-bank financial intermediaries not all the way to that of banks, but closer to that of banks, both on credit and the liquidity side. Now, who are these investors? I think these investors, in my view, can be insurance companies, pension funds, hedge funds, etc. And we just don't have too much depth in the hedge fund space as of yet because, arbitrage, speculative activity should be allowed to flourish but then fail. And there isn't as much capacity for these sorts of failures in the Indian markets. And as far as insurance companies and pension funds are concerned, we just have the real problem that the government deficits are so large, government borrowing is so large, that a preponderance of their allocation is always to government paper. In my view, our insurance firms, especially the government owned ones, should not be allocating so much long term capital to government paper. This capital should really get allocated to risk taking for the private sector. So there's a fundamental crowding out of long term investors' balance sheet by the sheer size of our government borrowing programs every year. And therefore, until that is brought down to manageable levels, therefore, I personally thought that adherence to the FRBM targets was very, very crucial. That is what would have given a fillip to private borrowing markets in the economy. But we are always pushing out those targets to some future horizon because we
There are
can,
compulsions.
because we can do that. I think it's as simple as that. I think these targets are not binding. We don't have an independent fiscal council that holds government borrowing programs accountable. And so we keep shifting these targets away. And I think the whole essence and the purpose of the FRBM targets is a bit right now lost. And I think it's not clear to me what the targets are anymore. So I think until we fix the government borrowing and go through a serious period of consolidation for 3 to 5 years, I don't see how we can create space for long-term investors to bring capital to the securitization markets.
Absolutely. You mentioned about shadow banks in India, and you mentioned about the role of non-banking finance companies. One of the claims of the non-banking finance companies is that they are able to do lending at the last mile and add to the financial inclusion. These loans originated by non-banking finance companies typically end up on the balance sheets of banks, either by way of lines of credit or by way of so-called securitization, or in India they call it direct assignment, sale of loans from the NBFCs to banks, or maybe the so-called co-lending, NBFC partnering with the bank. How do you see this partnering? Do you see any concerns in terms of risks still residing in the non-banking financial company sector? You mentioned about the regulations in that sector not being as strong, even though, as you mentioned, the RBI is largely aligning it. You are aware that there is a scale-based regulatory approach now, which is sort of equating those two. But still, of course, it's not as strong as in case of banks. So how do you see this partnering? Origination happening at NBFCs, ultimate funding coming from the banks.
Overall, I'm in support of sort of differentiated banking, or let's call it differentiated intermediation structures. Now we have banks, we have several asset-based lenders, we have some cash flow-based lenders now, especially with fintech innovations. We have small finance banks, we have payment banks. I think differentiated intermediation structure helps because it creates specialization and expertise in each intermediary for the specific functions they are providing. It also creates a certain amount of stability so that if one asset class or one business model fails, then the entire financial system is not hostage to them not getting recapitalized in a timely manner. I think so. In that sense, I view the growth of the non-bank financial intermediaries in India as overall like a healthy development. Of course, my assessment is, and I talked about this in my book on the RBI stint, The Quest for Restoring Financial Stability in India, that my assessment was that the easy money that was chasing the non-bank financial intermediaries after demonetization, because there was a glut of deposits, banks didn't know what to do with it, so deposit rates fell, and we had a surge in sort of liquid debt mutual funds, which were then funding these non-bank financial intermediaries. I think that growth was too quick. It was associated with very poor lending standards, both in housing and to some extent, I would say, even to the corporate sector. And ultimately with the housing finance crisis and ILFS debacle, all that came to roost. So I think broadly what I'm trying to say is that differentiated intermediary structures are good. I think it makes sense for those who develop the last mile expertise to be originating loans. If then risk bearing is cheaper somewhere else in the system, it makes sense to transfer the risks over. And this way you get sort of economies of intermediation in the process. But this is not to say that just because you have a last mile advantage, necessarily you are managing your risks well. And I think we have seen that NBFIs can also go through a leverage boom and bust cycle, as we saw post demonetization until 2018-19. And so I think I'm in support and favor of the steps that the Reserve Bank of India has taken to get a greater handle on this. My sense is they will look to do something similar in the fintech space as well, once it grows to be of a reasonable size. But that's the nature of financial sector. I think one thing to me that's a constant in the financial sector is that it always organically keeps evolving to the rules of the game. The way the financial sector looked 20 years back is never the same as what it looks from then on, and it will surely look different in 20 years from now. And so there's always a little bit of a catch-up game that the regulators have to play. Hopefully they are most of the times ahead of the game rather than catching up.
Very well put. So, I also wanted to ask you about securitization by banks in India. World over, it's banks which are the primary movers of securitization volumes. In India, banks are only on the buy side. None of them actually come up with securitization of their own receivables, despite some of them under pressure in terms of regulatory capital requirements. Do you think this is a case of lack of sensitization, or is it a considered call by banks for not opting to securitize?
See, my view is that it comes down to this issue of institutional depth for there to be buyers in the securitization market. And I think that until savings in the form of pensions, insurance premia, etc., aren't getting allocated in a large way to buying the securitization paper from banks, I think we will not see this changing in my view, because the fact that banks end up in the end buying this paper in one way or the other, to me is a sign that ultimately that is the only pool of low cost capital which is available to buy these securities, because the low cost pool of longer term capital, which in my view should be what drives the securitization market, is getting crowded out by the government borrowing programs. And you can see that we have reduced the reliance on banks over time. We have reduced the SLR requirements very substantially, from a peak of close to 40% to now below 20%. And, perhaps it may get harmonized with the liquidity coverage ratio of Basel at some point. But essentially, bank balance sheets are not owning government paper as much as they used to. Of course, that means the government borrowing programs are now being more funded in the markets. And the question is who's holding this paper in the markets? It may be mutual funds, it may be insurance companies, it may be pension funds, etc. In my view, unless and until the government borrowing gets consolidated away from 80 to 90% debt to GDP ratios closer to 60 to 70%, we will not see the freeing up of the balance sheet capacity of long-term capital that can give a fillip to corporate bond market, securitization markets, and so on.
I also wanted to ask you about non-performing loans in the retail space particularly. Non-performing assets in India are mostly managed by the asset reconstruction companies, but that's mostly having to do with corporate loans. When it comes to retail loan pools, and you mentioned about fintech originated lending, which is also growing quite fast, and maybe a chunk of that might turn non-performing in time to come. Currently, there's no option of securitization of non-performing loans. Is it something that you would recommend? There is a market, I mean, assuming that there's a market, is it something that regulation should permit? Like in the US, the agencies have been doing re-performing loan securitization. So also in sort of several European markets, non-performing loan securitizations do happen. Is it something which the regulation should permit or promote?
Yeah, so if you look at the sort of non-performing loans market in the United States, of course, there is a set of vulture funds and hedge funds who are very active in that space. Then they go and become very active managers in the bankruptcy, etc. Our insolvency and bankruptcy code is still relatively new. It's still sort of, I would say, it's making good progress, but it's still steadying itself to some standards. I think greater pools of capital being allocated to managing distressed firms will still take some time because they want to see how this code stabilizes. Of course, we had the perhaps unavoidable suspension of the code during the COVID aftermath for a while, and that those kinds of events throw a little bit of sand in the wheels of investors saying, okay, let me set up a fund, and then suddenly, okay, we can't file. So at least from their narrow standpoint, these kinds of events are a bit of, sort of negative shocks to their deployment of capital. On retail side, I think, but I'm still optimistic that on the corporate side, we will probably see more active distressed management players over time because IBC seems to be handling at least smaller bankruptcies reasonably fast and smoothly compared to what we had before. See, on retail side, I would say the default rates in India generally have not risen to very high levels. Of course, unsecured borrowing has picked up, and there is a concern that if the economic slowdown that we have witnessed over the last 5-6 years was to not reverse itself very soon, then there could be stress in this unsecured retail borrowing, but that's something that remains to be seen. Usually these markets flourish when you get an episode of distress, because that's when people actually see an opportunity. Banks may be trying to offload the loans for capital efficiency reasons. Someone else therefore sees an opportunities because the prices on the loans might be attractive. But I think we have not seen, I would say, a large scale retail distress in India in sort of recent times, or at least in the history that I can think of. So I think it's an interesting thought. I still think there is somewhat of a stigma to retail defaults in India. If you think about our housing, my sense is we are back to sort of cash days of sort of pre-demon period. There's still a lot of cash part to the transactions, maybe less than it used to be. But one thing that doesn't get appreciated is that that cash component of the transaction creates a lot of equity of the buyer. They are putting in a huge chunk of their money when they do the transaction in cash. So, not a big chunk of it is really on the borrowed segment. So I think on the retail segment, I would say the real risk is perhaps in the unsecured borrowing, credit card, drawdowns, etc. If wage rise remains muted relative to inflation, if employment scenarios don't improve dramatically over the next few years, there could be stress there. And then that might create a window where banks are looking to offload the risks. And then we have to see whether that will give opportunity actually to see players wanting to come in and manage the retail distress. Now, retail distress, of course, is not, we in principle, loans above a certain size can all go to the IPC, but many retail loans will not fall into that category. So, I don't have great clarity on whether retail distress in bankruptcy in India is going to be handled at a fast pace and well as and when it happens in a huge chunk of loans. That we'll have to wait and see. I hope it doesn't come to that situation, but usually you do need an episode of stress for these markets to develop and garner interest in the first place.
Resolution of insolvency for individuals has not yet been,
Exactly.
implemented. It's still not implemented.
Yes,
And
yes.
one of the reasons for default rates to maybe start showing up in the NBFC space might be the fading of the COVID moratoriums and restructurings,
Yes.
which were done a
Yes.
year ago, and they are now fading, and therefore there might be a liquidity strain on the individuals. But as you mentioned, we hope that things remain good.
Yes.
So, my final question on the credit default swap market, CDS market, there is none in India as of now. The guidelines were recently rewritten. Is it something that, you of course have views on transfers of credit risk from the originator to the investor, but is it something that you would see as a healthy development in Indian market, or is it something that you would
See,
not?
it all comes back to the question of why there isn't much of a corporate bond market in India in the first place. And what the research is increasingly showing is that the success of the credit default swap market in the corporate space is not necessarily because of hedging demand, but because it becomes a standardized instrument to take a bet on the corporate credit risk. So every day you go in the market and you have a 5-year credit default swap, or now the maturities are standardized, but every 3 months there's a new CDS. So within 3 months there's a standardization of the maturity of the credit default swap. In contrast, bonds issued by companies are very specific maturities, coupons, and so on. So I think this view is important because it helps understand that the success of the credit default swap market may be inherently tied to whether you have a successful corporate bond market or not. Because it's really those who are wanting to invest and take on corporate credit risk are the ones who are seen to be wanting to be active in the corporate default swap market, because it becomes a standardized, constant maturity way of taking on credit risk in the market. Now, to the extent that a lot of our long-term capital pool is locked up in government borrowing, I don't see a thriving corporate bond market anytime soon, and therefore I don't see a thriving credit default swap market emerging either.
It's all coming from the crowding out principle that you referred to.
Exactly.
Right.
So I think to me, it is not so much of a product and market development issue as much as it is about changing India's macroeconomic balance sheet parameters. That we cannot see private capital markets booming in the fixed income debt space until the long-term capital in the fixed income space that should be taking on this risk is freed from the explicit or implicit restrictions it faces to keep supporting the government borrowing program.
Absolutely. So any final words that you would like to say to our participants? We don't want to take a lot of your time on that, but any final thoughts you would like to share?
No, I think my sense is, as I was saying, I think having a differentiated financial system in terms of sort of heterogeneity of intermediary specialization, intermediary capital structures can be a great source of strength for the Indian financial system. I think there are some exciting developments happening in the fintech space with, all on the back of the UID, the ability to do cash flow assessment by encapsulating the cash flow behavior directly from, either the e-market, the government marketplace, or the GSTN network, or, it could be on sharing platforms or the gig economy platforms. So I think there is tremendous scope to do cash flow based lending in India on the back of financial innovation. I think there's the Open Credit Enablement Network, or OCEN, which is being developed in the India stack to facilitate a lot of this cash flow based lending. So my sense is, as long as risks are being managed prudently, I think in a country like India, where financial inclusion at the last mile, especially for small and medium sized enterprises, needs to grow tremendously, I think there should be a lot of scope for growth as long as risks are managed well.
Thanks very much. Thanks very much for your time, and I think everybody's indebted. We all understand how busy your time is. So thank you very much for being present today.
Yes, thank you so much for inviting.
Thanks.
All the best.
Thanks.
Bye.
I'm sure you'll all agree with me that it touched upon a variety of issues. And one of the very significant points he made is that for long-term fixed income markets to exist, there has to be room left out by the government, which takes up a large part of the savers' money in terms of employee provident funds, insurance money, pension money, and so on. Very large part of that still gets invested in the government paper, and that leads to crowding out of the market. And therefore, his views about whether it's a covered bond market or securitization market or banks investing in fixed income products is that a lot of room is blocked by government paper. He also touched about non-performing loan securitization, which is our topic that we've been discussing through the day, and saying that these products obviously develop when there is retail distress. So maybe if at all, I mean, keeping fingers crossed, but if at all everything goes smooth, we may not be needing so much of retail NPL securitization. He also talked about, he made a very important point about open credit enablement network. I am sure you're aware of this development. India Stack is developing something called an open credit enablement network. I don't have a full clarity on what exactly this is, but perhaps this would open up the way for cash flow based lending in the country. As for intermediaries such as non-banking finance companies collaborating with banks either by way of co-lending or direct assignment, his views were extremely favorable, that this is a case of differentiated capabilities of people, and that is eventually good for the system. We asked him a question about whether there should be a government-backed agency for guaranteeing mortgage loans, similar to what Fannie Mae and Freddie Mac do in the US. And I'm sure you have heard his view that while these agencies are quite good, but it would be difficult to keep them free from political interventions. Eventually, populism of the government drives the institutions, and therefore there is a policy creep. And very soon they slip into becoming prey to government targets. So these were wide range of issues on which he dealt. Round of applause to Dr. Viral Acharya from all of you.
So we'll now start with the third session for the day, that is on buy-side interests, motivations and concerns. This session will be moderated by Mr. Kalpesh Gada, who is a structured credit advisor. The panelists will be Mr. Arvind Sampath, Group Head Treasury, Poonawalla FinCorp. Ms. Lakshmi Iyer, CIO, Debt and Head Product at Kotak Mahindra AMC. Ms. Shweta Shah, Director Markets at Northern Capital Limited. Mr. Manoj Gupta, Head NBFC, Capital Market and Structured Finance at Kotak Mahindra Bank. And Mr. Umesh Salvi, MD at Catalyst Trusteeship Limited. Please join me in welcoming the panelists on the stage with a huge round of applause. Over to you, sir, to lead the session.
Good afternoon, everyone. Thank you, Vinod, as always, for putting this together and for having us all on this session. So I'm sure everyone has heard what's happening on the global scene, what's happening in India, so far as securitization is concerned since morning. We would have also heard from ex-regulators, we would have heard from the sell side. But it's now time to spend some time with probably one of the most important pieces of the jigsaw, which is the investors or all the money pots. If those pots of gold or pots of money was not there, then the rest of all the various constituents wouldn't have had much to talk about or discuss. So let's just jump into this investors side of securitization. And Manoj, I'll start with you. Considering that about 80% of whatever is the retail sell down is essentially a flow of assets moving from NBFCs to banks. So banks are the key investors, no doubt. And also traditionally about 60% of these investments have largely been coming in the form of direct assignment. That's been the general observation. So looking at it from a larger point of view, since banks have multiple options, there is direct assignment, there is securitization, there is even co-lending, etc. So how do you really view these options when it comes to acquiring portfolios?
Yeah. So see, from a bank standpoint, banks are highly regulated entities. So there are multiple factors which go into deciding which product makes more sense. Now, if you look at it, there is, first of all, the risk weight or the capital requirement for each of these different products is different. For a securitization, even if we look at, let's say, something like a single A-rated transaction, the risk weight would be 50%, whereas something like a direct assignment attracts 100% risk weight. So the capital requirement, I would say, is the first important factor for a bank to decide what kind of returns we are making on that capital and which product one should look at. Then you have other cost implications, the likes of priority sector. Direct assignment attracts priority sector. You don't have priority sector on securitization or PTCs. So a whole lot of these factors get into deciding which product banks should look at. But eventually, we have seen that all of these at some point in time, there will be an equilibrium on return side. Otherwise, as on today, probably securitization is better compared to direct assignment. From a return perspective, risk-adjusted return perspective, if you were to look at.
Yeah, at the same time, for a very long time, somehow the volumes have been more weighted towards direct assignment. So just to add on to what you said, so if you have to think about, so the fact of the matter is bulk of the volumes are direct assignment, which probably even the regulators would wish that it was more of securitization. So if you have to sort of just think of what are those real, factors or disincentives which make it a little more difficult for banks to invest in securitization, or the incentive for investing in securitization is lesser? So big ticket, what are those hurdles, obstacles, etc., which would be coming in the way?
I would say from a regulator standpoint, they've done everything possible. It's more the supplier of these assets. From a supplier standpoint, today a direct assignment makes far more sense compared to securitization. There's capital relief. And like in case of securitization, risk-adjusted return is better for banks. In direct assignment, for a seller, the incentives are better. So it's more the supply side than the incentive required for bank. Having said that, I would say that as capital markets become more difficult, as rates starts rising, securitization is a good tool for NBFCs to raise tenor matched liability. And I think over a period of time, the market should pick up. It gives better rates compared to, let's say, a bullet maturity bond. So I hope it picks up.
Interesting. Arvind, I'll move to you next. Traditionally, like we said, that securitization in India has basically meant a flow of funds from, or rather flow of assets from NBFCs to banks, so everyone recognizes NBFCs as primarily the originators and banks amongst being one of the most important investors. But in your case, yours is amongst those few NBFCs which is also active on the investors' side. So what's really your investment thesis? How do you view investing in securitized paper?
Sure, Kapesh, thanks. I'll answer more from a general point of view, from an entity's point of view, rather than specific. So yes, you're right in saying earlier NBFCs were sellers and banks were traditionally the pools of liquidity, simply because they were seen as better originators and better collectors, but always needed funding for growth. But in the last, say, 4-5 years, in the glut of liquidity and low rates, we've seen many entities come forward, to buy pools or to buy seasoned pools, HNIs, corporates, and of course NBFCs as well. We've seen many NBFCs being on both sides of a transaction, meaning on both the buy side as well as the sell side of pools. So what are the key motivations? If you get a curated pool, you get a seasoned pool without origination and collection costs, and if you're strong on credit, I think direct assignment is a very, very clear answer. It's an elegant solution because somebody is originating for you, somebody is collecting for you, and you have benefits of seasoning and sorting and selection. If you still want a curated seasoned pool but don't want to take any credit risk, PTC is a good answer for you, especially for my capital market colleagues. That also works well. You should get a pickup over a vanilla bond, as Manoj was mentioning, but you have to solve for illiquidity. So the key motivations still remain an accrual book. There are various other things that have opened up, especially after the new guidelines. For example, cross-sell, upsell. These are also possibilities once we acquire a pool. Of course, they are subject to negotiation and agreement, but these are now clear possibilities. People also do pools for solving for the denominator. Optically, the ratios based on AUM also look better. And essentially, it's if you're looking for a growth of the book, this remains one of the better solutions. Of course, you have to look at your financing mix, your access to capital and your access to funding. If they are comfortable, I think a seasoned curated pool is a very, very elegant and natural answer. Many people also do this to do test programs. So if you're not in a certain state or you're not in a certain product, a good way to test it out is to do a small token pool and see how it performs. It's really one of the best ways that we've seen. So these are some of the motivations that I've come across, and I think much more to grow. There's much more risk appetite coming towards this that I've seen over the last few years.
You made a valid point in terms of many entities looking at whether assignment or securitization is a good test case. In fact, the other thing which was going on in my mind is that one could view it both ways. One is to say that, hey, look, I am present in a certain asset class, but may not be present in a certain geography, so there's a good way for me to first test that out. Right. The same hypothesis could work for the asset class itself. The the sort of contrary view could be that these are not the asset classes which I understand or which I even intend to, therefore I won't touch them. These are the asset classes which I understand, and therefore I'll acquire more portfolios of those asset classes. And in the past, we've seen, both sort of thoughts prevail. So which do you think is the more likely view, and which one is the one which is going to be more, largely prevailing?
Clearly, if you're trying to solve for diversification, let's say you're strong in the East but not in the West, or you're strong in 2 or 3 asset classes, but you would look for adjacent asset classes. You want to bring in people who are new to lending, but then once seasoned, you want to sell them a mortgage or a LAP. So for acquiring assets or acquiring customer segments, I still think securitization through DA or PTC is a very, very good option.
And just to touch upon the other point which you mentioned about cross-sell. Now, as an investor, especially an NBFC investor, it would make a lot of sense because that's a good opportunity. Since the seller, in all likelihood, is also an NBFC, probably operating in a similar segment, so on and so forth, does that often become a friction point? I mean, if the selling NBFC would say that, look, I'm happy to share the assets and all of that, but it'll be very jittery about sharing the precise information, which is what will be relevant for you for doing that process. So does that happen?
Yeah, it's a great question, Kalpesh. The earlier guidelines were silent about it, but these guidelines clearly say that this can be negotiated. So NBFC A can, on day one itself, tell NBFC B that we want cross-sell rights on product 1, 2, 3. And then it's very clear. Then there's no, cannibalization at all.
So moving to the other sort of important investor segment, which is the mutual funds. And I think it would be fair to say that mutual funds and securitization have had a bit of a warm now, cold now kind of a relationship. And it would be probably be true to say that we are presently in that cold now kind of a phase. So Lakshmi, firstly, would you agree with that? And what would it take? I mean, the present macro scenario is probably not well suited for mutual funds to be, do investments in papers which are typically much longer than what the mutual fund present appetite is. But what would it take for mutual funds to warm up to securitization once again?
Firstly, hi, good afternoon to all of you, and it's nice to see a full house without mask, most importantly, and that gives me much more breathing space because I used to feel suffocated wearing a mask, and markets are even more suffocating these days. And you started asking about mutual funds' relationship with securitization. I don't know if it's blow hot, blow cold, but yes, it's been a combination of one-night stands, flirting, marriage, and then remarriage. So it's been a combination of all of these, largely because of 2 factors. One factor, is my voice echoing? Or is it?
That's what it seems here, but they can
Okay, they are able to hear. All right, because I can hear myself again. Anyways, so it's a combination of 2 factors.
It's your andar ki awaaz, don't worry.
So the first factor, as you rightly alluded to, is the macro. And today, more importantly, specifically in today's context, the macro actually reminds me of Bhul Bhulaiya. Because you think you are talking to Anjulika and you are actually interacting with Manjulika, for those who have seen the movie. I'm not going to reveal the suspense, but it's very confusing, it's very chaotic, it's very volatile. And when that kind of a scenario happens, typically investors also tend to shy away. And that is also tied into your question. It's a combination of the kind of inflows that the mutual funds get. If we are predominantly getting money into liquid and overnight funds, which are getting to be a gigantic category in the mutual fund fraternity, even if I want to have a marriage, I have no choice but just to look at it and flirt. So I think that's where we are. The interest rate scenario, the liquidity scenario is far from clear. Probably on June 8th, we will have much better clarity. And even before that, if I take you 2 years back, this massive spell of pandemic has also meant quite a few lenders, probably going into cold storage, trying to grapple with recoveries, cash flows, ALMs. So, when there is already so many issues on the other side, then you don't want to inherit more trouble. So I think it's a combination of all of these factors. So if you see in the total mutual fund industry, I think the total PTC exposure as we speak will be no more than about 3,500 crores. And it would be one originator which is actually having bulk of that size. So if you exclude that, and if you look at the retail pool, that number would not be more than 300, 400 crores. Tops maybe 500, I might be away 5-10%. So I think that will take a little bit more time to warm up. As I said, till then, we have to say, ताकते रहते तुझको सांझ सवेरे. So we are just going to keep looking at it, tracking all the deals and saying that yes, we are in the game, but not yet ready to jump into the pool.
So right, you mentioned several factors which are sort of external, the kind of flows that you're getting, so on and so forth. Let's say a few months down the line or whatever, some period down the line, that part improves. And now everything is right from an environment point of view. Then what kind of transactions would really be meaningful, attractive? So, I mean, अगर रिश्ता आता है उस टाइम पे तो कैसा रिश्ता आना चाहिए? What would we be looking for?
So, if this question were asked to Draupadi in Mahabharata, she would say she wants the Panch Pandav. She wants every trait and everything which she wants, right from the archer to the one who can do the mace to one who can be upright. But of course, this is not Mahabharata, this is not Satyug, and I am not Draupadi. So therefore, my answer as a money manager is, I think the most important thing that we look out for, of course, there is rating, there is underlying, all that is a given. How diversified the pool is, because often on we see that there are many originators, who hail from a particular region, and these I'm talking about the slightly lower rated lenders. And even 40%, 45% concentration is something which we are very allergic to. So that's something which we clearly look out for. And also going very low down the spectrum in terms of rating is not something which at least we are very keen on at the current juncture, given the fact that the monies are not really getting diverted to the credit category. If you see month on month the mutual fund numbers, the credit risk category is only seeing net outflows. So if we were to buy securitized pools as part of non-credit portfolios, which is not a bad thing to do, I think the sweet spot would be, among other things, the tenor. So if there is a case to look at anything under, say, about 2 years, or maybe ballpark 12 to 24 month kind of a space, that's the sweet spot right now for two reasons. A, people are still willing to put money into short duration funds, low duration funds, where the durations of these funds are either regulatorily capped, maybe at 12 months or so, or as a money manager, given the current macro, it's being managed in the band of 1.5 to 2.5 years. So I think that's where we will look out for some added tadka, if I were to say, something to really, I won't say spice up the portfolio, but flavor up the portfolio. So you get that kicker of that additional yield, you have the benefit of diversification, and you get the rating advantage because of credit enhancements and cash collateralization. Because on a standalone basis, the non-credit risk funds will have very limited appetite to actually absorb some of these asset offerings.
Right, and we so far heard from, let's say, somebody from the bank side, the NBFCs, both are these sectors which have actually invested in securitization for several years. We also heard from a mutual fund who've been, like I said, off and on, in and out in the markets. Couple of other investor segments which have always been spoken of. It's like the insurance companies, pension funds, and so on. They have always been spoken of as one of the potential investor segments, especially in the context of RMBS. What they look for and what RMBS offers is a very neat fit. But if you look at the actual numbers, their investments are not really materially huge. So I'm going to move to Shweta and just ask you, because you've been interacting with a variety of segments, and I'm sure you've done discussions with these segments also. So why is it that we don't really find them investing in securitization in a big way? And do you see any of that changing in recent times?
Yeah, thanks, Kalpesh. I think this is a very, very important question, and some of us have been trying to address this for a very long time. But before coming to what is the progress here, I think I would just take a step back to say that why is it important to really create, this particular, create that interest from this particular set of investor class. When we talk about long tenor pools, when we talk about HFCs, there is an inherent structural ALM challenge which they face when they are raising funds from traditional sources, right? And securitization is a clear answer to that ALM management challenge. And hence, there is a clear need to develop a diverse pool of capital for this segment. And hence, we come to the requirement of developing this whole segment wherein we've tried engaging with multiple insurance companies and retirement funds. Obviously, we have seen very limited interest in this space, and there are genuine reasons for the same. If I have to break it down, when probably an insurance company or a retirement fund is looking at an investment, there are a couple of risks that they think about. One is the liquidity risk, right? Even if somebody is investing in a AAA rated PTC, do we really have the liquidity in that space currently in market? We really don't have that. So that's one issue. The second one being probably credit risk, right? Now, what we have observed is that these are typical fund managers who are willing to take duration risk. But when it comes to taking credit risk, it really requires a deeper understanding of that asset class, and how the pool will behave over a period of time and so on and so forth. And probably for somebody like us who's doing this day in, day out, this may look like a very staple product. But for a new person who's not done it before, securitization can come across as a very complex subject, and to develop capacity and create that bandwidth to assess the underlying pool and then, the entire execution process. And it just doesn't end at execution, but even once you have invested, how do you really take care of the monitoring of it, considering these are really long tenor investments? And then complying with certain regulatory requirements of stress testing and so on and so forth. This can look like a very complex subject for the new investor and the new investor segments. So I think that is one of the reasons that we feel is, why insurance companies and retirement funds have kind of stayed away from this whole securitization as a subject. We've seen some investments happening from only one probably insurance company at, and that's also limited to a particular originator. But if we really have to develop this market, I think we really need to address the capacity building issue, which is maybe to some extent can be addressed, and we have tried to address this through some technology-enabled platform that we've built at our end, wherein you can do seamless execution of the transaction, and some of the work which an investor has to do can be really taken care by the platform digitally, and some kind of hand-holding and post-monitoring support in the form of giving you ready-made performance, a matrix, and doing stress testing, etc. Some tools which can be provided to them. I think that can really help in a longer run. So,
no, that's right. Only the good thing is that a lot of the stuff which you mentioned is actually happening, both in terms of platforms, in terms of hand-holding, in terms of reporting, etc., etc. So hopefully it will develop more confidence, especially in the new investor segments. I'm just going to pull off a thread which you mentioned about one of the worries of the investors being one, that it's a complex product for anyone who's sort of getting into it for the first time. Second, that the need for monitoring is very high. So just taking it that further from there, Umesh, this entire worry about the monitoring part and especially the availability of servicer reports. You've been on that side, you've been representing investors for years. What is your comment on both the timeliness of these reports post-transaction as well as their quality? As an investor, in short, do you think they get what they should be getting, or is there something which is missing?
So, if I say last 15 years, what kind of report we used to get earlier, and now what is the quality of report? Definitely it has improved a lot. But still we feel currently we are dealing with more than 100 servicers. And each and every servicer is giving report in their own formats. So as an industry, I feel there's a need of standardization of report. Every rating agencies wants report in a specific format. So as a trustee, we try to accommodate everything in one particular format. But there are challenges because the information, the structure in which we get reports are different. Timelines, that's a biggest challenge as a trustee we face. So even if document says that trustee should get report 3 or 4 days prior, but practically we get report 1 day prior or sometimes on the same day. We try to accommodate everything and give report to investor in specific format, in specific timelines. But still there are challenges and specifically on timelines. The quality of reports definitely it has improved, but as an industry, if we can come out with a standard format for reporting, it will help us.
In fact, this standardization, not just in terms of reports, but even standardization of documents, etc., is another point which has been discussed and noted several times. Even in the Harshvardhan committee report, that was one of the items which had got a lot of space. But just to also further add to what you mentioned, that a trustee's role is in a securitization quite different from what it is in a conventional NCD. In your view, in the system at large, is there a recognition of the trustee's role in a securitization transaction, or do you think people don't really understand what all is required of a trustee?
Definitely people appreciate the role of trustee, but I guess market is not aware what exactly trustee has to go through. So like I mentioned, NCD transaction, the structure is, very simple structure. On a specific date, you get a coupon principal. But in a securitization transaction, every transaction is different. So as a trustee, we need to do a lot of calculations at back end. In a normal NCD transaction, whatever assets have come as a security, on a quarterly basis, you can change those assets. But in securitization, that's the only assets you have. So you need close monitoring of those assets. And we have seen challenges in getting those reports where maybe whatever portfolio is assigned, sometimes we get different reports. Sometimes closing and opening is not tallying. So the basic hygiene issues are there in transactions. So as a trustee, a first priority is to make the payment to the investor. But at the same time, now investor wants a clean report. And that is, unless servicer provides us those clean reports, it's very difficult to give that kind of service to investor. And now there's a need of technological innovations. So as a catalyst, we have developed a couple of systems where automation is there. We upload the borrower's information, we'll get the report. Investor can log into the system and they can directly download those reports. They can view every day what is happening, but provided we get that kind of information from a servicer. So now there's a need of API integrations with the servicer as well as trustees systems. So if we work on those areas, so definitely trustee can give better services and investor will be, whatever, as per new regulation, specifically direct assignment, now there's a need of daily monitoring. Trustee get a monthly report, but investor has to have a daily monitoring. So these are the basic challenges. So definitely the need of a technological innovations and at all levels, services, trustees, we have to align to provide better services to investors.
On this point about, for example, the reports or the daily recognition of NPAs or the quality of reports, I'm going to quickly ask Manoj and Arvind, both of you, so far as these reporting from the originators is concerned, not just the basic reports which one gets from the originators, but also thanks to some of the platforms and curated analysis which is now available even through rating agencies or otherwise. Largely, what is your comment on the kind of reports that you actually get? Is that something which, say for example, if you have to speak to someone who is just stepping into this market as a new investor, would you tag this off as an item that you're worried about, or would you think this is something which has improved over the years?
So, over the securitization market now is 15, 16-year-old, and we've seen hundreds of pools getting matured, even in cases where entities have gone bankrupt, but pools have performed and investors have been paid. So, I think from a data integrity standpoint, wouldn't worry too much about it. So far, we've seen, we getting timely monthly reports. We've seen reporting to be, and it is in public domain, right? So to that extent, originators are also conscious of it. A rating agency would publish a surveillance report every quarter or every 6 months. So to that extent, I think I wouldn't see that as too much of a challenge or for an investor to worry about if somebody is getting into this asset class.
What was your question, Kalpesh,
So
about
the question
reporting?
really is that when it comes to these reports from the originators, how would you largely think about these reports? Do they have the kind of quality of information?
I think Umesh covered it well. Standardization and timelines are the key thing. Even today, we have to deal with a lot of follow-up, a lot of clarification, and conventions of each issuer separately. So standardization is, and I think we can solve it among us sitting down, and that should be the next initiative. If we can use platforms, as Umesh mentioned, that would tremendously improve if there's direct connectivity to the systems. But we have to then solve for InfoSec and other RBI priorities as well.
In fact, in addition to this investor quality, Manoj mentioned about the fact that in recent times, we've even seen something which was sort of unheard of 10 years ago. So even this event about bankruptcy of a servicer stroke originator stroke servicer has been tested out. And that was an important event. So Umesh, I would like to sort of hear from you that this entire servicer disruption event, which led to a lot of the old assumptions getting tested, what was the learning from that episode? And do you think going forward the market now stands a little better prepared to handle such an eventuality? So what really happened for the benefit of the audience here, that in a broad sense, how did people really handle that event? Because it would have had several operational challenges. So how did that get handled?
So at least today we can say that we have successfully seen change of servicer. So, I mean, prior to 2 years, before those defaults, we have hardly seen that event happening. But as a catalyst, we have replaced at least for 15 to 20 pools, we have replaced servicer. And there were challenges. At first time such event happened in India. So there were challenges, but it has successfully happened. And now, if you see the collection mechanism, so most of the collection happened through NASH mandate. So when NASH is in place, it's very easy to change the servicer account and link those collections directly to the trust account. So that covers most of the, almost 70 to 80% of collections where collections are happening through NASH. The other cash collection, PDC, definitely there is a long process, notice has to be given. It's very difficult to get a single servicer who has a presence across India. Typically, if you see all the, whatever the portfolio is there is spread across India, we get the regional players as a servicer. So the challenges are there, but at least it's a tested now. I mean, in future, if for any default, if you have to change the servicer, I think we can do that.
So that should, in a sense, give some bit of better confidence to the investors, saying that there have been these traditional challenges to securitization. What if the servicer goes bankrupt? What if the assignment itself gets challenged, so on and so forth? But at least some of that has been answered now. I'm going to just quickly move on to some of the implications from the guidelines, and now we have the guidelines have been around for more than 6 months now. One of the outcomes of the guidelines was the restriction on RBI regulated entities investing in papers which have been securitized by other RBI regulated entities itself. And what that means is, in the past, we've seen some of the transactions coming from some rental companies and so on. Although these have not been very large number, but those were interesting transactions to happen. And now, maybe the banks and NBFCs, etc., will find it challenging to invest in those transactions. So, Lakshmi, with this kind of a restriction on the quote-unquote larger investor segments, do you think it's a bit of a better opportunity for mutual funds? Clearly, with some of the larger investors not being able to do that, it should probably improve the yields for an investor like mutual funds. So do you think something like that can happen?
So Kalpesh, it can act as a catalyst, no denying that, but I think the bigger chunk of securitization market was largely around PSL. And that was a bigger bane for mutual funds because it was never competitive, and till such time that the non-PSL category, which has now started showing obviously some kind of an uptick in terms of the percentage, till the time that does not continue as a trend for some more time, I think the pricing disadvantage may remain, is what my sense is. Yes, as I said, some small mercies can prevail with one segment not being allowed regulatorily to participate. At least that space can be routed towards capital markets and to mutual funds. Also, another thing which is important to note is that banks or any of these entities or the non-mutual funds participating in the securitization transaction, the tenor mismatch in terms of their ask for a tenor and typically a mutual fund ask for a tenor is significantly different. So for example, maybe 12-month door-to-door with a 4 or a 5-month kind of an average is a high point, is completely doped from a mutual fund standpoint, but that may or may not really excite a non-mutual fund, typically a banker. So I think that is where one could see more opportunities coming up. And with the entire term structure itself, today, plain vanilla NBFC itself, the cost of borrowing today versus just about not even a month back is 100 basis points approximately higher. So that itself has raised the bar in terms of, because ultimately a securitization for a mutual fund in terms of classification is still an NBFC, because bulk of them are the NBFC as originators. So I think that is the sweetener at the current juncture, and hopefully with some more clarity coming about, and which we are pretty confident it should probably in a quarter's time, and the flows normalizing, I think this, this process will kickstart again. Also, single loan PTCs, they were like real trendy and in vogue for a fairly long period of time. It was very easy for a mutual fund from a credit perspective also to evaluate, not really go down. So I think some of those, if they make a comeback, I think that's what will make the markets more vibrant from a mutual fund demand perspective. And as I said, it's reasonable to assume even a non-NBFC originator issuing a plain vanilla versus securitizing, through a single loan, I think in the latter there is potential for a higher kicker. So I think some of those is what we would like to see as mutual funds And yeah, I think the yields are already at reasonably elevated levels today. Government of India is borrowing higher than probably what I would get as a home loan, probably from the highest quoting bank in the country. So I think that way the term structure looks much better than what it was probably 6 months back.
And since you mentioned this point about single loan sell downs, which at one point of time used to be like the darling of mutual funds several years ago, now with the guidelines being in place since almost 6 months, do you think there has been any of those trades being shown at all? Has it even started, or have you even heard of people bringing such transactions to you? Has it happened?
No, not really. As I said, we've not really seen the pace of activity that we used to see maybe 3, 4, 5 years back. I think we are nowhere near that pace right now. And the numbers really speak volumes of it. So we just have one major originator who has quite a chunk of his or her outstanding with mutual funds. That itself is the proof of the pudding. So yes, for if there are any issuers in this room, please take note of it. There are potential investors. There are more than 40 mutual funds in the country today.
The other change, brought in by the guidelines was this application of risk weight, and especially fairly high risk weights for the lower rated tranches. Now, some of these lower rated tranches, especially the non-senior lower rated tranches, so in transactions which would have these mezzanine tranches, and some of this could be, NBFCs could be the potential investors. So, Arvind, on that front, do you see anything changing? Does it become less attractive for you? How do you really view it?
That question was for?
Thanks, Kalpesh. Interesting way to look at it. Let me break it down and see if we can, come to some sort of a conclusion, though it's been just 6 months. So earlier, tranching was not compulsory. September guidelines make tranching compulsory. That's one. And two, the lower tranches now have to be rated, and the risk weight table, as you mentioned, some of it goes very quickly to 100, 140, 200, and the lowest tranche is 12-50%. So how has this impacted markets? I don't think deals have slowed down. So anecdotally, I don't have enough evidence to say this is a deterrent. Two, credit enhancement still protects the junior. So there will always be a buyer at some IRR, 15, 16, 20, X or Y. There would still be a buyer because while risk weight is one, you know that it's a fairly well credit protected structure. So deal flow hasn't stopped. Anecdotally, volumes are there. Has higher risk weight deterred markets? I still think we are still coming from the last 4-5 years of ample capital and ample liquidity. We will be put to test over the next 24-36 months, where either it will reflect in price or it will reflect in the deal flow or the volumes. In any case, and here is where I sort of differ a bit with Manoj, PTCs, I think, do a lot for the buyer. I think they don't do enough for the seller in the sense there's protection by way of capital, there's protection by way of credit enhancement, and the credit enhancement is very well stressed and very well tested. For the buyer, I think it's a very well, it's a AAA or it's almost a no loss kind of structure, which is why you will find that the better rated issuers prefer assignments, and those who come to this market either need a notch up on their corporate rating or need a diversification in terms of their funding sources. So with those two motivations, more funding sources or notch up, this aspect of lower rated tranches being very high risk weighted has not yet come to the market or has not yet become an issue yet. But like I said, we should defer this question for a year and then relook at it.
Maybe some of it time will tell. Shweta, the other change brought in by these guidelines, and I remember there was being a lot of discussion at the previous summit when the guidelines were fairly fresh in everybody's minds about over-collateral not counting as MRR. And not to say that over-collateral was a piece of every securitization transaction, but at least it was a part of the structure in several. So post guidelines, what has been your experience about people preferring over collateral? I mean, there was that time a discussion that the the use of over-collateral in transactions will probably come down significantly, etc. So what has been your observation in discussions?
Right, Kalpesh. I think it's a very valid question. So when the guidelines came out in September, I think the initial expectation was that this will have a significant impact on the way we structure PTCs going forward. But what we've observed is that we have been able to find an alternative solution in the form of equity tranche. So OC has largely been replaced by an equity tranche in any structure. Although there is, some sort of an impact on because of this change in terms of the higher capital charge that is getting attracted on the unrated, no coupon bearing equity tranche. But having said that, I think overall the market has pretty much accepted this as an alternative solution. So we haven't really seen any instance where the transaction got hampered because of this particular change.
Yeah. So the market has sort of found its level, so to say. The other question I had, again, in going back to the different investor segments, we spoke about insurance companies and so on. Another potentially big investor class could be these FPIs. Once again, a lot of potential, but the actual action has been very less. So what has not been working out in their case? Has there any change happened in your observation?
Kalpesh, see, Northern Arc, of course, works very, very closely with a lot of FPIs. So we've seen traction on the bond side very, very well, and we've executed multiple transactions there. When it comes to PTCs, there are a couple of factors that we need to really keep in mind. One is to do with the minimum retention period requirement. The other aspect is to do with the taxation angle. And the third is to do with the hedging aspect, right? Now I'll just break it down in terms of what exactly each factor has to do with the way FPIs have, responded to this. So first, if I have to look at minimum retention period requirement, this can be largely addressed through a suitable structuring solution. So it's not as if there is no way to deal with this. Coming to again the hedging, similarly, this also can be addressed through a suitable structuring solution. So that's also very much possible. The third being taxation. There are two ways to deal with this, at least from what we have experienced so far. One is that either you build that into the pricing, and if after building that into the pricing, if the transaction is making commercial sense, then there is definitely a case for doing that transaction. The second is, which I think Mama also spoke about in morning, is that if you can, which we are also exploring, and it is to do with the gift city. If one has a setup, in the fund setup in the gift city, there are multiple tax benefits, that come along. So where there are hurdles in this investor class, there are also the solutions, right? So then in our experience, what we've seen is that with FPI, the peculiar challenge that one faces is to do with the amount of time and effort that goes in stitching up the whole transaction, right? Sometimes it can take months and months. It can even go over a year, So by the time you really start a discussion and by the time you try and kind of come to some conclusive stage, the whole market would have changed, right,
And the pool would have almost run down.
True. And, so I think that is one very important factor wherein it's about selling right from the basic thing like selling India's story, then explaining them about the specific asset class, then the entire hand-holding to comply with the regulatory aspects, and then, coming and stitching up the whole transaction, also giving them the comfort in terms of providing support for the post-monitoring of the whole thing. And we've done a lot of work here, and we are even currently doing a significant amount of investment in terms of time and effort in this area. We are very closely working with 2 or 3 large FPIs, and we're hopeful to sort of conclude some transaction, in coming months. And what we believe is that probably once, you have 1, 2, 3 transactions, it's like taking baby steps, but then the overall market will, kick off from there and it will expand.
So you are hopeful on that front.
We are
But this thing which you mentioned about the sheer amount of effort that goes in, that needs to be invested into sort of developing a new, investor segment, etc. That's probably true of many of these investor segments, because it's just too much of a time, and oftentimes the question that gets asked is that from the in the investor's mind, and is there really a compulsion on me to really spend so much time and effort into something? I might as well continue spending my time on regular business. Yeah, that's true. Since we're talking about the implications of what happened thanks to the guidelines, Manoj, one of the products which got mentioned in the guidelines of September 21 was this new thing called loan participation, which we had previously not heard of, which is by and large direct assignment less the legal hassle of assignment itself. Do you think people are at all getting interested in that? Do you think banks see some merit in that route at all? Or do you think the preference for direct assignment is going to continue?
Honestly, I saw it for the first time after you mentioned it.
So that itself is an answer probably, that clearly it's not.
Yeah, it's not
high
been
on people's
used
minds,
at
probably.
all. It's not been used at all. Now, technically speaking, it's as good as assignment without the hassles of assignment, as you rightly mentioned. So one should look at it. This is earlier banks used to have something called an IBPC, Interbank Participation Certificate. It is very similar to this, and without the hassles of what required in a direct assignment transaction, you can simply do an IBPC. Obviously, it doesn't appear as probably it will not count as a loans and advances in the bank's book, and it might go in the investment book. But other than that, I don't see why should this be not used more for transactions of sale of assets.
Yeah, except that unlike IBPC, this one will even show up as a loans and advances. But yeah, essentially maybe time will tell in terms of what the interest in that product is. The other thing which these guidelines had alluded to, and that's again just like standardization of documents, the entire piece about listing of PTCs is something which has been discussed for a long time. And the importance was mentioned even in the Harshvardhan committee and the guidelines of September 21. They didn't say that it's mandatory, of course, but they recommended, especially listing of RMBS. Now, one of the things which often gets mentioned as a hassle is this, the entire onerous requirements relating to reporting, etc., both on the originator servicer as well as the trustee. So, Umesh, this hassle of listing, do you really agree with it? Is it as painful as it is made out to be? Or what in your view is the reason why listing of PTCs has not taken up to the extent one would have probably wanted them to?
So, you'll be surprised to know, in last 2 years, there are more than 50 transactions which are listed. Last financial year, almost 30-35 transactions where Catalyst is acting as a trustee is listed. So, initial days, there were challenges, including exchanges. They were not aware how to monitor this transaction. But now, I don't think currently there's a challenge in a reporting formats on anything. So now reporting format is pretty standard format. Typically, last few years, market was predominantly PSL market. But since last 2 years, as NPSL market has picked up, so we are seeing transactions getting listed. You'll be surprised to know we have few transactions. In one of the transactions, currently there are more than 1,200 investors. So it was single PTC transaction. So HNI clients are showing interest. They're showing interest in the listed transactions. So for last 2 years, we have seen good number of transactions getting listed, and I don't think there's a reporting challenge. Typically securitization market, people buy to hold it. So there is no need of listing. So if you see any of the bank, they don't intend to sell any of their portfolio, any of the PTC investments. So there was no need of listing. But now as NPSL market has picked up and retail investors have started, definitely now with the new guidelines, there are restriction of size and everything. But for a listed transaction, again, people have started showing interest now.
So that's definitely encouraging. And in fact, you mentioned about some of the new investor categories. So Shweta, people keep hearing that there has been a lot of work happening on many of these new investor categories. Again, we mentioned about some of them which have not really picked up and some of them which have. So maybe it is family offices, HNIs, et cetera, et cetera. So can you share a bit of what really has been your observation there and what has kind of worked out there? What has gone into getting some of these new investor categories interested in securitization?
Right, Kalpesh. So when it comes to family offices and HNIs, I think there are a few large family offices where what we realized is that the understanding is not an issue. They pretty much understand PTCs, they understand, and with some support from our side, I think we've been able to educate them in terms of structuring and the tranching and so on and so forth. So that's not an issue with some of the larger FMLA offices, but when it comes to pure HNI market, a lot of educating this segment is something wherein a lot of effort needs to be put in, and it's not just at the level of the end investor, but especially in this category of investor, you have multiple layers. You know, you have a wealth distributor in between, or you have an independent advisor. So, you know, if you are able to educate the whole chain, it's only then where you will actually see the traction and some meaningful volumes coming in. Having said that, I think we have done a fairly decent amount of work in this space, and this is in fact out of probably the three categories that we spoke about, say insurance, pension, the long-term investors, and then we spoke about FPI, and then this. Probably the HNI and family office is one investor class where probably the momentum will build faster, is what our feeler is.
So that's again an encouraging sign. Overall, Umesh, if one was to look at, over the years, somehow the securitization market has been sort of blessed with someone saying that may you live in interesting times. And sometimes there has been the income tax claims to worry about. Sometimes there is this notices for tax on the excess interest spread. Sometimes issues related to GST and so on. So at the present juncture, would you say the market is in a sort of a stable or a settled state, or are there like some major issues floating around even now?
As regards taxation, I think
No, you go ahead.
Yeah. We haven't really faced any, at least in the recent past, we haven't really come across any major dispute per se. But having said that, I think, maybe some other participant might have a different view here.
Umesh faces most of it, so you might know.
So, when it comes on a taxation, no one will say it's a closed issue. I mean, every month we receive at least 3 to 4 notices for different transaction with the different queries. We have a separate team for taxation matters. They keep responding to these notices. Last year, the entire matter was tax on the EIS. We have settled more than 200 taxation notices in a VSV scheme. Still, there are more than 50, 60 demand notices pending at income tax level. There's a clarity on the sections. Everyone is aware about sections. Sections are very clear, but still, there are targets for each and every department, and people try to. I mean, there are certain new structures are coming, and I will never say it's a closed issue. Still, some innovative notices are coming. I mean, recently we have seen, I mean, there are a few transactions where FPA investors are there. And recently we have seen a structure where there's a clear-cut FPA is allowed to invest, but we have received certain queries, notices on a taxation on a FPA portion. So we are responding to this. I mean, matters are getting resolved, but it's an ongoing process. I mean, we'll never say it's a closed issue. We have to keep responding to their queries.
So it's still going on. Manoj, you've been looking at this market, or you've been a part of this market in different capacities for a very long period of time. And some of these issues which could have been true, I mean, sitting in 2015, it could have been true. Sitting in 2020, it might have been true. the market is kind of dominated by a few players. One statement which I've often seen written is that securitization in India is a nascent market. This was true 20 years ago, even today it gets written and so on. So if you have to just think about, let's say 5 years from now, if you were sitting in a conference like this in 2027, do you think life will be materially different? Do you think we'll be still talking about the same things? What do you think could change?
So I'm generally a very optimistic person, so I would hope we see lots of single loan and corporate securitization transactions. I hope we get back. See, eventually, for market to be vibrant, you need liquidity in the market. It's generally a buy to hold kind of instrument so far. So I hope we see different categories of investors with their different motivation participate in this market. As we see more participation and more active trading happening in this segment, I hope the volumes will increase. From a regulatory standpoint, I would say that we are in a stable state kind of a thing. I wouldn't say that there is always something better possible, but that incremental is not that material to give a significant impetus to this market. So it's more now the action from investors and issuers that should propel this market to the next level.
Right. And since you spoke of, you hope to see a few things, I'm tempted to, put this one last finishing question on everyone before we open questions to the audience, which is that if you sort of had a Aladdin ka chirag and you could wish for any one or two things, but only related to securitization. So what would that wish list be? You can start from you and reach right up to Arvind.
No,
you can be greedy, you can ask for anything related to securitization.
No, so as I said, if I go 10 years back, the mutual funds were extremely active on securitization market. Banks were extremely active. Banks still are. So more and more investors, FPI, mutual funds, insurance companies, participating in this market, making it more liquid. That is what I would wish for. I mean, that is what will take this product to the next level.
I think, Kalpesh, development of secondary market, for securitization, I think that is going to be extremely critical and a lot of work needs to be done there. And that's possible with more market participants coming into picture, more investor categories, coming there. And of course, a significant role can be played by product specialists like us, in educating different asset classes, different categories of investors. And then also some of the things that we spoke about in terms of standardization of documents and availability of information, again, is going to be extremely critical. And last but not the least, I think putting all of this together probably through a technology-based platform will make a huge impact is what I feel. Yeah.
It's quite a possible wish list. It's quite possible.
So my wish list to the genie would be to allow PTCs to quote 2 ways as fine as Government of India securities. Absolutely. So that is as simple as it can be, and I'm not very greedy. So I will say I just have one wish list.
So last few years we are seeing the same set of investors. So new investors should explore this market. And specifically mutual fund. So last 3 years we have seen hardly any transaction from mutual fund industry. So single loan transaction as mutual funds coming back into industry, that will be great for industry.
So let's make investment in securitization mandatory. Instead of having a cap, let's have a minimum, let's have a floor.
So I'm going to ask for two, Kalpesh. One is roll down credit enhancement resets, automatic resets, and two, to be eligible to be counted as loans and advances. These two, I think, can make a material impetus to get started.
Yeah, right. That's a valid point. So we've, I think, done with whatever we had to talk among ourselves. time to now open the floor to questions both from people who are here as well as people who have joined us online.
I have a question on the servicing transition. Umesh talked about some transactions where services have been changed. Two things, servicer changing, was it based on, of course it was trustee's action. So trustee took the action based on investor consent, or was it done by trustee himself? That's one question. Second, what happened to the servicing fees? Because the replacement servicer would have obviously expected substantially higher servicing fees, unlike the non-arm's length servicing fee at the original servicer level. So what happened to that? Where does that come from? The excess spread level takes care of that. Supposing it wasn't enough, then what happens to that?
So, in a default by servicer, so that initiation is done by always investors and not by the trustees. So, we act on the investor's instruction to replace the servicer. Servicing fee is something, I mean, no structure captures this kind of servicing fee. If tomorrow we need to replace, structure doesn't allow it. But it's an investor's conscious call to give most servicing fees to the new servicer. And it will be at least 10 times higher what fee used to pay to the existing servicer. So, from a EIS portion is sufficient to take care of that particular thing. So, definitely with the new servicer, fees goes substantially high. And I guess EIS are sufficient to take care of that servicing fee. So, this is how the structure works.
Any other question, Andy?
So, Lakshmi, you asked about the loan PTC, single loan PTCs, that it's allowed, but why it's not picking up. So, just my 2 bits on that. The fun of loan PTCs is when you can originate and sell the next day. So, because you have the seasoning requirement, I cannot originate with a market view 6 months hence and what rate I would sell it. So, be rest assured, the seasoning requirement is taken care of, you will be flooded with loan PTCs. But till then, it won't work.
I'll give you my genie.
This whole, I think everyone since morning has talked about single loan PTCs. In single loan, how do you do tranching? We tranche what? There's one single loan to one single borrower, what do you tranche? Just the recovery rate, or what exactly would be? No, tranching means credit tranching. Tranching is not time tranching. Tranching by definition has to be credit tranching. So, if the borrower is one, there is only one risk. Other than recovery rate, I don't know what do you tranche. I don't know if somebody has solution.
Yeah, you can do a credit tranche, right? So
credit risk is on the same borrower.
Yeah,
the same borrower either survives or defaults. So, there is only one possibility of survival, one possibility of default.
First loss, you could have a first loss
No,
kind of.
that's precisely my question. The first loss or second loss will therefore have to be only based on the expected recovery rate. It cannot be based on probability of default. That's only one for the borrower. I can, for example, let's say recover 70%, I might recover 60%, I might recover 50%. So, it's at the recovery rate only. So, tranching is possible only on recovery rates.
But eventually there could be two investors with different kind of risk appetite, right? So, in a retail pool, typically which would be a less than investment grade pool, you make it a rated pool by adding credit enhancement on top of it, right? So, let's say if there is a single A rated kind of a borrower and you can add a credit enhancement on top of it and make it suitable for a double A rated investor, then that credit enhancement which one is putting on top would be the credit tranching which one is doing.
I don't know, to my mind, I think the principle of tranching itself necessitates having a pool. It's only a pool which can be sliced. In a single loan, all that can be sliced is the possibility of recovery. The enhancement in that case will necessarily have to come from the originator, and the originator's bankruptcy will anyway then affect the investor. So, I'm wondering whether this is sort of originator topping up the risk of the obligor, that wasn't the intent of the investor. The investor probably has more confidence in the obligor than the originator. Otherwise, the single loan sell-off will probably not work. So I don't know, it's somehow sounding like economically a bit non-feasible idea, but possibly yes, the market will demonstrate. Yeah. Anyone else? Any question to?
Hi, this is Sumit from IDFC. We've been speaking since morning about issuers, and a lot of issuers kind of expanding the market. About expanding the investor base. What we've not spoken about is expanding the issuer base. Fundamentally, if you see today, banks are not present in the issuer segment at all. The large NBFCs, if you say the AAA NBFCs, are literally not present, except for captive transfers. Large NBFCs, the AAA ones, don't really do market issuances. So frankly, where will volumes come from? I mean, 5 years down the line, we spoke about having more investors, having more liquidity. But global volumes, I would assume, would come from, large issuers, which today banks are largest lenders to the retail segment, but frankly, not present as issuers at all. So what's the panel's view on, whether banks will, when securitization market started well back in 20 years back, ICICI used to, at that point of time, do 30,000 crores odd of issuances every year. After 2006 guidelines, that literally stopped. Do we see banks and large NBFCs really coming to the market at all? So that's question number one. Question number two is, again, mortgages globally are very, very large. But in India, other than captive, as I said, other than captive, transfers, say HDFC transferring to the bank, frankly, there is no really market for, mortgaged assets really changing hands on the securitization side. So frankly, do we see a mortgage market developing in India? And first is in terms of issuers. So these are two questions. On the corporate loan securitization bit, whether mutual funds will be able to invest at this point of time, my view is that the spreads between the loan and the bond market, which historically used to be 150, 200 basis points, today I think loan markets are cheaper than bond markets. So today, frankly, AA rated borrower can get loans better price than bond market, simply because of the kind of liquidity that the banking system has and because of the lack of capex that has happened. So given that the spreads don't exist between the loan and the bond market, frankly, there is no motivation for a bank. Today, if I give a loan, there is no motivation for me to go and sell it down to a mutual fund. There is a lot of dearth of asset really on my book itself, and similarly for all the banks. And banks are cutting pricing and giving BBB borrowers and A borrowers at rates which are lower than bond markets. So frankly, that I see as a challenge in terms of single loan securitization at this point of time. But on the first two questions, which is issuers, and second is on the mortgaged, mortgage-backed securitization. I leave it for the panel to decide who will take this.
So I'll take a crack at the first one, Sumit. If we look at the macro, or we look at the economy, banks are the lowest providers of funding. So unlikely that banks will come to sell assets, because then there's only retail. And for retail to be comfortable and educated about the product, I think it will take a lot of effort from this whole room. So banks, I think, will continue to remain providers or buyers, and the rest of the ecosystem would remain the sellers. Now, coming to the issuer side, the primary motivations are capital management or liquidity. We've not had a challenge of either for the last 5 years. Okay? Let's look at the next 2-3 years and see how it goes. So there are still pockets. There are pockets of people who are low leverage but constrained for funding. They will come through in some form or the other. Either they will prefer PTC, or if people are comfortable with their credit, they might have a DA. Then there are people who are constrained for funding and capital, and they will traditionally be in the market on the sell side. So if your question is what is going to dramatically explode the issuer side, it's only going to be paucity of capital or liquidity. That will get more people on the table. But to expect banks to be sellers, I think none of my discussions are even going there. So I'll reserve my comments on that, on the first, that aspect.
So, he rightly said, from a bank standpoint, Now, securitization post the Ind AS application, it is not getting de-recognized from the balance sheet for NBFCs. So it's becoming more of a larger liquidity tool rather than the capital tool per se. So as the liquidity dries up and you know, NBFCs for expanding their balance sheet, they would need different sources of fund. This could come in handy. So I guess that would be a driver for issuers.
So just adding to what Manoj just said, I think there is a difference. I mean, in the higher rated space, more and more issuers will come into this market, especially in the times of dry liquidity and, when probably there's difficulty in raising funds through the other channels. But there is a huge scope to add more and more issuers in the mid and the smaller, originator space. Especially you have these new age fintech entities, and you have newer asset classes coming up, and you have a lot of new products like in this latest securitization guideline where they've allowed persistent securitization. So when we are able to come up with those newer structures, probably we'll automatically expand the issuer base and cover more number of issuers. So I think, yeah.
Mortgage assets, I mean, my second question was on whether a mortgage asset market will really develop in India. I mean, one is long-term, no insurance companies investing, and the whole basis risk with mortgage assets. So, frankly, my understanding of the market is, while globally mortgage market is a very big market, in India, other than, some captive transfers, I don't really see a large mortgage market playing out today. Is it looking like whether it will play out in future or not? What does the panel think?
If you see on the mortgage side, you see a lot of direct assignment transactions, right? It's a very active market, lots of issuers. I mean, you go to any affordable housing finance company, which is an emerging segment, almost 20-25% of their liability is coming from this space. Now, why direct assignment and why not securitization? Of course, I mean, some of the challenges on the, you block large amount of capital, credit enhancement does not get reset. It's more, I would rather say it is more, they are more incentivized to do direct assignment rather than doing securitization. Otherwise, as an asset class, mortgage, you see a lot of mortgage transaction happening.
I would like to thank the panelists for a very holistic perspective on buy-side interests, motivations, and concerns. Next, we will be moving on now to the Indian Securitization Award 2022. For this, I ask you to please be with us for the next 5 minutes while we prepare for the same.
In today's hall, we have two types of participants, northern arc and the other half. Okay, time to go to the awards. May I request Devang to please come on the stage to hand the awards over. This time we had decided to limit the award to only one category, the most innovative deal of the year. And we have received, please get seated. We had received 5 nominations. I'll run through the 5 nominated deals. Move down, please. So the first one is a securitization of, can you move, yeah. Next slide, right. So the background, of course, as the market is on the upswing, it's time, just go back. Time to recognize innovation. Innovation is what drives the market to new heights. Awards are not merely a sense of accomplishment. Awards are also to encourage players to move to better services, ensure consistent performance, and continue the innovations in the market. The awards will be given at the foundation. So move next. The criteria for the awards, move down, is deal structure, ease of execution, innovation in the structure, investor value, scalability, and replicability of the structure. These were the criteria based on which the nominations were adjudged by the jury. There were 5 nominations, as I mentioned. Number 1, a trade receivable securitization. Number 2, a 3-tranche turbo par securitization transaction. Number 3, a direct assignment, which is at premium over the outstanding principal. The 4th one is assignment of merchant loans. And the last one, not the least one, securitization involving a make-whole amount and capital gains. The first one, the trade receivable securitization transaction, was nominated by Great Capital. The structure involves a single obligor with a substantial rating, and the transaction was based on invoices raised by a certain merchant to a particular obligor. The merchant is acting as a trading intermediary. All the invoices have a maturity of less than 6 months, thereby providing an attractive short-term opportunity to investors. The structure allows the intermediary to easily originate and securitize the invoices at a scale which would otherwise not be possible for a single vendor. And in terms of the nomination, the transaction involves innovation because it's been able to leverage its trading intermediary status. The single vendor can neither generate significant asset volume, which can be securitized, nor execute transaction without facing significant legal and operational hassles. By aggregating supplies from various vendors as trading intermediary, the intermediary can do the both efficiently. As intermediary has built proprietary technology solutions to successfully fulfill the procurement needs of the obligor and coordinate with various vendors at a scale, this enables it to deepen the relationship. Transaction offers off-balance sheet funding, supply chain funding, for both the originator and the obligor, and the transaction leverages technology, developing API and systems to maintain a digital ledger of invoices and so forth. The next, you can move to the next slide. Then the second deal is a 3-tranche turbo par securitization transaction nominated by Northern Arc. The structure involves securitization of education loans. Underlying loans represent a mix of secured, partially secured loans to graduate and postgraduate education loans. Transaction has been rated by CRISIL. Innovation is in terms of asset class, because that's a new asset class for the Indian market. It's a
the Indian capital market otherwise has long dated newer asset class like education loans. Historically, the sector has been at a lower count and size of deals owing to primarily the asset quality considerations. Thus, the structure of the transaction ensures necessary checks and balances are built to track performance. Sufficient safeguards have been built in case of persistent weak performance of underlying loans to protect the interest of the investors. The third transaction is a direct assignment transaction, once again nominated by Northern Arc. The transaction is a premium direct assignment transaction where purchase consideration is arrived at by fair valuing the receivables obviously, and by capturing the expected losses and prepayment of the underlying pool over the tenure. Because it's a premium structure, therefore the cash flows are matched with aggregate value of cash flows to be received by the originator. The returns to the assignee is dependent on the following parameters, and the parameters include the cash flow schedule, expected monthly prepayment rates, prepayment schedule or curve over the pool structure, lifetime losses, loss build-up, loss curve throughout the tenure. Discounting factor is the discount used to compute the value of the pool. While the points A and A to F are the points on the left hand side are based on selected pool and the pricing is based between the parties, the returns to assignee is often sensitive to other factors. The structure discounts the pool cash flows for the expected losses, and the innovation here is that it's a premium structure. The funding of the originator can be higher than in a comparable direct assignment, which obviously happens at par value. Investor takes a calculated risk by taking into account the expected losses, expected prepayments, and the excess interest in the pool. The monthly cash flows is split in 90-10 ratio between the assigner and assignee. So the differential splitting of principal interest is not required as the cash flows have already been fair valued, and hence it's much simpler to distribute the cash flows. The fourth entry is assignment of a merchant loan or merchant loans rather. This is nominated by Cred Avenue Private Limited. The structure is backed by assignment of merchant loan receivables sourced via Paytm platform by merchants or traders in Paytm ecosystem, having daily payment frequency, originated under a lending program partnered with a technology service provider by sourcing and servicing of loans. The program provides for a set-off of all the dues on a quarterly basis, which are overdue by more than 90 days from a loss reserve maintained as per the arrangement. Transaction involves a replenishing period of 15 months, it's a replenishing structure, followed by an amortization period which is with promised interest payment during the both replenishing and the amortizing period, with accelerated principal payments to PTC holders during the amortization period. Innovation, of course, is it's a completely new asset class with replenishing structure, thereby facilitating a transaction of longer tenure against shorter duration of asset class. Significant credit protection in terms of credit enhancement, which is consisting of 3% external cash collateral and a 14.41% over collateralization. Key structuring highlights is strapping of principals in relation to contracts overdue by more than 60 days, set off of contracts which are overdue by more than 90 days from the loss reserve on a quarterly basis, early amortization triggers in case of PTCs in case of breach of the boundary conditions, and lastly because of structure robustness, the PTCs were rated higher than the rating of the seller, thereby benefiting the seller as well as the investor. And the fifth entry is filed by Catalyst Trusteeship Limited. It's a securitization involving make whole amount and capital gains, transaction backed by loans against properties and housing loan receivables. The transaction shall have timely interest and timely payment of principal structure, TITP structure. The amount of principal distribution to senior PTC holders shall be such amounts that result in payment of default return, payment of minimum make whole amount or XIRR on the senior PTCs, which would mean prepayment protection essentially. Distribution to subordinate PTC holders and junior PTC holders on a pro rata basis. The program provides for set off of all dues on a quarterly basis, which are overdue by more than 90 days from a loss reserve maintained as per the arrangement. In case where the aggregate amount of outstanding senior PTC is reduced to INR 1 crore, the senior PTC holders shall receive all allocable cash flows payable as per capital gains or as income distribution. The transaction involves a concept of make whole amount, I guess compensatory payment, as also bringing capital gains into the picture. The 5 entries were sent to the jury and the jury selected. Any guesses? Any guesses, anybody? So the jury, if you can maybe go back, would you go back to the jury selected? Yeah, you're building suspense. The jury selected the fourth entry, which is securitization of merchant loans by Credit Avenue. Round of applause for Credit Avenue. People from Credit Avenue, all participants from Credit Avenue. Are you all there to receive the award, Credit Avenue people? The entire team could come up to receive the award. The award would be handed over by Mr. Devang Gada. Very well done, Credit Avenue team. So congratulations, Credit Avenue, all of you. And Devang, thanks for doing the honors. The last few minutes will be just relaying the key takeaways of this entire summit. So my colleague Tim will do the summarization of the entire day's program by the key takeaways. Tim, over.
As we come to the end of a very eventful and insightful day, I would like to present the vote of thanks. I'll first highlight the key session takeaways that we had in today's entire session. We had the welcome address by Ms. Bama Balakrishnan, who gave an overview of the developments in the market and lauded the volume pickup, but noted that it is still much lesser than China and other developed markets. And then we moved on to session 1 of the 10 Securitization Summit 2022, which spoke about the Indian securitization markets going the global way. The same was moderated by Mr. Vinod Kothari himself, who noted that the guidelines in India are largely being aligned to those globally. We had Mr. Mark Adelson, who gave an overview of the global volumes and the emerging asset classes. He made a mention of some of the recent lawsuits. And Mr. Ben McCarthy talked about the new asset classes, particularly those based on fintech. And he mentioned that there are transactions based on buy now, pay later loans, P2P loans, etc. He also touched upon cryptocurrencies and mentioned how they are disruptive. However, it will need some time. Mr. Prashant Dwivedi gave an overview of the Asia Pacific markets, noted some desirables for regulatory developments in India, such as off-balance sheet warehouse financing and securitization of non-performing loans. Mr. Sanjay Chamria, who was here physically, talked about the use of securitization as a business, particularly by NBFCs. Mr. Krishnan Sitaraman talked about the various benefits of securitization. He talked about the innovations, the macro and micro structures, the innovative structures that are coming into the market. We then moved on to session 2, which spoke about the sell-side developments and the regulatory scenario. The panel consisted of several sell-side practitioners, including Mr. Krishna Loda, Mr. Sachindranath, Mr. Sudeep Bhatia, Mr. Pankaj Malik, Mr. Irfan Sheikh Mohammed. The panel also included Mr. Nihas Bashir, a noted legal counsel. Mr. Devang Gada was the moderator for the session. The panel dealt with the economic equivalence of co-lending, direct assignment, and securitization, the three which essentially result into origination by NBFCs and acquisition by banks. The panelists also felt that regulators should accept the reality and permit credit enhancement for direct assignment and co-lending. The panel had an engaging discussion on capital requirements based on the risks of the pool. Mr. Nihas Bashir mentioned that some of the infirmities of the regulations that the regulation does not allow financial sector entities buying securities originated by non-financial companies. We then moved on to Chakraview discussions, which are essentially fireside chats, which was the first time we had done such a discussion. As you may have noticed in different parts of the room. We had interactive discussions by the participants and the anchor person who was leading the discussions. We had topics such as NPL securitization, wherein Mr. Prasanna Kumar was the anchor person and he gave his insights on the crux of the discussion and said that NPL loans should be allowed to be securitized, whether through ARCs or otherwise. We had the next topic, which was, are bankers giving a fair deal to DA or TLE markets? The anchor person was Mr. Hemant Pandey. The anchor person for the next session, green securitization, ESG concerns in securitization and STC securitization, was Mr. Atul Agarwal. And we had the fourth session, which was based on role of third-party credit enhancers in securitization. These discussions concluded and the presentations were made by the anchor persons, and there was an insightful discussion on the same, which then moved on to a special address by noted economist Dr. Viral Acharya, who mentioned that government guarantees for mortgage lending may be good for promoting mortgage lending and take away the credit risk and be left only with the interest rate risk. He also spoke about covered bonds and mentioned that while there is skin in the game, it is quite good. However, in India right now it's a problem. The problem is clogging of long-term money by government paper, leaving very little space for the private sector investment. He also spoke about co-lending, direct assignment, and also spoke about the new and upcoming concept of cash flow-based lending, which is based on OCIN, which is something of India Stack. And it is new and upcoming. It's a technology platform. We then moved on to the third session that spoke about buy-side interests, motivations, and concerns. The panel consisted of several investors such as mutual funds, banks, NBFCs, represented by Ms. Lakshmi Iyer, Mr. Manoj Gupta, and Mr. Arvind Sampath. The panel also included representation from trustee Mr. Umesh Salvi and Ms. Shweta Shah, who presented from an arranger's perspective what are the buy-side interest, motivations, and concerns. Mr. Kalpesh Gada was the moderator for the session. I would now like to move on to thank our sponsors and the speakers for the event. The sponsors are Platinum Partner, Northern Arc Capital, Gold Partners, Poonawalla FinCorp and HDFC Limited, Silver Partners, Cred Avenue, Ugro Capital, Resurgent India, Associate Partner, Ratna Fin. I would also like to thank our endorsers, ASIFMA, Australian Securitization Forum, and Asia Pacific Structured Finance Association. And last but certainly not the least, I would like to thank the participants who have been with us throughout the day and helped us in making this event a success. Thank you so much.